we are in the last chapter, that is risk assessment and internal control. That's the last topic in the order of discussion. And of course, these are the standards technically we are going to discuss as a part of this chapter. 520, 530, as I already told, these two are audit evidence topic. It is there. 450, 265 were part of audit evidence, but now we will be discussing along with risk assessment. We'll be discussing now. And again, this particular chapter weightage is, minimum 8 marks to 12 marks, and even these standards are also there, right? Worst case, if at all, from those standards, if at all a question comes, 4, total 16. That's the maximum weightage of all these topics put together. So risk assessment 520, 530, 450, 265 and 330. 5 standards and risk assessment chapter, nothing but. So entirely put together, the weightage will be 12 to 16 marks. That's it. Technically, 100 marks portion is over. Choice we are discussing. What we are discussing is like a choice related portion. 100 marks is already over. Enough. But this risk assessment topic also can come as part of MCQs and also can come as part of compulsory question. That's it. Okay. Now, so we'll directly proceed with the chapter. And in the risk assessment, if you observe, we have divided the entire chapter into multiple topics. This risk assessment and internal control chapter, we divided it into multiple topics. Like, we are going to discuss something called first topic, risk assessment. Second, we are going to discuss about materiality. There is a standard called 320. Actually, this is 7th standard, technically speaking. Along in this chapter, we are discussing totally 7 standards. 450, 265 belonging to another chapter, 520, 530 belonging to another chapter, and 320 in this chapter, 330, and this chapter predominantly 350. 7 standards we are discussing actually. Materiality, that's another chapter. Another topic that we are going to discuss is internal controls. Internal controls. And fourth one, let me do one thing here, I'll write. So what are the topics that were there as part of risk assessment? Risk assessment and internal control. So first one, risk assessment. This is one topic. Another topic is materiality, which is nothing but SA 320. And another topic is understanding the entity. You can even use the word understanding the entity. Understanding the entity. Then I think internal controls. Internal controls. Then we have automated environment. Then IFC, right? Automated environment. Then internal financial controls, correct? Yes. Then we have IFC, internal financial controls. Then we have finally 330 standard. Then we have 530 and 520 standard, 450 and 265 standards. These are the topics technically we are discussing as part of internal control, where this is covered as part of our 5th chapter, which is audit evidence. This is covered as part of in our book as part of 6th chapter. But we need to discuss it in the risk assessment. That's it. Rest all other work covered here. Now, in exam, how a weightage will come? Automated environment, 99% 4 marks question pakka. Either 2 MCQs they might ask, or a 4 marks question might come. Okay. Then, if you see risk assessment and understanding the entity put together, this is one topic. Technically speaking, these two put together, one particular standard only dealing with that. Even internal controls also dealt under that topic only. Okay. From whatever I've highlighted here, like risk assessment and understanding the entity, 4 marks weightage possible. Internal control discussion. What is it? Internal control discussion, a 4 marks weightage is possible. Then materiality and IFC put together may or may not come. Okay, if at all it comes, it will come for 4 marks. Automatically, some or the either of this question might be cancelled. Able to understand? And obviously, 530 and 520. because it's part of audit evidence chapter. If 530, 520 tested, some other topics might not be tested in audit evidence. Able to understand? There is no guarantee that compulsory question can come, but if a question comes, a 4 marks weightage for SEA 530 and a 4 marks question for SEA 520. There is no guarantee that a question will come. That's the point. Because no, in 500 audit evidence topic, we have totally some 8 standards. All 8 standards put together, the chapter weightage is 8 to 12. Remember, all the standards. Now, for a 12 marks question, means 12 marks means only 3 standards only they can test. Out of 8 standards in the audit evidence topic, any 3 only they can test technically. They can't test all the standards. But if at all they test, this is the weightage of those topics. If at all they test, we don't know whether they will test it or not. Then 265, 4 marks is the weightage. 450, 4 marks is the weightage. Now immediately some of you might think 4 plus 4 plus 4 plus 4. No, never add this. 8 plus 4. No. I'm just telling you, if a question comes, how many marks it will come. That's what. Able to understand? Technically, this is part of audit evidence topic. This is also part of completion and review topic. There it depends upon how they are testing other standards. If at all they are testing other standards, they may not test this. Able to understand? For example, in the last attempt, January, I think 530, 520 was not tested. Sampling, there is no question on that. There is no guarantee that. Last time they test, this time also they'll test sometime. We don't know. There is no pattern like that. Institute will not follow. I already told one. There is no pattern that same question, will not come. Last attempt, if there is no question, this time it will come. There is no such pattern at all. Nobody follows that pattern at inter level, at final level, at foundation level. It is we who are concluding that. That's wrong. Okay, there is no guarantee like that. There are few attempts where every attempt 530 pakka question will be there. 530 pakka question will be there every time. But now it is added as part of one chapter. Earlier we used to have 530 as a separate chapter, 520 as a separate chapter. In the old scheme, audit sampling is one chapter, analytical procedure is one chapter. Pakka question. But now they added it as part of audit evidence topic. We don't know how they might test it. Able to understand? But effectively 12 marks is the minimum portion which they will test from audit evidence. Sometimes up to 16 also it might go. Clear? That's it. So this is the composition of the chapter, risk assessment and internal control. This is the composition, like entire overview of what we are going to discuss. Automated environment 99% they will test. Internal control topic 99% they'll test. Risk assessment topic, of course, 99% they'll test. Materiality they may or may not. Materiality topic they may or may not. IFC also may or may not. That's it. 330. This is also being tested for 4 marks. In the last exam also 331 question is there. Jan 25 attempt also 331 question is there. Clear? Now remember, there are totally, like, I'll give now introduction to the topic. Whatever we do in audit, we call them as what? Audit procedures. Yes. What we do actually, audit procedures. Examination, verification, observation, whatever. Yes or no? Whatever we do is called as audit procedure basically. Why we do this? To obtain, the objective of audit evidence is to obtain audit evidence. Yes or no? The objective is very simple. I want information. My objective of audit is what? First of all, to give opinion. If I have to give opinion on financial statements, I want to know what are they based upon. I want to know how they were prepared. What is the basis for them? I want information behind them. Financial information I want for financial statements. What financial information is there behind the financial statements I want? That information I want. Now, for getting that information, I need to do various works, various procedures I need to do. Is it too disturbing? Yeah, just 1 minute. Yes. So once again I'll repeat. Whatever we do in audit is to obtain evidences. So whatever we do in audit is to obtain evidence. And whatever we do in audit generally to get this evidence is called as audit procedure. Okay. Now in this technically what I generally recommend many students is to take choice of this entire topic except 465 and except 450 and 265. But for listening, 100% to listen. No compromise. If at all it feels convenient for some students, this chapter might be very convenient, no problem at all, happily study. But if at all you feel after completing, because this is lengthiest chapter, after you study everything, not only lengthy, complex also, items of financial is that is also lengthy only, that's actually big in terms of pages also, but that's not at all complex, very easy to understand. But this is complex, conceptual, lengthy, everything, and the stress that you require is very enormous generally. Okay? So I'm just telling you. So 530, 520, I'll make it very simple for you. When I'm discussing 530, 520, 450, 265, you will feel very convenient. You know what topics which is very challenging for me also to explain is 330, which is very challenging. 330, some points will be there, some 2 or 3 sub-concepts, only 2-3 sub-concepts are there. I mean, those 2-3 were extreme challenging. Internal controls are also challenging for me to explain. Rest all other very easy. This is something very difficult to comprehend. Like unless you see a real practical world, okay, you can't comprehend these controls. But still, I will take examples of metro station, all that, where I will take operating control help, not financial controls help, operating controls help. Okay, yes. Now, so whatever we do in audit, we call them as what? Audit procedures. Now, we all know there are various types of audit procedures, correct? What are various types of audit procedures that we have? Okay, risk assessment procedure and further audit procedure. Risk assessment procedures means the standard 315 talks about. Further audit procedure is what covered under 330. What is risk assessment procedure? Actual standard is what, identifying and understanding of entity. Identifying and understanding of entity and its environment. Actually, in between, risk of MMS is there. Identifying and identifying and assessing risk of material misstatement through understanding the entity and its environment. That's actual standard. But in a simplest way, you can understand this. Identifying and understanding, identifying of risk and understanding of the entity too. Identify and assess risk. Through, how did you identify the risk? How did you assess the risk? See, risk assessment has 2 steps. One is risk identification. Then only you can do assess it. First, you need to identify the risk, and then you can assess it. Assessing means you need to classify risk into 2 categories, high risk or low risk. Risk assessment is 2 types. Either is it a high risk or low risk. We generally, tell me, when do we require more evidence? When the risk is very high, we require more evidence. Or if I say in some organization risk is low, do I require more evidence for it? To prove it, more evidence is required. To prove it, evidence is required. How can I say risk is low? How can I say risk is low? I need evidence for that. Even to say that the risk is low, I need evidence for it. Here I'm not saying the quantum of evidence. See, when risk is high, you require more evidences. That there it is quantum. Where I need evidence. See, suppose in some organization, risk related evidence I'm talking. I'm not talking about the misstatement related evidence. Risk related evidence I'm talking. In some organization, sales are there. If I directly say risk is high, nobody will ask me any question. What is the proof? But if I say there is no risk there, how did you tell there is no risk? You understood now? So where evidence is required, when I categorize the risk as low, I need evidence. Further, if I categorize risk as high, and I want to know whether material misstatement there or not, for that reason, I do more testing. More number of evidences I will gather. So when the risk is high, more evidences I will obtain to avoid my audit risk, to reduce my audit risk. I'll tell you the relationship, I'll tell you as a whole. Okay, fine. Let me come back to this high, low, that point once again. I'll connect once we start. The very first topic is audit risk analysis. You see, the first topic, inherent risk, control risk, detection risk, some formula and all is there, yes or no? Yeah, that only we'll have to discuss first. Okay. So risk identification and assessment. How did you identify and assess? By the way, risk identifying and assessing risk, right? Risk means which risk? Risk of material misstatement. We are bothered about that risk only. We are bothered about financial statements materially misstated. What possibility is there? We are bothered about risk of MMS. Okay. So identifying and assessing risk of material misstatements through understanding the entity and its environment. So understand the entity and environment. Through that, you can identify the risk. Once you identify the risk, assess it. Is it a high risk, low risk? There are two types of risk I told previously also. I think we would have came across financial statement level risk, assertion level risk. Did we? Have we came across this? Okay. Risk that we assess, no, whatever the risk that we identify, no, we classify that into two levels: financial statement level risk, assertion level risk. Very simple. Fixed assets, immovable property is there. Original title deeds, no, it is not with the company, it is with the bank, and the bank is closed from past few days. Okay, for some internal issues were there. We are unable to obtain evidence also from the bank regarding some ownership documents that are there with the bank. Okay, ownership documents are there with the bank. We are unable to obtain evidence also for that. Now tell me here, entire financial statements affected or ownership of the immovable property is only affected? I'm not saying ownership is not there. Ownership assertion is affecting, right? That is assertion level risk. I want to verify inventory at a particular godown which is with the third party, and third party is not letting me. Third party saying, sir, we don't have any policy like this, we will not permit others. Client also, we don't permit. If you want, we'll return the goods. Client is saying, no, no, sir, the third party business process is very important. He need to do some process, only then I can sell the goods. Now, third evidence is not available on the third party inventory. Which evidence I'm not having? Which assertion? Assertion, which assertion? Inventory with third party? Existence. Main I'm worried about existence. So, no? Assertion level risk. This is also which level risk? Assertion level risk. Top management, finance director and CFO, they are fraudulent. They are very fraudulent. Like their intentions are not at all good. Now, which item in the balance sheet, which item in the P&L will affect? Overall, many will affect. Which risk is that? Exactly. That risk is called as financial statement level risk, which is also called as pervasive level risk. Rarely we identify this. You know, financial statement level risk is something that we don't find at all. Very extreme rare. In fact, at the time of accepting the client itself, we do one assessment. Engagement risk analysis we do. At the time of accepting the client itself, we do something called engagement risk. That is only we call it as acceptance and continuation of client relationship under 220 and SQC. That acceptance and continuation of client relationship, what we check it? With integrity of the principal owners, reputation of the client, key management, who are they? Our competence, ethical requirements, are we complying? This assessment is nothing but engagement risk. If client is not honest, if the top management is not honest, we would have not accepted the audit itself. So engagement risk analysis, we will try to identify financial statement level risks at the beginning itself. Well before we accept the audit itself, we will do that assessment. We don't even do this assessment after we accepted the audit, all that we do before accepting itself. So 99.99% we will not find financial statement level risk generally after we accept the audit. Most of the risks that we find are what? Assertion level risk. Sometimes multiple assertions together, like I found multiple assertion risks. Investments, I'm worried about valuation. Inventory, I'm worried about existence. Fixed assets, I'm worried about rights and obligation. Multiple assertion level risks I found. Sometimes all of them combine themselves into financial statement level risk also. So very rare after we accept the audit, financial statement level risk that we rarely find. So once you identify the risk, you need to categorize the risk into these parts. Are you clear? Next. Then, you know, even in many companies, no, they divide. I mean, many audit firms, big four firms and all, no. Suppose if you take KPMG and all, they have risk assessment into three levels: low risk, elevated risk, significant risk. Again, risk is again three levels: low risk, significant. This is what we have in our risk. Low risk, high risk. Generally, when there is a high risk, no, most of that high risk is nothing but elevated level risk, or we can also call it as high risk. Sometimes this high risk may be classified as a significant risk. Simple example. Suppose 1 lakh cash shortage is there. 1 lakh cash shortage is there. One of the reason why shortage is there is intentionally fraud is there. Another reason might be error. Records only wrongly containing. One scenario is books of accounts are wrongly recorded with some entry. It's a wrong posting. Another one is books were correct. Cashier stolen the money. Between these two risks, which is significant? Between these two risks, which is significant? One is theft risk. Another one is, in a books, error risk is there. Which is significant? Theft risk. Risk of fraud is always significant. Correct? Transactions with related party, low risk, high risk. Exactly. Why? Through related parties, we have seen in 550 standard, there is a possibility that company can enter into a complex transaction and may manipulate the picture. Yes or no? That's it. So in this chapter, we are going to learn in very first topic and third topic or second topic, understanding. Okay, we are going to learn about this risk assessment only. Ultimately, whatever we do in audit, in order to reduce audit risk, in order to reduce whatever we do in audit, the purpose of this audit procedure, everything that we do in a client, right? Risk assessment, risk identification, all that is to reduce audit risk. Okay, now before I discuss about audit risk, okay, you have done some risk assessment for a company, you identified some risk, you assessed some risk. What you will do based on the risk? Okay, you did risk assess. What you will do then? You need to design and implement further audit procedure. This is your response to the assessed risk. This is the response to the risk which you assessed. Risk which I assess, how will I respond? By planning my further audit procedure. That by 330 standard heading, you see response to assessed risk. Response to assessed risk. Like in 315, I identify and I assess the risk. Assessment level only discussed under 315. Okay, you assessed it. What you will do now? I will respond. How will I respond? By designing and implementing audit procedures, further audit procedures, planned further audit procedures. Remember, audit plan. Remember in previously one topic, audit plan. Audit plan will contain planned risk assessment procedure, planned further audit procedure. Some of the procedures may be performed at the beginning itself. Slowly, the plan will be developed over a period of time. Remember that points and all? Yes. Now, audit plan will be developed. Audit strategy can be developed only after we understand risk assessment correctly for a particular organization. Then we will develop the plan. We will inside that risk assessment point we will mention we completed or it's in progress we will mention. But a strategy can be established. An audit plan can be established only after we do a thorough risk assessment. Then only I will understand how should I do the audit, where I should give more attention, where I should give less attention. Correct? So 315 risk identification and assessment, 330 response to the risk. Risk assessment procedure is 315. Further audit procedures are 330. Again, these further audit procedures are two types: compliance procedure, substantive procedure. Compliance procedure is called as test of control. Substantive procedures is again subdivided into two types: test of details, substantive analytical procedure. Sometimes in exam they will use here substantive procedure is the right. Sometimes they will use in questions and all substantive audit procedure. Substantive audit procedure is nothing but substantive procedures. Substantive analytical procedure is different. Can I use the word substantive audit procedure, substantive analytical interchangeably? No. Substantive analytical procedure is one type of substantive audit procedure. But substantive audit procedure also includes test of details. Okay, fine. This introduction you keep in your mind in this chapter. Okay, now let's begin our analysis audit risk. Now let's begin our analysis audit risk directly. So first thing that we are going to discuss is audit risk. What is an audit risk? Very simple. when the financial statements are materially misstated. Look at the condition. When the financial statements are materially misstated, the risk of expressing an inappropriate opinion. If the auditor is giving inappropriate opinion, I think I would have told sometime earlier. Yes or no? If auditor gave inappropriate opinion on the financial statements which are materially misstated, that's audit risk. Exclusion, you see, audit risk does not include expressing modified opinion when financials are not materially misstated. This also I told. Tell me which is more risky for an auditor. Financial statements are absolutely wrong. They're not at all reliable. But you gave a report that it is true and fair. Public trusted your opinion and invested in the shares of the company. Later they lost their money. This is case number 1. Case number 2. Financials are good only. You are very conservative. This auditor is very conservative. He gave adverse opinion. Don't believe the financials. In spite of it, people invested. They lost money. Later on, they lost money. In case number 1, people will question me, or case number 2, they will question me. 1. In case 2, I already said they're not true and fair. You invested. What can I do? Whereas in case number 1, I gave a confidence that everything is good. Everybody will start questioning me. Why, what are you doing? The company, so many frauds and all were there. You gave positive opinion. We trusted on you. Yes or no? That's why when financials are not materially misstated, you are giving a modified opinion on that. Suppose I said adverse opinion, but actually they're not misstated. Okay, they're true and fair. Financials are true and fair. But because of my conservative attitude, I said not good. This is not a risk for me. This is not a risk for me. See, I am giving adverse opinion. I have reason. I have explained my reason clearly also in basis for adverse opinion. What pervasive fraud I found. Pervasive level mistakes, whatever I found, I clearly expressed in basis for adverse opinion section clearly. People's choice whether they will believe it or not. This is not a risk for me. But the point is, when financial statements are materially misstated, where adverse opinion is required, or a qualified opinion is required, I inappropriately gave unqualified opinion. I inappropriately gave which opinion? Unqualified. Which means when you are giving unqualified opinion, there is a risk. Audit risk is a risk of giving unqualified opinion. That's it. Simple. What is audit risk? It's a risk of giving unqualified opinion on the financial statements which might be materially misstated. There might be a chance of material misstatement, yes or no? That is audit risk. Sometimes audit risk can also include risk of giving qualified opinion where adverse opinion is suitable. That also we can interpret. This point can be interpreted in that context also. Because unqualified, qualified, more or less same. Not a big deal. Qualified opinion, is it a big deal for any company? Not at all. But adverse is a very big issue on the company. Now, so for example, expressing unmodified opinion when a modified opinion is required. A qualified or disclaimer or adverse where that opinion is required, you are giving unmodified opinion, clean opinion you are giving. That is the more risk. That is major risk. Consequences. What will happen because of audit risk? Your reputation will damage. Some regulatory action and all might be there. Why you gave unqualified? People will come and inquire you. And risk of legal action by third parties, users of the financial statements. Possibility is there. That's why if at all you do audit properly, see, definitely even though after you do audit properly, some risk will be there. No doubt about it. That's why you need to maintain documentation. Suppose you gave unqualified opinion. Very big frauds and all were discovered after 4 years. And those frauds happened in the year for which you gave the opinion. How come you are responsible? They can't straight away. See, first they will come and inquire you. If at all you gave adverse opinion already, you are free. Nobody will question you. Since you gave unqualified, people will come and question, why did you not found it? They will look at your audit process. How did you perform the audit? They will only see one point. Have you performed audit as per standards on auditing? Yeah, you performed as per standards on auditing. In spite of it, you are unable to discover the fraud. You have done your duty correctly. Nobody can touch you. That's why we have to maintain documentation. That's why you need to perform audit as per standards on auditing. You should develop checklist. You should develop quality control policies. Perform audit as per standards correctly. Enough. Maintain pakka documentation. What, even company might liquidate tomorrow. Company completely got liquidated tomorrow. It doesn't matter. As long as you have documentation solidly with you, nobody can touch you. That's why we need documentation. Are you getting the point? No, that's it. So this is audit risk. So example, artificially increased profits through fake revenues can increase audit risk. Business risk such as litigation, publicity, auditor losing reputation. This is not audit risk. This is auditor's risk. Correct? This is not audit risk. Audit means what? On a client, on a particular financials, I'm giving an audit report, right? That opinion related risk is called audit risk. Audit risk deals about the report. Auditor's risk is different. Understood? Now, why audit risk arises? What is the reason why audit risk is arising? Very simple. Financial statements are materially misstated. There is a risk. There is a risk that financial statements are materially misstated, and there is a risk that I will not detect. Detection risk means what? Risk of not detecting. If I'm able to detect everything, is there any risk? The point is I'm unable to detect. Mistakes are there. I'm unable to detect. Possibility that financial statements are materially misstated, and that misstatement possibly I can't discover. Because of these two risks only, I have an audit risk issue. Mistakes might be there. I might not discover them. Without discovering them, I will give unqualified opinion, and this opinion tomorrow might go wrong. That's an audit risk. Easy. So audit risk is a function of risk of MMS into detection risk. What is risk of MMS? Risk of MMS is a risk that financial statements are materially misstated prior to audit. Obviously, forget about audit. Possibility that financial statements are materially misstated. This risk is because of auditor management. Exactly. Risk of MMS is entity's risk. It's a risk because of the entity. It's a risk because of the organization. Whereas detection risk is in the auditors. But remember, detection risk is not only influenced by auditor, it also influenced by management. What if they all colluded? Third party, company, legal authorities, lawyer, everybody colluded and misrepresented me. Detection risk. So detection risk is not only auditor's control, it's also influenced by third parties. So what are the examples of misstatements? Remember, in previously one question bank in items of financials, in one of the question we saw examples of misstatements. Here only, charging capital expenditure revenue, incorrect disclosure of financial statements, applying wrong accounting policy, errors in accounting estimate, fake expenses, misstating inventory, overstating receivables. All these are examples of various misstatement. In exam they'll ask you what is risk of MMS and give you examples. Now levels. The risk of MMS, the risk of material misstatement, risk of RMMS, risk of material misstatement. This risk of MMS is categorized at how many levels? 2. Assertion level. It is a risk for a specific class of transaction or a specific account balance or a specific disclosure which might affect nature, timing, extent of audit procedure. Suppose if I know that inventory lying with the third party, I have to plan my audit accordingly. That will affect my audit procedure. So assertion level risks, I can address them easily as part of my audit. So I can develop I can do some separate nature of procedure for that, extent, timing. I can plan nature, timing, extent for addressing assertion level risk, no problem. Financial statement level, these are pervasive risks. What are they? Pervasive risks which are affecting financial statements as a whole. Now, what are components of risk of MMS? Now, okay, risk of MMS means we understood. Now, why risk of MMS might exist? That's inherent in the business. Agreed? In a business, employees and all will do. So many thousands of people are working. Obviously, there is a risk that some error, some fraud might be there. That's an inherent risk. Inherent means what? It's in the system. By default, inherently, books of accounts will be 100% accurate, or will they contain mistakes by default? They contain mistakes, pakka, because many are involved. Many employees are involved. That's inherent risk. What is it called as actually? Inherent. What is inherent? The possibility that an assertion, yes or no, the possibility of an assertion to a material misstatement. The possibility of an assertion, susceptibility means possibility. Susceptibility of an assertion to MMS. One transaction you take, suppose no, a company has to purchase goods. There might be a possibilities. Vendor might be fictitious. See, suppose a company purchased goods, some invoice is there. One invoice is there, 10 lakhs. What is the risk here I have? No, according to me, in this, what could be the risk? Either this entire transaction is fake. That is one possibility. Two, or the quantity might not be this much. The purchase invoice has 100, but in reality they might have received less than 100. Or the price might not be this much. They paid 10 lakhs, but it might be only 8 lakhs. Yes or no? Or goods received from the vendor. Okay, that's it. These are the three major risks. Now tell me, these risks will be there whether we do audit or not, correct? Whether we do audit or not in a company, employees will do fraud only when auditor will do audit. A person will do fraud irrespective of audit. If audit is there, they might control little bit. But fraud is something in a company, a fraud, error are possible whether audit is there or not, correct? Possibility. So susceptibility of an assertion to a material misstatement. You see one wording here, before considering related control. Tell me, primarily, who should do risk assessment? Primary responsibility management. Forget about auditor. They are responsible to protect their assets. They tell me at the end of the day, if this campus, no gates, the doors and all were not closed, security guard is not there, nobody is there. Yes or no? What is the risk here? Somebody might come and take some assets and then steal, theft. Now this is inherent risk. In any business process you take, that's an inherent risk. Now to address this inherent risk, organizations generally implement controls. What controls here they implemented? Security guard is there, some locking mechanism is there, CCTV cameras were there. These are all controls. So before considering, forget about controls first, what risks are there? That is inherent risk. To address these risks, companies incorporate controls. Control is nothing but a process. It's nothing but a policy. Control is not something there in organization. In your home also controls are there. When you're going for vacation, don't you lock the home? That's an internal control. That's a control only. Are you getting it? So if you do not lock the home, what will happen? There is a possibility of theft of assets. Exactly, that's inherent risk. What is inherent risk? Possibility of errors, possibility of fraud, possibility of theft. That's an inherent risk. To prevent this, what are you doing? Implementing some control. What if the control fails? What if sometimes control might fail? What if security guard went for chai, coffee, something? What if? That's a control risk. That time if at all somebody intruded. Are you getting it? Control risk. Control risk means what? It is a risk that, control risk is a risk that a material misstatement, by the way, misstatement will come either because of fraud or error. We know a misstatement in an assertion will not be prevented, will not be detected, will not be corrected on a timely basis by internal control. The risk that MMS in an assertion will not be prevented, detected, corrected, nothing but a risk that a fraud cannot be prevented by a control. A fraud cannot be detected by a control. A fraud cannot be corrected by a control. That risk is called as what? Control risk. Controls are three types: preventive control, detective control, corrective control. CCTV cameras, they prevent frauds. Yes or no? Top management supervision might prevent employees to commit fraud. Able to understand? So internal audit, that's also a type of control, technically speaking, that will prevent employees from committing fraud. Able to understand? So now, why someone asks you, why risk of MMS is there in financials? Why mistakes will happen in financials? Mistakes will happen because of either frauds and, okay, that is inherent. In every transaction, inherent risk is there. Okay, in order not to bring an error, in order to protect from errors and frauds, what companies doing? They implemented automation, they implemented controls, they implemented rules, they implemented regulations, they train people. These are controls. What if the control fails? Again mistake will happen. Again mistake will happen. If control failed, automatically mistake will happen. What if that mistake is not discovered by auditor? Auditor might give a wrong opinion on financial statements. Therefore, risk of expressing inappropriate opinion on the financial statements is a result of risk of MMS and detection. Why misstatements is possible in financials? By default, mistakes are possible. Controls are not there to prevent it, or controls are there but not effective. So audit risk is formula based. What is audit risk? Audit risk is equal to risk of MMS multiplied by detection risk. Risk of MMS is equal to inherent risk multiplied by control risk. Able to understand? Easy or not? That's it. So what are the components of audit risk? Risk of MMS is one component. Yes or no? And these risks are, what is component of risk of MMS? Risk of MMS consists of what again? Inherent risk and control risk. These risks are entities risk, correct? And these will exist irrespective of audit. Auditor will not control it, correct? Next, inherent risk. What is inherent risk? It is a risk that it is a possibility that an assertion about a class of transaction, account balance, or disclosure to a material misstatement before considering related controls. Characteristics. These risks are something which exist before considering internal control. So every company voluntarily has to do inherent risk analysis in every transaction. Okay, how should we do purchases? Where and all things can go wrong? How we should sell? How frauds can happen in sales? How frauds can happen in employee benefits? How frauds can happen in inventory? How frauds can happen in fixed assets? The company has to do an inherent risk assessment in depth. Then identify where and all risk spots. Put control. Some control you put. Able to understand? So this risk is, inherent risk is higher for complex calculations, or this risk is higher when influenced by external circumstances like technological obsolescence, all that. So what are the influencing factors for these risks? Business risks, external factors, entity specific factors. The risk of MMS is because of two reasons. One is external factor, or sometimes it is internal factors, specific factors. Entity specific means our internal. Sometimes it might be internal. It is only specific to our organization. These risks are, for example, complex accounting standard is there. Management misunderstood them. They misinterpreted and then passed some journal entry wrongly. Business risk, like technological, all this technological risk, advancement risk, obsolescence risk, competition. These are all external risks. So inherent risk varies across assertion transaction, correct? Will inherent risk be same in every transaction? It will be different for purchases, different for sales, different for various assertions, correct? Again, inherent risk for existence. Yes or no? Physically, I don't have any problem. Physically, it will be there, I know. What about ownership? Inherent risk for existence might be low. Inherent risk for ownership might be high. Inherent risk for valuation might be high. Fixed assets, no? Which risk is high, valuation risk is high, not existence risk. Even ownership risk is also low only. Title deeds are there, everything is there. So existence risk is low, rights and obligation risk is low, valuation risk is high. So inherent risk varies across assertions, transactions, balances. So auditor designs test of controls, substantive procedures considering inherent risk. So we generally do audit based on inherent risk. What are all possible? When we are doing audit, we do something called walkthrough test. How organization purchases goods, what process exactly they follow, who are all involved: purchase manager, stores manager, accounts manager, finance manager, CFO, how many inventory manager, store record keeper, security entry gate, factory gate entry, inward outward, so many controls and all. I will first study the entire system and I will try to find out where frauds can happen, where things can go wrong, where errors can happen. I will see, computer SAP system, I will see, like software, I will see how the software is capturing all these events. I will try to identify the system. First I will try to identify what can go wrong. Then what I will do, what controls company implemented. I will verify. First I will list out inherent risks. Then I will apply, I will then check out what controls the company implemented. Whether this risk is mitigated or not, I will see. If not mitigated, I will classify finally risk assessment as high or low. Based on control understanding, based on control implemented by the organization, I will classify my assessment as high or low. Based on my assessment, I will design my further audit procedure. This is how the system works. First we identify risk and then we compare it with the control and we develop something like one Excel sheet like this. That is called risk control matrix. What is it called as? Risk control matrix. Did I show any risk control matrix? Not. I will show you now. Risk control matrix I will show you. Yeah. You see, this is one risk control matrix. This is one risk control matrix. What is this here? This is regarding procurements to payments. The company is purchasing goods. Right from procuring the goods till they make payment. What process they follow? You see, PP, procurement to payment. Okay, first risk ID. We are giving IDs for every risk. In a company, for purchases, I asked management, do you have a procedure for purchases? Company said, yes, sir, we follow procedure. Where is the manual? Show me. Absent. Absence of manual. Okay, absence of SOP. Like how exactly they purchase. There is no SOP manual. Okay, so SOPs. So that is one risk. Absence of SOP is one risk. But you know what the company told? Sir, don't worry, sir. The vice president has made, SOPs are designed. Oh, since SOPs are designed, is there any risk here? No risk. Control, key control is no. This is a preventive risk. This is a preventive control. You see, what are we identifying? First, we are identifying what can go wrong. Then we are asking the organization to address this risk. What procedure you implemented? Now see, for example, in a simple way you can understand, sir, every month you are paying salary. Did you consider leaves of the employee while paying salary? I ask. Yes, sir, obviously we will consider leaves. Is there any record of leave? No record is there. Then how do you think that salary correctly processed? Sir, we have an account attendance system. See, what is the risk in salary, monthly salary? There is a risk that an employee who left the organization might be paid salary. Second risk, there is a risk that an employee who has taken so many leaves but still full salary is paid. That is another risk. For that risk, what control company implemented? Attendance record. Able to understand? Like that only here also. So like that, I will try to identify various types of risks and what control or process or procedure company followed there. I will ask them. If a proper procedure, policy, process, something is there, that's called control. Now risk I am listing, risk I am listing, control I am listing. Risk control matrix. Able to understand? So this we will develop first. Then we will do test these controls. Companies have controls, right? These controls we will test whether they are working effectively or not. That is test of control. And we will take some actual transactions and then verify whether these and all reflecting on real transaction or not. That is substantive procedure. Able to understand? This level of understanding is sufficient, okay, for our discussion. Enough. Look at. So what are the examples of inherent risk? Complex accounting standard which is misunderstood by the entity, leading to potential misstatement. Business failures because of the high competition, all that and all. These are all inherent risks. Understood? In exam they might ask you, straight away in exam they might ask you, why write about inherent risk? What are the characteristics of inherent risk with examples? You have to write the entire answer. Characteristics are what? These risks exist before considering controls. This is higher for complex calculations, especially when influenced by external circumstances like business risks, all the technological risks, all that. Entity specific risks also might be there. Complex accounting standard, they might ask you MCQ also. They'll give you one example. Is it an entity specific risk? External risk? They'll ask you like this also. And assessment, inherent risk, the inherent risk is different for various assertions, for various transactions. So auditor will design controls, test of control, substantive, considering various inherent risks. That's it. Control risk. What is a control risk? Control risk is something that reflects inefficiency of internal control system. Yes or no? Higher control risk indicates weaker controls. If controls are weak means that's a higher control risk. Now examples, cash and checkbook control not followed, increased risk. Employee attendance records are not correctly maintained, that's a risk. Fire safety controls not there, petty cash controls breached, employee attendance records not maintained. These are all what we call them as control risks. Next, detection. What is detection risk? It is a risk that Audit procedures performed by the auditor, you did verification all that, right? Will not detect. Even though you verified, you won't find a material misstatement that exists. Okay, either that is individually material, or when aggregated with others also it is material. So there it is a risk that audit procedures performed will not detect a misstatement which is material either individually or aggregate. Even after using specific audit, there is a risk of undetected MMS. So now again, no, why detection risk? This is two reasons. One reason is sampling risk. Another reason is non-sampling risk. Another reason is non-sampling risk. One reason for detection risk is sampling risk. Another reason for detection risk is non-sampling risk. What is a sampling risk? Sometimes, no, actually, no, many purchase transactions fraud. If at all I get that one transaction also in my hand, no, I can see and tell immediately the fraud. But the point is, in my sample, they were not covered. I selected transactions based on sample, right? I found I selected 100 transactions. In all the 100 transactions are genuine only. They're not fraudulent. This is one risk, where the possibility that your sample might not contain a fraudulent transaction. That is called as sampling risk. Why sampling risk arises? We will discuss in 530 standard. Audit sampling. 530 standard heading is what? Audit sampling. There we will discuss. So sampling risk, it is a risk that auditor's conclusion based on sample will be different when the entire population is tested. Nothing but, if at all I verify entire purchases, no, I would have easily found out all the frauds and I would have not given unqualified opinion. My conclusion is absolutely like materially misstated. But I verified sample. I thought everything is good. So my conclusions based on sample, they will be different from conclusions based on the entire population if at all I test it. If at all this risk is there, then that is sampling risk. Whether I verify 100 or I verify all the 10,000 also, my answer is going to be same. Which means sampling risk is there or not there? Exactly. Sampling risk will not be there. So it is a risk that auditor's conclusion based on sample will be different from conclusions if entire population were tested. So that risk, it occurs when sample is not representative of population. That's why we generally follow stratified sampling approach, so that we can select a sample from all parts of the population. Okay, what is stratified sampling? We'll discuss in sampling topic. Okay, so that's it. So this is sampling risk. Apart from that, there is another risk called non-sampling. Sometimes, no, see, why I have not found errors, why I did not find mistakes. Reason one reason is sample reason. Another reason, I misinterpreted. That's my personal. Sample correctly came. Even many fraud related transactions were there in my sample, but I couldn't identify them as fraud. I took wrong judgment. It is a risk that auditor reaches an erroneous conclusion for reasons unrelated to sampling. Not because of sampling. For some other reason, you took a wrong conclusion. Because of that, you did not find a fraud. Because of that, you did not find a material misstatement. That's a non-sampling risk. This risk will arise due to inappropriate audit procedures or errors in application of audit procedure. Either you are applying wrong audit procedure or you are choosing some inappropriate procedure. Example, auditor did not attend inventory count of work in progress but relies upon some working documents and all were there. I just rely upon documents and signed the financials. This is sampling risk or non-sampling risk or non-sampling. You did not apply correct procedure. That's the reason. Other, if at all you visited work in progress location, you would have found out some fraud easily. This is non-sampling risk. Understood? Now tell me, detection risk, to some extent, auditor can control. Yes or no? Detection risk is the only component of audit risk which is in the control of the auditor. Reducing detection risk helps in keeping overall audit risk at low level. If at all detection risk is low, detection risk low means what? Wherever mistakes were there, I will easily find out. Audit risk will reduce. If I find more mistakes, obviously what opinion I'll give? Adverse opinion. If I'm giving adverse opinion, my audit risk will naturally reduce. So how to reduce detection risk? Very simple. Check broader scope of transaction. Use larger sample size. Use experienced and competent staff members in your team. So cover in depth. Use competent people. They will find out many frauds and errors. That's how you can reduce detection risk. That's it. Are you clear? Now, by the way, tell me, right now I told, right, risk assessment, high risk, low risk, all that. For some auditors, a particular scenario might appear risky. For some auditors, it might not appear risky. Correct? Risk assessment is a matter of judgment. Agreed? Assessment of risk is a matter of professional judgment. Audit risk is a function of risk of MMS and detection risk, that we know. Assessment of risk is based on audit procedures to obtain information and evidence throughout the audit. The assessment of risks involves professional judgment, rather a matter which is not capable of precise measurement. You can't measure the risk 100%. Oh, yes or no? Assessment of risks involves professional judgment, rather a matter capable of precise measurement. You can actually ignore the word not. You'll get the same meaning. Risk, can I measure it 100% precisely? You can't. Rather, what you can do, I can judge it. That's what the meaning. You can eliminate the word not, or you can keep the word not also. It won't much. It's just a sounding which is important. Assessment of risk is a matter of professional judgment, rather a matter that is capable of precise measurement. Rather means what? You can't do that. That's what the meaning. Are you clear? All of you? So professional judgment is exercised by auditor by training, knowledge. How did auditor judge risk is there or not? Through his experience, through the training. He know auditing standards, all that. He know how to do this risk assessment. So no, to develop competencies so that he will take a judgment which is reasonable. So that he will take some reasonable judgment, competent judgment. So no. Next, obviously, tell me, auditor will do combined assessment of risk MMS. The auditor may assess inherent risk and control risk separately or combine them. Generally, we combine them. See, either you can do it separately or you can combine them based on preferred techniques, methodologies, and practicalities. This standard do not refer them separately. Basically, in this standard, we don't address inherent risk separately, control risk separately. We only tell them, the standard is only telling about why risk of MS arises. That's it. Only for that reason, inherent control risk and all came. Generally, in the standard, they only refer risk of MMS, combined risk assessment only they talk about. Auditor has to identify and assess risk of MMS. That's the standard heading. Why risk of MMS exists? Because if you ask me, then detailed breakup I showed you. So this standard does not refer inherent risk, control risk separately. We combine. The standard combines both of them and then address it. Risk may be expressed sometimes in quantitative terms. Generally, we can't explain in quantitative terms. Can we explain in qualitative terms? Yes. High, medium, low. Then importance. Whatever the approach of audit you're following, making appropriate risk assessment is crucial so that you can plan the audit perfectly. Easy until now? Next. Is there a relationship between these components? Yes. Inverse relationship. There are only two components as per the standard technically. Risk of MMS, detection risk. The relationship is inverse. If risk of MMS is very high according to auditor, definitely he will perform more in-depth audit procedures. Experienced people he will use. Naturally he will discover more frauds and errors. Detection risk will reduce. Correct? So higher the risk of MMS, the auditor will conduct more in-depth audit, reducing the detection risk. Same way, if auditor identify low risk, which will allow less audit procedure, leading to higher detection risk. So your risk assessment must be correctly done. Your judgment must be correct. If at all you think low risk, generally you also what you will do, you will not do audit so depth. Basically, at the time, what will happen? You will not discover many frauds, if at all there. Where it lead to ultimately audit risk. Are you getting it? Everybody? That's it. So interrelationship. So in exam they might ask you interrelationship 0.3 marks. Write about combined assessment of risk and interrelationship. These two can be asked 3 marks plus 2 marks. Understood? And already identified assessment of risk. We identify risks at 2 levels: financial statement level, assertion level. Then analyze the risk to determine its significance. Is it high risk or low risk? So ultimately, Reduce the risk to an acceptably low level. How will you reduce the overall audit risk? By planning and performing audit procedure suitable to the risk assessment process. Based on the risk assessment, I will design and plan further audit procedure. Then I will. Some inventory lying with the third party, I got to know in the company. Through risk assessment, I got to know third party inventory is there. What is my response here? What is my further audit procedure? I want confirmation from third party. He gave confirmation. My risk is reduced. Are you getting it? That's it. Clear or not? That's it. So, what is the concept of risk assessment procedure? What exactly risk assessment procedure includes? This we will discuss after 10 minutes gap. Yes. Easy. Not so complicated, right? Mostly, I can say 70-80% of this top, 70% of this topic is like this only. Not complicated. Easy only. You can comprehend better. Some 25 to 30% is bit tough. Okay. That's it. Yeah. We'll continue after a small break. Now let's understand what is the concept of risk assessment procedure. What is the concept? So, as I already told, what is the risk assessment procedure? Concept is what? To identify and assess risk of MMS at financial statement level and assertion level. Correct? So risk assessment procedures are basically their audit procedures. They are also examination only. Only when you go and verify the entity only you will understand risk. So risk assessment procedures are audit procedures which are performed to understand the entity and its environment, including internal control. I want to understand what organization it is, what environment it is, what controls they have. By understanding the entity and environment and organization controls, I will do identify and assess risk, and I categorize them at two levels. Assertion level and financial statement level. Purpose: it provides a basis for identifying and assessing risk. Risk assessment alone does not provide, obviously. Suppose I did risk assessment, I found where and all risk is there, where and all not risk, where and all there is no risk. Can I directly go and give opinion on the financial statements? Yes, they are free from MMS. Risk is only indicator. You don't know whether real mistake is there or not. If you want to know whether a real mistake is there or not, you need to verify the transactions. Thoroughly verify the transactions. Try to identify what are all mistakes are there. If nothing is there, then you can give unqualified opinion. So risk assessment alone do not provide sufficient appropriate evidence. Further, assess whether the risk identified are pervasive. Most important, impacting financial statements at a broader level. This is a common requirement, no? Yes. And relate the risk to what can go wrong at assertion level. For example, company is not maintaining attendance records. What can go wrong because of this? Employees' salary amount will be paid higher. Because of this, profit of the company will reduce. This is one risk. Yes or no? Suppose company inventory records are not maintained. There is a risk that closing stock value might go wrong. Valuation is. So, assess the risk with respect to, relate the risk to what can go wrong at assertion level, considering relevant controls that the auditor intends to test. So, what can go wrong? Okay, inventory records are not maintained, valuation might go wrong. So, here what should I test? I should plan physical verification, identify how much stock is there, then I must do valuation correctly. So, I should focus on addressing valuation assertion. So, I need to test relevant controls. First, identify what can go wrong. See, in inventory, what can go wrong? Inventory valuation might be wrong. Why? Inventory might be overvalued or undervalued. For that, what I want to look at, see whether records are maintained. Physical verification, I'll go and see. Existence, I'll see. Are you getting it? Next. Consider likelihood and magnitude. Generally, whenever you find any risk, there is no risk is there. There is no guarantee that will always turn into reality. Identify the likelihood. Just because the risk is there, identify the likelihood. Likelihood of misstatements depends upon the controls implemented. Likelihood depends upon what? Controls implemented. Suppose inventory, is there a possibility of theft? In inventory, what risk is there? The risk is overvaluation, undervaluation. Overvaluation, when inventory will be overvalued when NRV is not considered. If NRV is low, cost only the company is valuing the inventory at, then there is a risk. Suppose company has a team, okay, accounting team, in that one person is dealing with only inventory valuation. He will always calculate NRVs and all, that control is there. The company has a proper person, dedicated team, system and all is there. Now tell me, inventory, the risk is wrong valuation. Control is there. Is the likelihood low or not? Exactly. And consider the likelihood of misstatement, including potential, including potential for multiple misstatements. Consider the likelihood of the risk. See whether this risk will impact multiple assertions, check out multiple items. Also, not only likelihood, check its magnitude. Financial statement level risk will have a higher magnitude. Every item will affect. Assertion level risk might have only impact on that assertion. Yes or no? Magnitude of the misstatement that could result in misstatement. So what auditor has to evaluate? Likelihood and magnitude. Likelihood means will it occur or not occur? What is the probability of occurrence? If probability of occurrence is very high, I will pakka verify that in my further audit procedure. Then magnitude, if magnitude is high, likelihood is high, if both are high, I may classify this as a significant risk also. Then, so information from risk assessment can be used as an evidence for assessing the risk, gaining an evidence for obtaining evidence. Gaining means nothing but obtaining evidence for transactions, understanding about the effectiveness of controls. When you understand, when I identify and assess the risk, first thing I will understand about its level assessment. Then I will get evidence for transactions balances. I will also get evidence regarding controls effectiveness. Sometimes substantive procedures and compliance procedures are performed concurrently. Remember, I told you we don't perform separately. So what aspect I am verifying? So that itself is a compliance procedure, that itself is a substantive. In reality, we take 100 samples, we see controls, we see actually how it is recorded, everything we will see. So compliance and substantive, we perform both directly together. Getting it? We don't perform, we combinedly perform. We don't perform separately compliance, we don't perform separately substantive. Able to understand that? So use information as audit evidence. Information from risk assessment can serve as an evidence for assessing the risk, can serve as an evidence for obtaining audit evidence on transaction, can serve as an evidence of understanding of controls effectiveness. So substantive and test of controls both are performed sometimes simultaneously, concurrently. Understood all of you? So write about the concept of risk assessment, 5 marks question. Concept of risk assessment, 5 marks question. Then assessment of risk is a matter of professional judgment, G concept, 4 marks question. Assessment of risk is a matter of professional judgment, 4 marks question. Then write about detection risk, 4 marks questions right away. Then for inherent risk I already told. Okay, components of audit risk, 5 marks question. They will ask you like what is audit risk and what are its components, both put together 5 marks. What is the meaning of audit risk and what are the components of audit risk, both put together, a 5 marks question. Next, risk assessment procedure includes what and all? Inquiries of management and others. What exactly in risk assessment we do? How do I identify risk? Tell me. By talking to people. I'll talk to people, I'll observe what they're doing, I'll inspect records, I will apply analytical procedure, and I'll try to figure out where and all things can go wrong. So inquiries, one of the risk assessment. Analytical, another way of doing identifying risk. Observation is another way. I'll go to factory, I'll try to observe where and all frauds can happen. I'll go inventory, warehouse, I'll observe where things can go wrong. I'll talk to people and get to know how the business is happening. Through that information, I will figure out what can go wrong. Inquiry, observation, inspection, analytical procedure, all the three are what? Risk assessment procedure. Now look at. So inquiries, what I will inquire? Risk assessment procedure includes this. Concept of risk assessment procedure, the above one. Be careful. Risk assessment procedure includes what and all? Inquiries of management. This itself can be asked as a 4 marks question separately. Risk assessment procedure includes inquiring of management and others, like inquiries with management, top management, other employees. Why am I inquiring them? Inquiry means nothing but interacting with them, talking to them, asking them questions. They will be replying you to identify risk of MS, such as with the top management. Inquire those charged with the governance to understand environment of the entity, financial statements preparation. How is this company? What company it is? What framework is applicable? Okay, what is the risk involved in the framework? Talk to internal audit team to get information on internal control procedures and management response findings. Internal auditors have done in-depth audit. Ask them how their queries and all management responded. Did they responded internal auditor correctly? Ask them. Inquire with employees to know accounting policies are appropriate or not. Probably here employee means accountant. Okay. Inquire with legal counsel, lawyers, to get information on pending litigations, compliances, suspected frauds, warranties, business combinations and arrangements. Inquire with marketing and sales people to know what marketing strategies companies implementing, to know going concern, to know company's reputation in the market, sales trends, customer contracts. Inquire risk management function. Some listed companies will have risk management team itself will be there. I ask them informational operations and regulatory risk affecting financial reporting. Ask them what are the risks that they found, operating risk what they found, regulatory risk what they found. Inquire tech people. Identify system changes failure. This company is maintaining everything automated. Tech, complete ERP they are maintaining. So ask the tech people to know what changes they made to the system. How does these system changes will impact financial reporting, books of accounts? You need to inquire so many people. Any five. So they will ask you a question like this. Risk assessment, one of the important activity in obtaining information about, in identifying risk and assessing the risk, is inquiring with entities personnel and others. Inquiry with management and others. Others means what? Legal counsel, yes or no? Others means internal auditors, like that, yes or no? Governance also others only. Remaining all other might come under employees. Able to understand? Whoever it is. So comment, describe. You need to write any 5 points. Are you clear? Next. Another way I will identify risk is what? Observation and inspection. Observe operations, production, warehouse. Observe how accountant is working, cashier how they're working. Inspect documents, standard operating procedures. See whether the company has implemented SOPs and all. Review management reports. Observe client premises. So observation or inspection, that is also important for understanding the entity and its environment. Tell me, is it something because they say observe, you are going and observing? Whatever we do only, they are naming it here. Yes or no? How do I learn about a company? Tell me, how will I get to know about the company? I'll ask them. I'll observe what they're doing. I'll think. I'll apply my brain. Applying brain only analytical procedure. Correct? Huh? Yeah. Next. Analytical procedure. What is analytical procedure? Where I analyze financial and non-financial information. Analytical procedure consists of analysis of financial and non-financial. I mean everything. I analyze everything. That's what the meaning. Whatever everything is divided into financial and non-financial. Suppose last year to this year employees increased. Why sales does not increase? In a particular month, power consumption is extremely 3-4 times higher than normal month. In that month, why production does not increase? Is there any, like, probably my doubt is production records are suppressed. Some contract company took out of the books of accounts, in the sense they produced goods by using the machinery. Production manager and all using the company machinery. He performed one personal contract. For that, power bill company paid. That's not company business at all. Production manager has some private company, and that company got some contract. So that goods and all manufactured using our company resources. That's the reason power bill is very high. Able to understand? That's the reason. So this fraud and all, you will discuss these kinds of frauds and all will be there. Suppose marketing people, you give them money for their reimbursement of vehicle charges, all that. They use extensive expenses. They claim reimbursement, all that. Where is the business? Nothing is there. Then why, where and all you roamed? Personal expenses might be there. Able to understand that? So analytical, I analyze financial, non-financial to identify unusual transaction, unusual trend, unusual ratios. I will try to figure out some trend issues, unusual trend, unusual transaction. Repairs and maintenance. One bill is there, 2 crore is the repair. What repair will be 2 crore? I investigated further. I got the real bill, real invoice given by the third party. It's a spare part purchase. It's a spare part purchased, and the spare part meeting the recognition criteria under PPE. It should be capitalized. You can't debit under repairs and maintenance. Yes or no? So identify unusual transaction, unusual trend. That is called analytical procedure. Examples: relationship between profit and employees. Relationship between sales and square footage. Generally square footage and all we will see in retail markets. Per square foot they calculate. You know how much profit we are getting from detergents. Detergents are occupying how much square foot in the store. So there, if at all, can I put some other product so that I can get a better profit? Like that, they also calculate profit per square foot. Getting it? Unusual relationship that may indicate risks, especially due to fraud. There is a high expenditure in repairs and maintenance, high expenditure in legal fees, high expenditure in legal fees, lawyers fees. Why? Some pending litigation is there. When I initially talked to the company, they didn't tell me litigations and all. Whereas when I see lawyer fines, so much is there, so much fees is paid to the lawyer. So when I indicate, I found one very big contingent liability. Going concern issue is there. Next, analytical procedure includes what and all? Ratio analysis, trend analysis, reasonableness test, structural modeling. Ratio analysis, you know. Trend means also you know. Reasonableness test. Production records for power bill consumption is extremely high. Production correspondingly not reflecting. Unreasonable. Reasonableness test means like this we will able to understand. We will compare non-financial with the financial and identify something which is unreasonable. And structural modeling, generally we don't use this. Some regression tools and all, statistical tools and all, we generally don't use this structural modeling. Now more about analytical procedure we will discuss in depth in 520 standard. What are risk assessment procedure includes? Sometimes I'll ask you includes. So you need to write the first one, side heading, main, first two lines. Second, analytical, this and then example. Observation and then example. Enquiry is not any 2 points you write, because the question is sometimes full question. Sometimes I'll ask only enquiries, then 5 points minimum you should. Are you clear? That's it. Risk assessment procedure includes also, you understood. Now, having completed risk assessment, once we completed risk assessment in a company, we should classify the risks. Are there any significant risks? Because significant risk is something where significant attention is required, where auditor will give greater attention. Significant risk means we will gather more documentation for that. We need to extend our sample size like anything there. So what is the significant risks? Significant risks are basically inherent risks only. In an organization, risk only, some risk only. There is a possibility that because of that material misstatement might exist, where likelihood of occurrence is higher magnitude. Remember I told you, where likelihood is higher, magnitude is higher, both are higher, then we classify that scenario as a significant risk. You know, in the vendor master, no, company vendors list, one vendor name is there which is not approved actually. Somehow wrong vendor name came, and during the year many orders were placed with that vendor. There is a high possibility that this is a fraud. High possibility that this is a fraud. See, sometimes no vendor name will be there. It just approval is missing. Later on again management discovered, it's okay sir, it's okay, genuine, no problem. Sometimes it might not be genuine. If approval is not there, likelihood of fraud is very high. And the magnitude involved, transactions with that vendor is almost 10% of the total purchases with that vendor. Magnitude is also high. That's a significant risk. So we need to give greater attention to it. Why that vendor name came into the master, vendor master, in the sense in the approved list? How did it come in the approved list without approval? What happened? I will dig, I will investigate thoroughly in significant risks. When I classify some risk as significant risk, we investigate thoroughly there. Like assertions affected by these risks are assessed as having higher inherent risk. Which risks? Higher likelihood, higher magnitude. Now examples. Fraud risk. Risk of fraud is always significant risk. Related party transactions outside normal course of business. Remember, are not all related party transactions. They may give you MCQ. All related party, which of the following statement is true relating to related party? All related party transactions and related party relationships and transactions are significant risk. Related party, previously unidentified related parties is a significant risk. Related party transactions outside normal course of business is a significant risk. Outside normal course of business. What is outside normal course of business? He sold to one related party goods. Generally we give credit period 30 days only. To him we give 150 days. That's outside normal course. We sold goods without consideration. That's outside normal course. Normally we don't do like that. Normally with anybody else, when we are selling goods or purchasing, there are some terms. With this party, we violated the terms. These terms we are not following with related party. That's a related party transaction outside normal course. Generally, related parties and transactions with unrelated parties, more or less terms and conditions will be same only. Just that we both are connected. But sometimes with related parties, the terms and conditions are not in ordinary course. They will be different terms. Are you clear? Next. Factors for determining significant risk. Okay, fine. Risk of fraud is a related party, and risk of fraud is a significant risk, and related party transactions outside normal course of business is also significant risk. Generally, how do we decide whether there is a significant risk or not? The following. First of all, it's a matter of judgment. Whether a risk is a significant risk or not is a matter of judgment. But you can take the following symptoms if at all there. Generally, you may classify that situation as a significant. For example, risk of fraud, already we covered. Complexity, transaction is done complexed. You know, I gave a loan to my subsidiary company, they gave a loan to another company, they gave a loan to another company, and that company again I got the loan. Again I received some money from them. Some circuitous transaction, some fraud is there. Tax related fraud. Why this complex transaction? Next, if the risk involves significant related party transaction, if at all you predicted some risk here, and in that majorly related parties are involved, that might also be one of the factor to classify whether the risk is see, they are not saying these are risks. They are not saying if at all these character stars are there, they are directly significant. These are few characteristics which you will consider, and then you need to decide significant risk is there or not. Suppose related party transaction outside normal course, obviously significant risk. Transactions with related party, check significant risk is there or not. Transactions with related party outside normal course, classify it as significant. Is there a risk of fraud? Consider. Risk of fraud is there, significant risk. Are you getting it? Below factors. If these factors I will take into account to decide whether that's a significant risk or not. Now, degree of subjectivity in measuring financial information. For example, an accounting estimate is there. The company has a property, plant and equipment, especially machineries are there. Factory cost is there. Inside the decommissioning liability, site restoration, site preparation, decommissioning liability is there. A big amount, huge amount involved, and that's completely an accounting estimate where high subjectivity is involved. I may classify the decommissioning liability recognition, right? Accounting estimate, right? I may classify that as a significant risk. Okay, fine. See, if we will classify, understand what you will do by classifying an item as a significant risk. What you will do? More attention I will give on that. I will allocate expert resources there. I may take expert opinion there. I will use senior people there. I will personally monitor that. That's it. If you classify a risk as a significant risk, I get more evidences. More attention will be given. Thereby, my overall audit risk will be reduced. Understood? Further, you know, risk assessment further. And one more factor is whether the risk involves non-routine transaction, unusual transaction outside normal course account. One is high degree of subjectivity involved. Another one is what? Non-routine or unusual. This transaction seems non-routine, very like different transaction. Huge amount of repairs expenditure is there. So this is also one of the factor where I may classify that situation as a significant risk. So whether a risk identified by the auditor, inherent risk identified by the auditor, are they significant risk or not is a matter of professional judgment of the auditor. However, the following factors can be taken into account. Is there a risk of fraud? Is there a significant related party involvement? Is the transaction complex? Subjectivity, degree of subjectivity involved, and risk of non-routine. One more is recent. Yeah, one more thing. The risk is due to recent changes, significant technological changes, law and regulation changes, environment changes. Suppose companies for the first time applying Ind AS, and the company don't have that much competence. They don't know how to prepare financials using Ind AS. That might be a significant risk. Because there's a possibility that so many financial statement items might be misstated. By the way, significant risk means financial level risk, no, may or may not. Significant risk means what? Higher likelihood, higher magnitude. That's what the meaning. Financial statement level risk means what? Pervasive level risk, where many items might affect, where management, financial statements itself become unreliable. Don't confuse between financial statement level risk and, by the way, financial statement level risk is no doubt a significant risk, but significant risk need not be exactly. You clear? So financial level risk is different, significant risk is different. When do we say significant risk? There is an inherent risk, high likelihood that that risk might turn into reality, and that magnitude is also high, where it is impacting is also high, material. Getting it? May not be pervasive, or maybe pervasive. That is called as what? Significant. Pakka misstatement, high possibility is there. That's what significant risk. Two risks are always significant risks. Risk of fraud is always a significant risk. Related party transaction outside normal course of business, that's always a significant risk. Remaining items, whether are they significant risk or not, factors. Is it risk of fraud? Is there a significant change in the law and is the risk due to significant changes like economic changes, regulatory changes, complexity of transaction, significant related parties involved, subjectivity is high, non-routine transactions? Tell me, what is a non-routine transaction? Transactions which are unusual. Non-routine means unusual. Why they are unusual? The size of the transaction is so big, or nature of the transaction is different, or nature and occur infrequently, either due to size or nature. Okay, simple, either due to size or nature. What do you mean by non-routine? It's non-routine because of its size or because of its nature, and they occur very rare, infrequently. Non-routine see, that routine means frequency, non-routine means infrequent. Simple logic. Yes or no? Non-routine transactions are the transactions which occur infrequently. Why are they non-routine? Either because the amount involved is very big, or the nature is different. For example, sir, I sold goods to one customer with 150 days credit period. Normally I will give only 30 days. Nature is different. Are you clear? Guys, most of my sales are 10 lakhs, 15 lakhs, 12 lakhs, like that only each invoice. But one invoice is there, 2 crore is there bill. That's a non-routine transaction. Non-routine and all, how do I find? Analytical procedure. How do I find non-routine? Analytical. Unusual trend, unusual amount. Judgmental matters, like accounting estimates with significant measurement uncertainty. Accounting estimate with significant measurement uncertainty. Accounting estimate with high uncertainty means what? Example, decommissioning liability. That's an accounting estimate. Is it realistic? Is it close to reality? We don't know. Significant uncertainty is there. High estimation uncertainty, high measurement uncertainty. Yes or no? After 20 years, how much I incur? Nobody knows. Based on some assumptions we calculated. Yes or no? That's it. So that's about significant risk. And just now we saw risk of MMS is greater, correct? For non-routine transaction. Non-routine transactions, risk of MMS is greater. What do you mean by that? Greater management involvement is required to specify accounting treatment for a non-routine transaction. Generally, management involves too deep for accounting treatment of non-routine transaction. For example, 150 days credit period is given. Maybe the accounting or transaction execution approval processes and all different. See, accounting treatment includes transaction process also. Generally, transaction process is also covered as part of accounting treatment. Manual intervention in data collection and processing increases the risk of errors. So generally, when a company is collecting data, automatically they'll collect. They implemented some systems which is automatic, computerized. Manually, somebody is again changing the data, for example. That is also a non-routine issue. Non-routine transactions involves complex calculations, accounting principles where risk of MS is increasing. The nature of non-routine transactions make it challenging for the entity to implement Effective internal control. See, we have controls for every type of process. Sometimes some related parties we give 150 days credit period. Who will approve? There is no guidelines on that. We have only two rules. Up to 30 days credit period, so and so management will approve. If any customer is asking more than 30 days up to 60 days, so and so manager will approve. 150 days, if at all somebody is asking credit period, we don't have control itself. We didn't even think about that. Are you getting it? For non-routine transactions, sometimes controls might be missing. So the nature of non-routine transactions make it challenging for the entity to implement controls. That's non-routine means what? That is something that will not be usual, or that we will not have controls. Are you getting it? Next. See, in electricity boards, like for example, in the fuse box, for example, we have no MCB board in homes and all offices. Fuse will be there. The 20 amps, 6 amps fuse will be there. Okay. So that is based on normal usage. Yes or no? You are suddenly bringing one big generator and connecting. It will not work. The fuse will go. The fuse will be spoiled. Yes or no? The fuse will get damaged. Correct? So non-routine. Exactly. So we can't implement controls for non-routine transactions generally. Why controls are not there for non-routine? First of all, that itself is a non-routine transaction. That is something that we don't even expect it to occur. Clear? So risk of MMS is greater for non-routine transaction because of various reasons. One, management is involving heavily to specify accounting treatment. Then also that might be a non-routine transaction. If management, generally, how do we account books of accounts, any transaction? Accountant only will pass. But for some general entries, no, accountant is not passing, top management is passing. I opened accounting software, audit trail I generated. Which journal entries are not passed by this user ID, but by some other user ID? Some user ID was there. Who passed journal entries? That might be a non-routine transaction. Okay, why they passed? Manual intervention in data collection and processing. Non-routine transactions might be a complex calculation, accounting principle increasing the risk of MMS. Complex calculation, complex accounting principles. Nature of non-routine generally makes it challenging for the entity to implement effective control. They may ask you in MCQ. Generally, companies will implement internal controls for all types of transactions, including non-routine transactions. Non-routine transactions generally were not addressed by internal control systems. Generally, it will not be there. Clear? Same way, risk of MS is greater for judgmental matter. Like accounting principles related to accounting estimate, revenue recognition may have different interpretations, increasing the risk. So, required judgment may be subjective. The judgment of the management might be subject to highly complex. It involves assumptions about future events such as determining fair values. So risk of MMS is greater for judgmental matters like accounting principles related to estimates. Revenue recognition interpretation may be different, which increases risk. Subjectivity will be there, complexity is there, assumptions about future events. These are all require judgment. This is also one of the reason why risk of MMS is high for judgmental area. For judgmental areas and non-routine transaction, risk of MMS is high. Why it is high? They are giving various reasons, examples we are giving. Able to understand? So this was asked as once 4 marks question. This as asked as a 2 or 3 marks question. Are you clear? Or risk of MMS is high for non-routine and judgmental matters. Both they can ask. One is 3 marks, another one is 2 marks. As a 5 marks question they can ask. Are you clear? All of you? That's it. Finally, once you identify and assess the risk, once you determine it is significant risk, non-routine, all that risks, you need to document it. How do you document? In ICA material, documentation is given somewhere at last of the book. So we just kept it at one place. Even this non-routine transaction, judgmental matter, significant risk also discussed at somewhere. We kept it one place. Okay. Now documenting the risk. Obviously, document the discussion among engagement team and significant decisions reached. Generally, risk assessment and all, engagement team will discuss and then perform. Document the discussion. What are all you discussed? Record key elements of understanding each and every aspect of the entity and its environment. You might have understood about the entity and environment, right? What you understood about entity and environment, we have third concept in this book. There we will discuss. Understanding the entity means what? Understanding the nature of entity, understanding the business strategies, understanding the legal and regulatory framework, like that some points. Understanding review of financial information, like that some points were there. Document them. So document each aspect of the entity and its environment. Document each component of internal control, purchases, what controls they have, sales, what controls they have. Document it. I showed no one RCM, risk control matrix. I showed no procurement. That is nothing but documentation of risk. That's an evidence of documentation. Include the source of information, risk assessment process performed. Further document the risks identified at financial statement level and assertion level. How do you document them? Risk control matrix. Record the risk identified and related controls about which auditor has obtained an understanding. So I record what risk identified, what control is it relating to it, documented. Nothing but what are we documenting here? Risk control matrix. Are you clear? So this is documentation. Straight away 5 marks question possible. Straight away a 5 marks question is possible. Easy or not? Now let's look at understanding the entity and its environment. See, in documentation, and in a document understanding of each component of entity, one point is there. Write a document understanding of each component of entity, each component of internal control of the entity, whatever. Understand, document the understanding of the entity, nothing but. Yes or no? What do you mean by understanding of the entity? This one. What do you mean by understanding of the entity and its environment? What do you mean by that? Industry. To what industry the entity belongs to? What regulatory is applicable? What are the external factors? For example, the entity I'm doing audit is a bank. RBI is applicable, which is a regulatory. What are the external factors? All that you document. For example, external factors means what? What is the economic condition right for the banks? Interest rates, how much? Financing availability and inflation. These are all external factors. Document them. Also document regulatory factors. What do you mean by regulatory factors? Includes regulatory environment like legal environment, political environment, financial reporting frameworks, like what accounting principles apply to this company, specific industry regulations, tax laws, government policies, industry factors, competition, how it is, supplier customer relationship, how it is, technological development, how it is, like industry conditions you document. These factors give rise to specific risk from nature of business or regulations, like competition, how it is. It might give a specific risk. What specific risk might be given? See, earlier also we have one point in factors influencing external factors, entity specific factors. External factors means if there is a heavy competition, management is under pressure. What they may do, suppose they want to go for loan next year, extreme competition, sales are declining. What the company might do, they might artificially inflate the sale, inflate the profit, show better picture to a banker, get a higher loan. Fraudulent financial reporting can be done. That's why you need to understand the entity, external factors, regulatory factors, all that, to know where and all risks were there. Yes or no? So the auditor must understand the industry, must understand the regulatory, and must understand external factors affecting the entity. Industry, regulatory, external factors, you must understand this. Recently in one of the exam they asked for 5 marks. Understanding the entity, industry, understanding the industry, regulatory, external. Industry means what? Industry conditions. What is the competition? Supplier customer relationship, how it is, technological developments, or how it is. These factors will give rise to specific risk from nature of business or regulation. Examples: market competition, seasonal activities, product technology, all this. They may ask you, they'll give you this example. Is this an example of industry factor, regulatory factor? They'll ask. MCQ. So like market competition, industry related, right? Seasonal activity, industry related, right? Technology, industry related, right? Product risk, these are all industry related factors. Regulatory means what? Accounting principles, because accounting standards and all, who decide? Regulators will decide. Industry regulations, tax laws, government policies, these are regulatory factors. These are not specific to industry, these are regulatory. External, economic condition, interest rates, loans and finances availability, inflation, these are external factors not within the control of the industry. Able to understand all of you? These are the factors. This auditor has to understand what industry it belongs to, what frameworks it is applicable, what law and regulation applicable, what is the external factor, what is the industry factor. Then the auditor has to understand nature of the entity. What understanding of the entity and its environment, right? Now we understood about environment. Now let's understand the entity. Entity means what? What operations they are in. Like what is the nature of revenue source? What products and services they're dealing with? Where and all production locations are available? Operations, nothing but understanding operations. Understand ownership and governance structure. Who are the owners? What are the financing methods? Look at their investments, where they invested currently, where and all they're planning to invest very soon. Okay, examples. What are the examples? The nature of the entity means what? Auditor has to understand entity's nature to identify risk of MMS and determine related party transaction. When nature of entity you are understanding, related parties also you will understand. To know what operations they are in, who are the owners, and governance structure, where they are making investments, like what are the operations, how they are financing, what reporting is applicable to them. Yes or no? This is regarding nature of entity. Understand the nature, then you will understand what accounting is applicable. All that. Third one, selection and application of accounting policy. Please evaluate whether entities accounting policies are appropriate for the business, comply with financial reporting framework and industry standards. Please evaluate whether entities accounting policies are appropriate for the business and comply with financial reporting framework and industry standards. So this is one more thing. Selection and application of accounting policies. The auditor evaluates whether the entity's accounting policies are appropriate. Also understand what is the entity objectives, mission, vision, what strategies they are implementing, what business risks that they are facing. Like objectives and strategies. What do you mean by objective? Below we have given a meaning. Objective means what? Entity plans in response to internal external factors. Entities plans. What are the plans? Strategies means what? Methods to achieve these plans, these objectives, which may evolve over time. Okay. Objectives means mission. Strategy means how to achieve that mission, vision. Yes or no? Now, so the auditor understands objectives of the entity, strategies of the entity, and related business risks to identify MMS. Business risk means what? Business risk. Tell me which is wider. Risk of MMS in financials is wider. Risk of business risk is wider. Business risk is very big. It includes risk of MMS. Yes, broader than risk of MMS, but may have financial consequences impacting financial statements. Understanding business risk lets the auditor identify likelihood of MMS. Business risk. Some big competitor suddenly came. Pressure on the management. Loan requirement is there. Next year they are going for expansion. This all creates a pressure on the top management where they might commit a fraud. They may window dress. They may show wrong picture in the financials. So, by the way, do you have responsibility to identify all the risks? Yeah, that's not your responsibility. As a part of your understanding, wherever risk you find, that is. See, risk assessment is not your objective of the audit. Your objective of audit is to give an opinion on the financials, whether they are free from MMS. But in a financials, mistakes might arise so many. I can't verify 100% of the transactions. I want to know, see, the time available for audit is very limited. I can't verify each and everything. I want to verify only those areas where mistakes can happen. Where mistakes can happen, risky areas. What is risky area? Identify the risk. So we are identifying and assessing risk, entity, understanding entity, environment. Why are we doing all this? To identify problem areas because of which books of accounts might contain errors and frauds, because of which financial statements might be materially misstated, where I may give a wrong opinion. For audit risk reduction purpose, when I'm doing risk assessment, my objective is not to identify the risk and assess a risk, report on the risk. Is my objective to give a report on the risk of the entity? That's not my objective. Yes or no? So, what are the examples of objectives and strategies? What are the industry development? New products and services did the company launch? Business expansion. Do they have any strategy for business expansion? Do they plan any business expansion? What new products and services? Launching a new product is a strategy. Understood? Industry developments. So what generally in industry, what developments are there? So these will affect the entity strategies and objectives. Understood? All of you? It's something like strategic management. No? Yes or no? Some part of it. Okay. So objectives and strategies. This itself 4 or 5 marks question, many times asked. Nature of the entity, 5 marks question or 4 marks question. Relevant industry and regulatory environment. Relevant industry, regulatory and external factors, 5 marks question. Understood? Everyone until now? Then measurement. Measurement and review of his financial performance. See the latest financial performance. Nothing but like understand performance measures, which will help the auditor to identify potential pressures. These pressures may motivate management to mistake. Yeah, yes. So measurement and review of financial performance, like key performance indicators, financial and non-financial metrics, financial performance, period comparison, budgets, forecast, external reports, credit rating agency, media assessment, stock market assessments on the company, assess all that. So measurement and review of financial performance, understand performance measures, which will help the auditor to identify potential pressures. Suppose directors know they were having incentive based on 1% of turnover. So definitely there is a high possibility that they may want to manipulate turnover. These pressures may motivate management to misstatement. So review the financial performance of the company in the recent past. See whether are there any performance based incentives and all. Try to identify that. Are you getting it? So understanding of the entity means what? Reviewing the financial performance of the entity. Okay, reviewing objectives of the entity, strategies of the entity, and business risks that they are facing. Okay, and reviewing nature of the entity, reviewing industry, regulatory, external factors. Sometimes direct question might come. Write about understanding the entity and its environment. The auditor must understand first point, entity, industry, regulatory, external factors. That's it. You don't have to write any other. Nature of the entity, understand the nature of entity. The auditor shall evaluate accounting policies. The auditor shall obtain objectives, strategies, business risk information. The auditor has to obtain understanding performance measures, which will help you to identify potential pressures on the management. These pressures may motivate the management to commit frauds, to materially mistake the financial statements. So understand them. So understanding the industry, understanding the regulatory, understanding external factors, understanding nature of entity, understanding accounting policies, understanding objectives, strategies, business risks, review financial performance, measurement and review of financial. I will just see how I'll measure what is their financial performance in the recent quarters, all that. Okay, how is their pressures on them? Are there any performance linked bonuses? I will try to verify that. This is called understanding the entity and its. By understanding the entity and its environment, I will identify various risks. Then I will have to assess the risk. Then I have to document the risk. Then I have to plan further audit procedure. Are you clear? Able to understand the link now? Yes. Now tell me, understanding of the entity, is it a one-time process or continuous? Continuously. Because you don't develop understanding within first 1 week itself. Slowly you will understand about the company more. As you go proceed audit, you will understand more. Okay, understanding an entity and its environment is critical for planning the audit in order to identify areas which require special attention. That's yes or no? That's the reason why we are understanding. Gaining knowledge about the client business, which is essential for proper conduct of the audit. Why? Like, what is the need of understanding? To plan my audit, to identify risky areas where I can give special attention. And gaining knowledge about client business is essential for proper audit. Understanding the entity is a continuous dynamic process of gathering, updating, analyzing information throughout the audit. So understanding the entity is a continuous process. It's a dynamic process. So no, it's a continuous dynamic process where you need to continuously gather, you need to update, you need to analyze information throughout the audit. Importance. What is the benefit of this understanding? You can identify and assess risk of MMS. Only if you understand the entity, you can decide what is materiality level for the entity. Without understanding the entity, can I decide materiality? How do I know whether a mistake is material or not? Only I should understand the entity first. Then only I can understand what is material for this, what is immaterial for this company. Materiality is a absolute term or relative term. Relative term. Relative means what? What is material for you may not be material for me. What is material for Reliance Industries Limited may not be material for a normal small company. Yes or no? Sorry. What is, yeah, what is material for a small company may not be material for Reliance company. Yes, and see, the understanding provides a frame of reference to the auditor. I'll get some reference to decide to identify and assess risk, to decide materiality, to assess accounting policy, to assess selection and application of accounting policies. Only when I understand the company, only when I understand it's a gold company, gold jewelry business, customers can buy new model, old model, whatever the model they like, then only I can understand whether FIFO method suitable or weighted average method suitable. Able to understand? Identify areas which require special consideration, such as related party transaction, going concern assumption, business transactions. Establish expectations to use in analytical. I can analyze the company, I can perform analytical processes better only when I understand the entity. And most importantly, to determine whether sufficient appropriate evidence is obtained, how much evidence is required, including assumptions used by the management, where and all representations I require. I can get all this. Importance of understanding, straight away 5 marks. They may ask you, what do you mean by understanding the entity? Why entity need to be understood? What is the importance of understanding? See, actually, no, need of understanding, importance, both gave almost same answer. In fact, importance is having more points. So why you need to understand importance? What is the benefit you get? You understand risks. You can decide materiality. You can set materiality. You can assess accounting policies appropriateness. You can assess whether accounting policy is appropriate. You can identify areas that need special consideration, like related parties, appropriateness of going concern. You can establish expectation for analytical. You can assess sufficiency and appropriateness of evidence, including what assumptions they used, whether oral and written representation is required or not. Easy. One more segment is complete. Understanding the entity and its environment is also over. Confident everybody? Yes. So it's almost 2 hours. We completed one major topic in risk assessment. One major topic is completed. Then we need to discuss about materiality, internal controls, IFC, automated environment, 330. These are the topics which are pending in risk assessment chapter, this chapter. Okay. So I just okay, fine. So we'll continue the next session. So let's continue the discussion in risk assessment internal control topic. If you observe, we have completed risk assessment, understanding of the entity and its environment, which is actually 315. And the next topic that we are supposed to discuss is, see, in this topic 320 we kept pending, materiality. Internal control is there, right? Internal control also hold it. Study even when you're reading also at last. First we will finish priority wise, which are relatively easy, but pakka question will come in exam. Automated environment. The next topic that we will discuss is what? Automated environment. Okay. Now, what is an automated environment? The previous topic is what we kept pending, internal control. Okay. That previous topic is what we kept pending, which is internal control. The topic of internal control. See, this chapter name is what? Risk assessment and internal control. Internal control fully we are not leaving. Half of it will keep it pending. We'll see at last. Risk assessment we understood. Understanding of the entity and its environment we understood. Now we are going to understand automated environment. Once this is over, 330 standard we will discuss. Then we will discuss, if possible, 530 sampling topic. Then we'll come back and discuss 320, 450, like that. Able to understand? So that's how we will proceed further. Now, so automated environment. So what is an automated environment? Obviously today, if you see any business organization, today they are using automated tools. Best example, Amazon. Theirs is complete an automated environment. Even you take any other business also, 70 to 80% of their operations were automated. See, again, it's not about removing humans and then automizing with the system. No, not that. Automated environment means where business processes are happening through systems, where many of the business is conducted through IT systems. So that environment is called as what? Automated environment. Earlier, very few business processes and accounting used to be IT oriented. But today, everything is integrated into IT. Like if you are purchasing goods, the moment we receive delivery at a warehouse, only when we receive delivery, then only we can record purchase journal entry. Only when we record purchase journal entry, we can make a payment. Like without receiving delivery, you can't make a payment to vendor unless it is an advance payment. Unless it's an advance payment, you can't make a payment. Like that, everything is integrated. And the moment you sell the goods, the moment your billing is over, automatically stock registers are updated. Automatically sale registers are updated. Everything is automatically getting updated. This kind of business environment is called as automated environment. Now look at so what is the meaning and features of an automated environment? So automated environment is a business setting, okay, where processes, operations, accounting, and even decisions, they are executed using computer system. So the process, operation, accounting, decisions, everything is integrated through the computer. Able to understand? So for example, so what do you mean by decisions? Decisions being taken means what? What does it mean? See, decision means it's not altogether like human decision making, professional judgment, not that. Generally, suppose you made an application. You made an application to the institute for exam form. If signature, everything is matching, the system itself will take a decision that this is a proper application. That's a decision. Technically speaking, that's actually what? A decision. It's a process where an operations like accepting exam application from students, including the collection of fees, accounting of fee, deciding whether the student is eligible for so and so attempt or not. We will program the criteria. So the moment you make an exam application, the system will do a background check. When the student registered, for him, is this exam eligible or not? Eligible attempt or not? Like some minimum study period gap is required, right? After enrollment, some 8 months in CA in CA final, some 6 months minimum. After completion of articles, 6 months of gap must be there before a student apply for examination. The system will do a background check. For example, you are a CA student, you made an application. Whether after registration, 8 months gap is there or not before this exam. So the system itself automatically checks and approves the application. This is called decision making. Our system takes a decision based on the program we give. So that is called program. Getting it? So in a business where processes, operations, decision making, accounting, everything is through IT systems, and that environment is called as what? Automated environment. What are the key features in a business, in an IT environment? What is the main advantage? It reduced manual intervention, correct? An automated environment is characterized by manual intervention will be reduced to a great extent, and everything is system driven process. System driven. Greater automation often means greater complexity. Key features includes faster business operations, accurate data processing and computation, capability to handle large transactions volume, integration of business operations, security and controls, reduced human errors, access to latest information, strong connectivity and networking. I hope you're able to understand this. Yes or no? Systems will give you what are all. Business processes can be faster. Traditionally, we used to make manual exam application form. Somebody has to receive an ICA. They take at least 15-20 days. It's 50-60 team members. They need to sort it. They need to make sure the center's allocation, everything. How much task? Today, that entire people are eliminated. You made an application, center allocation, everything will be automatically taken care. Everything is automatic. Allocation of center is also automatic. It's not manually done. So, faster business operation, accurate data processing and computation, large volume of transactions can be handled through IT system, which a human cannot handle. Integration, inventory, accounting, payments, everything is integrated. Security and controls. If you maintain physical books of accounts, somebody can access it somehow and erase the data. But IT, nobody can access easily. Of course, IT itself has certain risks called cyber risks. Okay, that's different. Okay, now human errors reduced. You always get updated information, latest information, real-time information. Next, strong connectivity and networking capabilities. These are the features. Directly in exam, they'll ask you a 4 marks question. what is an automated environment and what are the features of an automated environment. And see, generally, in automated environment, complexity will be there, system. It depends upon, where, suppose if a company is using an ERP software, ERP means enterprise resource planning. You have in SMA this one, strategic management, you have any ERP discussion? Okay, fine. Like Oracle, SAP, they increases complexity, making audits more challenging. See, this is technically not true. Today, audit become easy because of ERPs. Traditionally, from a senior citizen point of view, who first time sees automated environment, who does not have any technical knowledge, he feel it is very complex, but it's very easy. Without today automated environment, it's extreme difficult for us to conduct audit. Only because of systems we are able to do audits very effectively, productively. Okay. Further, using off-the-shelf accounting software, nothing but a ready-made accounting software, Tally, for example, that's a less automation and it is simpler environment generally. Example we give. Okay, so what is an automated environment? What are the features? And write about complexities in automated environment. They may ask you regarding system complexity, nothing but this point. Using an integrated ERP tool makes the system more complex, which is challenging for the auditors, book point of view. Whereas using off-the-shelf ready-made software is less automation. It requires less automation, very easy for the auditor to also use it. Are you clear? Very simple. If a company is using a very complex IT, what we do, we first understand. We will be trained. Company will train us on how to use a software. All the 10-15 days training sessions will be conducted. Then only we will start audit, able to understand. And we can take the help of experts. That's it. Next. Whatever automated environment you understand, I hope this, no problem, right? Manageable, the disturbance. Yeah. So understanding and documenting of automated environment, like first, basic thing, what is automated, we understood. As an auditor, when you're doing an audit of any entity, you should understand the enterprise automated environment, like how entity is depending upon IT, what controls they implemented through information technology, what processes they are doing through information technology, what version of software they are using. Is this software in-house or an outsourced? Is it a third-party software or is it an in-house software? See, only when you understand the automated environment, you can understand the risks in that. For example, what are the risks arising from use of IT system? Generally, if anybody is using IT, what is the risk in IT specifically? See, every business activity, every business process will have some risk. That's called inherent risk. Every activity will have some risk called inherent risk. Now, automated environment, IT systems will give certain types of risks. For example, inaccurate data processing or processing incorrect data. Inaccurate data processing. For example, you uploaded a wrong 12th mark sheet. Okay? You uploaded a fake 12th mark sheet. You uploaded fake all the degree certificates. System cannot recognize between original and duplicate. It will process incorrect data. Yes or no? If you prepare one certificate, 12th certificate, nobody will have a mechanism to cross-check it behind. You know that? It is not integrated. Do you have any 12th certificate serial number matching with ICA records? Do you think ICA will access to intermediate board and then cross-verify that? They don't have. These are the risks. Incorrect data processing. Data might be wrong, but still system processes. System will process whether you give wrong data. For example, you go any website, you enter mobile number with 10 digits. Any 10 digits you enter, OTP will be sent. System don't know whether it's a right mobile number or wrong mobile number. Suppose if I tell you mobile number 123456789 10 digits, you will tell, sir, this is not a mobile number. System don't know. What system sees 10 digits are there, that's it. Send OTP. It will send OTP. Even from your message also, you type this number and send OTP, it will go. OTP will go. I mean, message will go. But you have a point called message undelivered. But message went right. Are able to see or not? Understood or not? Exactly. So system has this, weakness in the sense it processes the data even if the data is wrong. That's one risk. Sometimes processing might be wrong. Data is right. Inaccurate data processing in incorrect data, inaccurate data. Both are different. One is processing might be wrong. Processing might be wrong means probably, like, for example, you can take up like this. Okay, incorrect processing means, for example, see, For example, in generally when you're doing e-commerce transaction, for example, you need to, for example, you entered card details, all that. You want to make money. First it will give you confirmation, then go and check the balance. First it should check the balance and then give you confirmation. First one or second one? Second one. When you are transacting in online, when you enter your card details for payment, first it will give you ticket, movie ticket, and then it will go and see the balance. If balance is there, it will collect. Or first they will check the balance and then give you the ticket. Second one should be the right process. When you're designing an IT system, you need to understand first which step should happen, then which step should happen, then which step should happen. If at all it is not programmed correctly, it might lead to wrong, it might lead to giving ticket at first without checking balance. Next, unauthorized access. Risk of unauthorized access to sensitive data, cyber risks. Somebody can access your system data even from corner of the world. Somewhere at some other country he can sit and access your data. That is one risk in IT. Yes or no? Risk of direct data changes by bypassing front-end controls. Front-end controls means what? For example, firewall protection, all this. Okay, direct data changes. Or even it may be I can directly, somebody who knows my password, they can open directly my system and then they can delete the data, or they can change my files and all. That's direct data change, unauthorized. Privileged access. Super users, we call them as what? Super users, who will have excessive access to storage. Suppose you go to any bank, cashier, you see, he will have access only to how cash related affairs. He will not have access to customer ledger account. In many banks, public sector banks especially, cashier will not have access to customer statement. You go and ask cashier, sir, 3 days back in my account, no, something is debited. Can you please see and tell me what it is? Cashier will say, sorry sir, I don't have access to the data. But you are a bank employee. Yeah, I'm a bank employee. I have user. I can access system only for certain things. I can only do certain things. I cannot do everything in the system. If you want to know that, go to the accountant. Segregation of duties can be implemented through IT systems. Next, that is what? Inadequate segregation of duties leading to process risk. In IT, you need to differentiate the roles of the employees clearly. We call them as user access role. User roles. We call them as what? User role. For example, if you're logging into an SSP portal, for you a student role is given. When I log into SSP portal, I will have member related affairs. We both are using common portal, but my access privileges are different from your access privileges. ICA president also can log in ICA data, but he will have a different data. Able to understand? This is called user roles. Okay, next, risk of unauthorized modification. Another risk is what? Unauthorized modifications to systems. You see here, unauthorized changes to data. Direct data changes, nothing but unauthorized changes. Risk of direct data change. Here, modification of systems and programs. See, you can simply sync this with your mobile phone. Very simple. Okay. Processing of incorrect data. You are entering wrong mobile number and dialing. Okay. Risk of unauthorized access to sensitive data. You just kept your phone unlocked. You forgot to lock. Somebody can take up your phone and then see all your private photos, everything. Yes or no? Then direct data changes. I can delete your photos. And privileged access. Generally, your close people will have access to your phone. Privileged access. They know everything in your phone. For example, inaccurate segregation of duty. In phones also, if you see, in systems also, if you see, user roles can be given. In your phone also, you can add a guest ID. Suppose when you're giving a phone to a kid, no, you can enable guest ID and then give. Nothing will be there in that. Are you getting it? Next, unauthorized modifications to systems. Without your knowledge, I can install some malware on your phone. If at all your phone, I can access it. I can download a malware. I can download an application, something I can do, or I uninstall some of your important application. Next, failure to update systems. You're not updating your software correctly. That might lead to some breaches. Data loss. What if I reset your phone? If I know your password, I can reset your phone. Data loss. Yes or no? Impacting integrity and availability. These are various. In an IT, we have something called IT objectives. Information technology objectives. What are the objectives, especially from data point of view? Data objectives are what in a system? Integrity, availability, confidentiality. Actually, we call them as CIA. CIA. Okay. Confidentiality, integrity, availability of data. These three principles we should maintain. There are something like management information systems, ISMS 27000 standards, some standards and all were there. Okay, so the objectives of data in an IT environment is confidentiality, integrity, availability. Confidentiality, nobody should access this, only known users. Integrity, even if somebody who is accessing, they should not change it. The data should be intact. Availability, data should always be available. There is something called DOS attack, denial of service attack. For example, a website is there, I say website, you see DOS attack will be like this. On result day, I say website suddenly will not work. Why? So many requests at a time. That system cannot have some 2000, 3000 at a time, more than 2000 or more than 3000 system cannot process simultaneously. DOS attack, it is called. ChatGPT recently, like some photos, no, give it what? Ghibli art photo something. Okay, so ChatGPT server was down. Yes or no? These are all DOS attacks. It's not, see, DOS attack means somebody tried to access your internet from so many commands they will send so that your system will fail. That is called DOS attack. Sometimes all of us together we do DOS attack. System will deny service. Denial of service attack we call it as. So these are the risks available. Are you clear? Now, what is the impact of these risks in audit? Okay, there are so many risks, I understand. What is the impact of risk in audit? Tell me, if I find so many risks in automated environment, in IT system, which a company is using, I will lose my trust on internal controls. Yes or no? I will lose trust on the system. Because of that, what will happen? I will be doing more extensive checking in audit on actual transactions. Impact on substantive testing. If at all IT risks are not mitigated, if not mitigated, these risks can affect audits in the following ways. What is the impact of IT risk on audit? One, impact on substantive procedure. How? Non-mitigation of what? Of IT risks may result in non-reliance on system generated data. Therefore, auditor may do detailed checking for accuracy and completeness of the data. This increases substantive checking. What is the impact on controls? Leads to non-reliance on control system calculation built-in procedure requiring additional audit work. We may not trust, if a bank IT systems are not proper, we may not believe their system calculation, provision amount calculation, NPA classification. Today banks are doing NPA classification, interest calculation, everything through systems. If at all I don't have trust on the system, what will happen? I have to manually sit and do so many works. Then regulatory actions also may necessitate, regulatory requirement for IFC may necessitate modified. Sometimes this IT risk may impact even our reporting. Sir, how come IT system? We need to report on financial statements. No, why the hell we report on IT system? We are reporting on financials. If IT is not good, why we will modify opinion on financials? We don't modify opinion on financials here. We may modify opinion on IFC. If you remember 143 subsection 3 clause number I, there is a point on IFC we have seen. Internal financial controls over financial reporting, where auditor has to report on adequacy and operating effectiveness of financial controls. Don't worry, we have the next topic IFC only. Once again we'll be covering that. We have to report on IFC, financial controls, how effective they are. Okay, that we need to give an audit report. So there we may have to modify. This is the impact of IT risks. See, if IT risks are there, generally every system will have a risk. See whether control is there for that. Some firewall protection, access controls like that. If controls are not properly mitigated, if controls are not properly implemented, risk is not properly mitigated, it leads to non-reliability of the system. When the system is not reliable, these are the impacts on audit. Understood? Next. Now, so what we need to do in order to know our IT risks? What are the IT risks that are there? What we need to know? We need to understand the IT environment. Yes or no? So during a financial statement audit, by the way, many times this one asked, what are the risks using from IT? 5 marks. And what is the impact of IT risks? Separately, a 4 marks question, or sometimes both of it put together 5 marks question they might ask. What are the IT risks that are arising from the system, and what is the impact of these IT risks? They might ask any of this or both. Then, so how do you identify these risks? By understanding the system. What you will understand? Understanding of automated environment and documenting automated environment. What do you mean by understanding? Very simple. An auditor must understand entity and its business, including IT environment. This includes analyzing IT department, analyzing IT activities, analyzing IT dependencies, analyzing IT risks, analyzing IT controls. So get an understanding of IT department of the company. What are the IT controls? What are the IT activities? Where and also a company is depending on IT. For example, bank is depending on IT for NPA classification, for reporting between top management to ground level management. They depend on system. System generated reports they use. System only will generate NPA report. They use that only. So these are all IT dependencies. We call them as what? IT dependencies and controls, IT risks. Everything is through this. Auditor has to get an understanding of IT department, IT controls, IT risk, IT dependencies. What are the IT activities? Now, key points. What you need to understand, specifically speaking, like identify application systems in use. Bank is using a core banking solution. There is a software. What application? Determine whether the system is handling financial and non-financial. Core banking software is mainly dealing with financial information. Assess if the IT systems are local or part of a global setup. They are local only. They are implemented in our bank server as per the RBI guidelines. Local. Global means what? For example, SAP is there. SAP is a global. Like it's not that something like we install here. For example, Instagram you're using. That's a software, right? That's an application, right? Instagram is an application, right? Is it a local application or globally same application? Exactly. Okay. Next, architecture. What is the system architecture? Is it like a desktop based architecture, a client server architecture, a web based architecture, a cloud based architecture? For example, Google Drive is there. It's a cloud based architecture where the data is stored on the cloud. Instagram is there. It's a cloud based architecture. Why? Because in the Instagram, whatever the information you're seeing, is it stored on your phone? You're just browsing the data, something there on the web, something there on the cloud. You're accessing the data through that. WhatsApp, it's stored on the so and so web. Yes or no? Functions. What are the functions of the various application? Risks that may across various versions. What are the functions of core banking system? The functions are very simple. They will help front-end employees to deal with customers. They do maintain back-end books of accounts. They calculate so many calculations and all. Core banking solution functions are so many. Check interfaces between multiple systems if applicable. Core banking solution has so many subsystems. Interface means how the systems interact with each other. Then IT systems, are they customized, developed, off the shelf? In the sense, are they in-house or packaged? This is more. See, these are the main. The side headings are main. Side headings also you should write. Remember, wherever we give side headings like this, no, please write them also in exam. Okay, is it in-house or packaged? Tell me which will have more risks. Package will have more risk. In-house, in-house will have more risk. Why? Many think packaged. No, packaged is less risk. Packaged means what is a ready-made software. Thousands of users will be there. Thousands of users. So many testings would have been done on that. It will have no risk. In-house, we developed a software which is customized. That will have so many vulnerabilities. Because when we are developing a customized software, there is a high risk that may not be completely covering every control. Able to understand? That's it. Now, outsourced activities. Identify outsourced IT tasks. Many companies know they outsource IT maintenance and support. Key personnel. Know the roles of Chief Information Officer, CIO, Chief Information Security Officer, System Administrator, Data Administrator, Chief Security Officer. Like that, so many posts will be there in a companies. Get understanding of who are the people controlling the IT. Understand who are controlling the IT. That's it. Clear? Next, documentation. Whatever you understood, no, document it. How will you document? For example, company is using SAP. This is the version. This is the purpose. Accounting, supply chain, production. This is located in Texas. So it's a client server architecture, Unix platform they are using. So and so server they are using. Interfaces within the system, no, they have something called paymaster interface. Okay, maybe some payroll related something. In-house package, right? It's a package software. It's not customized software. It's a package software. Who are the persons dealing with this SAP? Chief Information Officer, Administrator. Is it in the scope of our audit? Yes. For example, there is another one, Budget King. This is for MIS budgeting. That may not be part of our scope of audit. That software we are not bothered about it. For example, no. Suppose you say you take this Tamil Nadu Metro Transport Corporation. Nothing but, for example, Chennai Metro Transport Corporation, metro buses, right? Suppose you take Indigo Airlines. They have, let's assume, some 500 flights. They operate so many routes across India. Tell me, flight management software will be there. They'll have something called flight management allocation software. Which flight, at what time, to which route it should allocate. How many employees they have. In which flights they need to work. They will have a system for that. It's a control. These are operation controls. We call them as what? Operations control. Is this relevant for auditor? Exactly. What is relevant for auditor? Financial controls. We are mainly concerned about financial controls. Controls are three types: operating controls, financial controls, compliance controls. What are they? Compliance controls. We are worried about financial controls generally. We are not bothered about operating controls and compliance controls. Easy. Next. So this is about understanding and documenting. Straight away, a 5 marks question, many times asked. Every question in this chapter has been, every topic has been tested in past. Clear? All of you? Next. What are various types of controls in automated environment? Within automated environment, what are the types of controls? Controls are two types broadly. General IT controls, application controls. What are they? General IT controls and application controls. Then third category is there something called IT dependent controls. These are actually manual controls. IT dependent control. Okay, I'll come back to it later. General IT control means what? General IT controls means what? For example, no, bank is there. Take bank itself example. The employee cashier is there. He has a control. Cashier can access only to a particular data, okay, and he can only do these changes in that particular application. This is an application control. There will be so many application controls will be there. Best example, in your phone, you imagine, okay, for example, you want to put a password for your phone so that nobody can access it. That's a general IT control. That is a general IT control. You make sure your phone is not, like, physically the phone is stored protected with you, in the sense you make sure it is always with you. You make sure it is not displaced anywhere. That's a general IT control. Are you getting? These are all general IT controls. Basically, password protection, system updation regularly, you're updating software, you're taking a backup. These are all general IT controls. This is general for every organization. Application controls. Every organization will have their own application controls. Every organization. For example, some of you might have password for gallery. Some of you will have password for deleting. Some of you will have password for file access. Within the phone, for each and every application, you might have implemented some specific controls. These controls are called as what? Application controls. More clearly, the example which I told, password is there, right? That's an access control. What is it called as? Access control. More clearly, it's a logical access control. Suppose you're not keeping, you're making sure a phone is here. Suppose you kept a phone here, nobody can take it. That's a physical access control. You're ensuring nobody can physically access it. Even if somebody physically access it, they logically cannot open it. That's a password protection, logical access control. Like that, there are so many types of controls in IT. So these are popularly classified into two types: general IT controls, application controls. For example, I'm an outsider. State Bank of India is using core banking software. I'm a hacker. I want to hack that software. By default, State Bank of India general IT controls will prevent me. I can't access. I can't access core banking solution software. Even whatever the way I try to hack, I can't hack it, because many layers of firewalls were there, many protections were there, many antivirus softwares and all were there. So we can't hack the data. That's general IT control. Even if at all I hack the data, even if I get access, somehow I logged into the core banking solution, I can't do anything. Each and every application inside core banking solution has their own controls. Only when an employee log in, only he can do something. There will be passwords for everything. These are called as what? Application controls. Able to understand? Fine. So policies. For example, in another application control, that's okay. It's enough. I think that's more than enough. General IT controls, these are the policies and procedures which support effective functioning of application controls. If applications has to run smoothly, you need to have a general IT control. Correct? Huh? If class has to run smoothly, security guard has to be proper in his duty so that he will not allow anybody to enter inside. Able to understand? So general IT controls support effective functioning of application controls, not vice versa. Remember, an application runs smoothly only when a virus attack does not happen. Virus attack should be prevented. That's a general IT control responsibility. Able to understand? Next, these concept of general IT controls applies to every kind of architecture, mainframe architecture, mini-frame architecture, end user environments, everywhere. Okay. Next, purpose. Main objective of IT, general IT control is integrity and security. Data has to be maintained integrity. Nobody can change it. Nobody can access it. System security, data security, data integrity, system integrity. That is the objective of general IT control. Able to understand? Now, what are the components? General IT controls, no, it has 4 types of divisions. Generally, 3 are very popular. These 3 are very popularly recognized. These are very popularly recognized. So, data center and network operation controls. What are they? Data center and network operation controls, program change controls, access security controls. Remember I told you access is only to very few. Ensure authenticated and authorized access to programs and data, covering like data security policies, data security, physical security, everything is part of general IT. You look into any, like I'll just tell you, you watch this video once. Google data center, there are videos on the YouTube. Google data centers, you just watch that video, you will understand. You know, inside the data center, to go Google data center, it takes lots of time for anybody. It's not that easy. Only an authorized person will be entered inside. So what if somebody can jump the wall and come? No, they are all non-climbable wall, non-climb, you know, you can't climb the wall. They are like rivers. Iron walls will be there, electric fencing will be there, 9 feet will be there, each and every wall. I mean, each and every entire, it's a fencing, electric fencing will be there, non-climbable. Getting it? So nobody can climb also. What if somebody with a very big vehicle try to intrude? It's not possible. Everywhere barricades will be there. Surrounding the entire database, data center, Google data center, they'll have barricades everywhere. The moment somebody intrudes, the barricades will open, so that nobody can even come close to the data center. Even if somebody enters inside the data center, the data center is wall, like iron protected, metal doors, metal systems will be there. You can't enter inside without a password. Password only without order you can't enter. Even if you enter inside, data rooms will be there where softwares will be stored. That also you can't. 6-layer security. 6-layer securities will be there. These are physical, logical, both. Physical access, logical access, both. This is access security controls. We call them as what? Access security controls. Program change controls. Even if at all, suppose in your phone, no, in Apple phone, for example, you take, or Android you take, you want to install software, you can't install. In I think Android also, it will ask password to install. Sometimes you can enable that. Whereas in Apple, by default, it is enabled. Okay. In Apple, no, I have to give my, you know, facial recognition, or I need to type my password if I have to install an application. So even if somebody opens my phone, even if somebody unlock my phone, they know password, they can't install anything without a password. Without a password, without my like facial recognition, they can't install a password. Yeah, I mean, they can't install a software. So this is called what? Program change controls. No, nobody can change any program. General IT controls, one of the component is program change control. This program change controls ensure what? Modified systems still meet our objectives. Like if a system is modified, it is still meeting objectives. What does it mean? Modifications are such that objectives are always met. So modified systems meet financial reporting objectives through change management process, including tracking and testing. Any process, if at all you want to change the system, it has to be done authorizedly. Only then the system will work even as per the objectives of the enterprise. And system development and maintenance controls. Ensure systems are developed, implemented. Ensure systems are developed and implemented to meet financial reporting objectives. Activities like project management, testing, quality assurance, everything. System development, system testing, system maintenance, system implementation, system maintenance, system upgrading, everything. System development and maintenance controls, we call them as system development and maintenance controls. This is also called as SDLC controls, system development lifecycle controls, that is also called as. Then data center and network operation. Data center controls, they ensure production systems meet financial reporting objectives. Activities like computer operations, batch job execution, backup, storage, and performance. They cover plans like BCP, DRP for recovery from failure. Ensuring production systems meet financial reporting objectives is which of the following component? Data center and network operation controls, MCQ. Computer activities, computer operation, job execution, performance monitoring, BCP, DRP, they are part of which controls? Data center and network operations control. Ensure that modified systems still meet financial reporting objectives through change management process. The moment change management, program change control. Access, security policy, data security, physical security, they're talking about access control. System development, system implementations, testing, quality assurance, they are system development and maintenance controls. Remember, MCQs might come. Are you clear? Even in the recent exam, this was Jan 25, a 2 marks MCQ came on production system related point. Are you clear? All of you? Now, characteristics of general IT. They mitigate IT risks across multiple systems. It's not about a specific system, generally across multiple systems. These are called as indirect controls, also called as pervasive controls. We sometimes even call them as ELCs, entity level controls. We sometimes call them as what? ELCs, entity level controls. Then the other type of control is application controls. These are the controls which are implemented at business process level. These are the controls which are implemented at what level? Business process level, to ensure data completeness, data accuracy, data integrity. These are embedded in the IT systems such as ERPs. Application controls. Suppose bank manager only will have access to customer ledger. If at all any changes has to be done, only he can do the changes. These are application controls. To this application, customer application, nobody can access. Others cannot access. Others cannot change. These controls are called as what? Application controls. Okay, so application controls are something like automated, or they may be manual. Application controls can be either automated controls or manual controls. At what level? At a business process level. At a business process level means what? At an accounting level, at a production level, at inventory storage level, at a production process level, it will be implemented. These controls, billing system related controls, accounting related IT controls, these are all application controls. For example, I want to make purchase order. A company want to purchase goods from some third party. The third party must be approved party. Only with him you can place an order. That's an application control. Through application we are controlling purchasing system, purchase system, inventory, billing. Only when inventory is billed, sale can be entered in the journal entry. A sale register will get updated only when the billing is completed. That's an application control. So these are the controls which are implemented at business process level. Whereas general IT controls are those controls which are implemented as a whole, effective functioning of application controls. See, my billing system and all works correctly only when a person who has access to that billing system works on it. Anybody can open in the system. Billing system will fail. Yes or no? That's it. Then the third type of control in automated environment is IT dependent control. IT dependent controls. Like what is IT dependent? For example, a bank has to calculate provision every quarterly once or yearly once. For example, as on 31st March, they need to calculate provisions on NPA. The provision is calculated by system, but still bank manager has to verify whether provision has been correctly calculated or not. So here, provision amount ultimately comes in the P&L account and balance sheet only after branch manager approves it. The bank manager only has to approve it. Yeah, this amount is correct. Why? IT dependent control, for more accuracy, for better accuracy. Here, provision amount is calculated by system. You take that report. You are once again checking it and then approving it. Then only in P&L financial statements which is given to public, the number will be shown. This is IT dependent control. Like it's a control manually done. It's a manual process. but we are using what data? System generated data. Are you getting it? So manual IT dependent controls are nothing but manual controls which are relying upon data generated by, produced by IT systems. Okay, for example, no, tell me whether system is working effectively or not. Who should check? Manually. This is an IT dependent control. So design and effectiveness depends upon reliability of source data. Require general IT controls to ensure effective. IT dependent controls require general IT controls to ensure effectiveness. How do I know general IT controls are working effectively? A manual process has to establish. Somebody has to be appointed. They should check all that. That's a control. Somebody has to do some process, means it's a control. Control means, I told once, it's a process, it's a policy, it's an instruction, it's a guideline. Able to understand? So that's it. These are IT dependent controls, where manual IT dependent controls are basically manual controls where they use data generated by IT systems. Yes or no? Design and effectiveness depends upon reliability of source data. How IT dependent controls are they effective? Depends upon the data, source data. IT dependent controls requires general IT controls to ensure effectiveness and reliability. If general IT controls are effectively working, IT dependent control will also be effective. Are you clear? Basically, IT dependent control is a manual control. It's a manual process. Okay, that's it. What is the relationship between these controls? A 4 marks or 3 marks question. General IT controls, application controls, they both are interrelated. Agreed? General IT controls, you know, what is their duty? They support functioning of application controls to ensure ultimately completeness and accurate system processing, information processing. Correct? That's it. These are controls. Many times they have asked a 5 marks question. You know, they will ask you what are general IT controls and what are its component, and also explain application controls. Or they may ask you, there are various types of controls in an IT environment. What are various types of controls in an IT environment? 2 types mainly: general IT controls, application controls. A third one is actually a manual control, but still let us classify IT dependent control. Okay, if they ask you a general question, no, you can simply write these side headings: data center network operation control, program change control, access security control, system development and maintenance control. Meaning general IT control 4 points, then application controls, IT dependent controls. Enough for 5 marks question. Sometimes I'll ask you what are general IT controls, what are components, then you need to write full answer. Understood? That's it. So this is about, you know, IT related stuff. Okay, still we have 2 or 3 more concepts. Once that is over, once this is over, automated environment topic will be over. Now, how can you test? How can you test in automated environment? Testing means what? Audit procedure. How can you verify? How can you test whether an IT system is working correctly or not? Very simple. I will inquire management first. I'll inquire them how it is working. I will observe how it is working. I will inspect log register. You know, whether a system is running correctly or not, I will see past record, log activity, or I will reperform. I will operate the system. I will try to enter wrong transaction, see whether system is accepting or not. Able to understand? So these are the testing methods. Many times asked. What are the methods? Various audit testing methods are used in automated environment. A simplest method is what? Inquiry. How do you test whether company control environment, whether IT controls are working effectively? Ask management, they will tell you. But tell me, will you get effective evidence here? No. Inquiry is least effective. Where you will get more confidence? Re-performance. Okay. In terms of effectiveness, re-performance is most effective. But tell me, where you can quickly complete your work? Inquiry. Inquiry is most efficient, but not effective. Whereas re-performance is most effective, but not efficient. Because re-performance means you need to check each and everything by testing. It takes time. It is not efficient method. But most efficient method where you can quickly get a knowledge about it is inquiry. But it's least effective. It's most efficient, but least effective, because evidence is not that reliable in inquiry. You asked management, is system working effectively? They said yes, sir. Will you believe them directly? So inquiry is the most efficient audit test, but inquiry alone is not sufficient. It must be combined with other methods for reliability. You know, inquiry in combination with inspection, anyhow we'll get that point later. Okay, combination with inspection provides the most effective and efficient. So inquire them. They said system is working correctly. How do I know it is working correctly? Show me past records. I will see what system is designed, how the system is designed, how it is actually performed. I will generate a report and see. Exception report we will generate something called exception report. Is the system failed? Somebody failed the process, somebody failed to comply with their process. I will generate something called exception report. Are you clear? Observation means what? Observation involves, involves observing users as the process transactions under different scenarios. So when they're processing transaction, how billing system works, I'll go and observe. In DMart, I'll observe the employee how he's billing. That's how I understand whether the IT system is correctly working or not. Only when all the items are billed, only when he pressed the cash button, the drawer opened for collecting cash from the customer. Yes or no? Until he pressed cash received button, it's not. Suppose if the DMart person, he pressed credit card or UPI, drawer will not open. These are controls, right? Cash drawer. You go to billing system, Big Bazaar, anywhere, Sarvana stores, you go anywhere. Only when after everything is billed, only when they press cash, below cash lock box will open. Otherwise cash box will not open. Suppose they accidentally close with the cash box. Say, madam, like some change they forgot to give you. Sir, kindly wait for 1 minute, sir. Next customer will bill, that time it will open. Okay, then we will give you the change. That's a process. Are you getting it? I don't know how many of you observe this. So this is how many controls were implemented. Okay, next. Observation. Observing users as the process transactions under different scenarios. Through observation, you will get some evidence. Okay, system working effectively or not. Inspection. Inspection involves examining application configurations, verifying system logs, verifying user manuals. I can see any changes made since last time audit testing, last time we tested. So from then what changes were there in the systems? I can see the log activity. I can see user manual, how to use the system, what is the system log. I will see application configuration, reperformance. This provides best evidence, but it is time consuming. Conduct test checks and observe error message. Especially we will try to do negative testing. What is negative testing? I will try to enter data something wrong. I will see system accepting or rejecting. System rejected means system is working effectively. Are you clear? So there are 4 testing methods: inquiry, observation, inspection, reperformance. Clear? Now, which method auditor has to use? It's a professional judgment, correct? So application of audit test depends upon factors such as risk assessment, control environment, desired level of desired evidence level, desired degree of assurance, and complexity. Which method of audit test, which audit test auditor will use? It depends upon so many factors. It depends upon risk auditor assessed. Generally, if at all we perceive high risk, which method we use? Reperformance. Control environment. Control environment means the entire system is effective. I may simply go with inquiry, inspection. What is the level of confidence? The more degree of assurance required, more degree of assurance you require on the effectiveness of IT, reperformance. Complexity of the business. The more it is complex, I may stick with inquiry, observation, and inspection. So what are the key points to consider? Understand how a transaction is processed end to end. Suppose if a company want to purchase goods, how first of all they are thinking to purchase, till how they are making payment. End to end process. Review application configuration to ensure compliance. Examine logs to identify changes since last audit testing. Identify the logs. Review user manuals. Perform test check and observe error message. So this itself can be asked as a 4 marks question. Which test auditor has to perform is a matter of professional judgment in an automated environment. Okay, write about various testing methods and what are the points that auditor has to consider while designing his testing methods. They may straight away ask you this as a 4 marks question. Clear until now? Next, what are the characteristics of manual and automated elements in internal control? Manual element, automated element in internal control. Okay, some controls are automated, some controls are manual. Generally, everywhere automation possible or not possible, especially unusual transactions, non-recurring transactions, high value transactions. I can't automate it. Yes or no? For example, when manual controls are useful, this was asked in one of the exam. When manual controls are useful, tell me where it is useful. How do in suppose no, I need to check whether IT system is working effectively. Can I implement another IT system to check it? Whether a robo is working correctly or not, who should check? Exactly. Monitoring effectiveness of automated controls. For monitoring effectiveness of automated control, manual controls are only useful. Only a man can check whether a machine is working correctly or not. Whether a machine is working effectively or not. Can I put another mission? You should check this mission accuracy, no then. So ultimately, whether a mission is working effectively or not, only manually only we can verify that. So manual controls are useful for monitoring effectiveness of automated control. Situations where errors are hard to define or predict. For example, that's when I see, you know, when you once you make an exam application, somebody will screen and then approve it. Exam application, there is no problem. Registration, you want to apply for CA course registration, system will not give you registration directly today. At back end, somebody is verifying it. Why? What if you generated a fake 12th mark sheet? Are you getting it? If at all system is directly giving you registration just like that, many even without 12th registration, even without 12th clearing, many will register into CA course and then start writing the exam. Yes or no? So situations where errors are hard to define or predict, what kind of errors and frauds will come, if we don't know exactly, there manual supervision must be there. Unusual transaction, non-recurring transactions. For example, no, customer want to return the goods. I don't have power on the system. System may not return the goods. System may not have the software to return the goods. Or a customer want to build 1000 units at a time. General our system, no, it has only 3 digits permission. If I want to accept 4 digits, system is not accepting the sale. System is not accepting the sale. Unusual transaction, non-recurring transaction, there manually we have to do. Changing circumstances needing controls beyond existing automated. Frequently changes in the processes. Frequent changes in laws and regulations that affect the way we do business. Their automation cannot be done. Able to understand? So these are the cases where manual controls are used. So what is the impact of manual control? What is the impact of manual element in automated? In an automated environment, how manual controls manually they will impact? Manual controls are suitable for scenarios requiring judgment and discretion. The system will not have a judgment and discretion. Wherever judgment is required, manually only it can be done. But you know, there are some limitations of manual controls. Manual controls have so many limitations. That's why we are automating. What processes we automate? Processes where judgment is not required, discretion not required, less judgment is required. Yes or no? Standard operating practices, we can automate it. Manual controls are less reliable than automated controls due to possibility to bypass errors, inconsistency. Correct? Manual controls are less reliable. Why? Somebody can bypass. Errors will be there. Consistency will not be there. You know, in a system you apply totaling. Suppose 100 amounts you total, 100 amounts you kept, 100 cells you filled with some number. Formula you, every time you give same number you'll get. But if I ask you to manually calculate the total with a calculator, you will definitely do wrong. 100 times I asked you to do. Will you do 100 times exactly accurately same way? No, exactly. So manual control is not suitable when high volume is there. Recurring transaction, it's not a non-recurring, it's a recurring, where automated controls can prevent activities where specific process can be adequately, like some processes we can easily automate. See, gathering student application, analyzing basic data of the student, all that, yes or no, that you can automate. But whether to grant him membership number, whether to grant him SRO number, student registration number, NRO registration number of the student, should we grant it or not, that manually has to be done. Able to understand. So this is a limitation of manual control. They might ask you many times, ask 5 marks question, what is the impact of manual element in automated environment? What is the impact of manual element in automated environment? What is the impact of manual element in automated environment? Clear, all of you? Now, so what are internal control elements? Internal control system will contain both manual elements, automated elements. These elements affect transactions, the way they are initiated, transaction recording, transaction processing, transaction reporting. So how a transaction is initiated, processed, recorded and reported. Not all this is done automatically, not all this is done manually. Some of them are manual, some of them are automated. For example, reporting might be mostly manual. Processing, recording is automated. Initiation again manual. Anything it can be there. Next, manual controls like approvals, review, reconciliation, follow up. These manual controls operate independently of technology. Correct? Manually, technology is irrelevant. Without technology, I'll operate. Use IT information. In a manual process, no, we may use system generated information, and we monitor IT and automated controls. IT controls, everything is monitored by manual controls. So no, automated controls means what? Using electronic record to initiate, record, process, report, transaction, replacing paper document. Getting it? So some electronic record I will use to initiate a transaction, recording a transaction, process and report the transaction. For example, a bank, no, quarterly they are crediting interest amount to customer account. Is it manually done or automatically? Automated. So no, that's it. Suppose no, to a customer loan has to be given. Up to some amount of loan you can automate. Like many applications are there today in the market where you apply for loan, system only will do analysis and then give you loan. But if you want to apply for a bigger loan, manually they will do. Are you getting it? So manual processes are suitable at somewhere where it is not unusual amount, non-recurring, high value. At all these cases, manually they will do. Able to understand. So characteristics of manual and automated environment, or they may ask you what is the characteristics of internal control. Characteristics are very simple. It might have a manual and automated. Manual controls, for example, approval, customer loan application approval, manual I have to do. Reviewing customer, reconciling physical inventory matching with this, something manually can be done. Follow-ups, if customer is not paying EMI, manually only we can follow up, system cannot follow up. So no, operate independently of information technology. Manual controls operate independently from IT. They use system generated information. Manual controls monitor IT and automated controls. Whereas automated controls, no, they use some electronic record to initiate, record, process report. Suppose a customer made an application through some application, loan application, he applied for a loan, they process customer PAN, CIBIL score, everything, and they initiate and record and report transaction, replacing paper documentation. Able to understand? And what is the impact of manual element in IT? Like how manual elements are impacting in automated environment? This answer you need to write. Easy. MCQs can be tested in any way, be careful. Next. So what is the audit approach? Actually here we are supposed to, if we remove the question, we should keep this as a concept number, but it's okay, no problem. So what is the audit approach in an automated environment? What is the audit approach? First we do risk assessment. In an automated environment, what we do? We do first risk assessment, we understand the system, we test operating effectiveness, then we do reporting. Risk assessment, understanding the system, testing operating effectiveness, and then reporting. Reporting, for example, we will evaluate control deficiencies. Main objective is what here? We evaluate whether are there any control deficiencies in IT systems. Are there any controls which are deficient? Are there any significant deficiencies and material weaknesses? Remediation, can we apply a remedial action? Internal control memo or management letter, which is also called as letter of weakness. How do we report weaknesses? Suppose we identified system has some problems, we should report to management. No, there is a standard called 265 which says that communicating deficiencies in internal control to the management and those charged with governance. Deficiencies are two types: normal deficiency, significant deficiency. Normal, tell to management; significant, tell to those charged with governance. That's what 265 standard says, which we will discuss little while later. Are you clear? Then auditor's report. So they may ask you this itself. Actually, it's part of diagram. Till now, they have never tested it, but I'm just cautioning you. Write about reporting in an automated environment. They may ask you, write about reporting. One of the important step in audit approach in automated environment. What are they? Where you evaluate deficiencies, identify deficiencies, remedial actions through internal control memo or management letter. You will report, and finally you will give audit report. That's it. Testing in automated environment, you must do nature, timing, extent of, you must decide SS NT of controls testing. You need to test the controls. SS reliability of source data, completeness of population, testing key reports, sample testing, consider competence and independence of team. Document understanding of the business process using flowchart or narrative. Prepare risk control matrix. Understand design of control by performing walkthrough test. Process wide consideration for ELCs, entity level control, segregation of duty. Understand IT general controls. Understand IT application controls. You see, documentation we saw, correct? Documenting which software they are using, which version they are using. One table we saw. Yes or no? Prepare risk control matrix. IT risk you identify. Identify the what are the controls. Understand IT general controls and application controls. Understand design of controls by performing walkthrough test, like how exactly the purchases are happening, payments are happening. Walkthrough test, right from the first step to last step, what are all stages involved. These 4 points enough. Risk assessment, identify what are significant accounts in the company. See whether consider qualitative and quantitative. Relevant financial statement assertion, identify sources of misstatements, consider risk arising from use of IT system. In this, no, mainly understanding and evaluate and reporting. These two enough. Reporting. Actually, this diagram nobody will discuss, but just briefly I covered. These two enough. These two are enough. Next, data analytics and digital audit. Data analytics and digital audit. So, yeah, okay, we'll do one thing then. We'll take a break and get back. Then we'll finish this topic. And then, so data analytics, digital audit, assessing and reporting findings. Assessing and reporting findings is there, right? Here itself, we will discuss 265 standard also. We will discuss 265 standard here itself. Okay, so it will be over. So once this is over, IFC topic I will discuss. Then preferably I will discuss 320 materiality and 450 standard. That's it. Majorly it will be over. Okay, yes, that's it. So we'll take a break and get back and then continue discussion on this. So not complicated, no? Yeah, moderate. Yeah, let's continue the discussion in digital risk assessment chapter. We are discussing automated environment, right? Just I'll show you something that we are developing. Okay, for example, in CA inter audit and CA final audit, in everywhere, in every other subject also, what we are doing is we generally don't like to promote any kind of chart materials. First of all, that's a complete wrong way of learning. You can't match exam stand. If you directly learn from this chart book, 99% you will fail. This is only a complementary nature. Okay, this is only a complementary nature. This is again not for day before exam revision. Once the concept is over, if you want to understand what we discussed in the concept, I tell you, right, summarizing. For summarizing purpose, this chart. Many will recommend this, use it for exam because everything is clearly covered. But I will never recommend this for exam. I only recommend the notes. Whatever the GOAT notes that we are discussing, right, classroom color notes, that's enough. That is only important for exam. But once you study entire CARO, for example, in CA audit report chapter, we have a CARO, right? You want to see once at one place, once you want to quickly recap. There it will be useful, simple. For example, you say fixed assets, properly maintained. Physical verification at proper intervals. Discrepancies, dealt in books of accounts. Title dates, is it in the name of the company? Revaluation, revalued, registered value, change more than 10%. Whether any proceedings, this is just for recollecting what is there, for better mind mapping purpose. But this answer, if you write in exam as it is, you will not score. You need to write full sentences. Understood? So for descriptive purpose, this will not be useful. Like this, we are developing for every chapter for all lengthy topics. For example, 21st clause is there. All lengthy topics we are developing this. Wherever, for example, we have risk assessment topic. For entire risk assessment chapter, probably I might implement flowchart because it's a lengthy topic. Sampling topic is there. We will have a flowchart. We will have a chart book. So wherever lengthy topics are there, to give you a whole perspective of the topic, only for that reason, a chart book will be given. So this kind we are developing now. So mostly for May 25 exam, if at all somewhere else is also ready, I will be using this day before exam for revision, from 2-3 at least. But for September attempt, this will be fullest. This will be available to the fullest. Okay, so that's what we are doing next. Anyhow, so data analytics. So what is data analytics? Typically, we are working very harder than students. Students, if at all they study like what we do, they get all India first rank directly. They hardly work 8 hours, 9 hours, 10 hours, but we work 12, 14 hours. So data analytics in audit. So what is data analytics? Very simple. I told you analytical procedure, remember? Analytical procedure, that's nothing but data analytics. There are so many employees were there compared to last year. Last year 100 employees were there. This year it is 200 employees, but business turnover is same. So you can understand either employees are used inefficiently, or there might be a dummy employees, or there might be a suppression in sales. Some analysis you might get. The analyzing data analysis means what? Data analytics means what? Analyzing the given data. Suppose a company has a sales register. It's just a data. Sales register is a data. What sales register will contain? Date, invoice number, party name, amount, what goods sold, how many were sold, at what time it is sold. That's it. That's the sales register. But you can analyze the register. What you can analyze in the register? Month wise, how many sales? Which month has higher sales? Which product is having higher sales? Which date sales are high? Weekends, how the sales are? Normal days, how the sales are? Who is our major customer? Which is our major product? From which state we are having more sales? Which buyer? I mean, what is the geographical location sales? Same sales register. But see how many types of analysis you can do. At which time orders are more? Evening time orders are more, or morning time orders are more, afternoon times orders are more. We launched some campaign. After that, how the orders were received. Before campaign, how the orders were received. After discount, how the orders were. Before discount, how the orders were. To analyze patterns. Data analytics is nothing but analysis of patterns. Okay, so analyzing the data, how various our decisions are impacting the business. So our decisions we are analyzing through data. That is called as data analytics. This is a very important tool. Data analytics, data science, like the data research. So that's a complete altogether different domain. Okay, so this is something which AI cannot replace. Of course, AI can give you different types of analysis. You give a sales register to ChatGPT, it will give you what are all various types of analysis. Today there are many visualization tools, data visualization tools, Power BI, like that some visualization tools were there. So you give data to it, it will give you a super flowchart picture about your company, but it can't take a decision. You need to analyze the data and take a decision for a better, meaningful results. Now, data analytics for audit. Companies benefit from data analytics through increased profitability, better customer service, competitive advantage, and efficient operations. Companies benefit from data analytics through increased profitability and better customer service, competitive advantage, efficient operations. Then data analytics. What is a data analytic exactly? It's a combination of various processes, combination of tools and techniques to extract meaningful information from vast amount of data. It's a sales register data. Meaningful result. Which quarter we are selling high, which month our sales are high, which product we are selling high, in which geography we are selling high, at which time sales are peak. Able to understand? So that is data analytics. For example, I will show you YouTube analytics. This is YouTube. Like if you see the backend, data analytics. For example, you see analytics. Okay, you see analytics. For example, last 28 days, Income tax marathon, I have some 54,000 views. So my car related video is there, so that has 45,000 views. Audit marathon some 39,000 views. GST marathon some 27,000. Last 7 days, this is the picture. Last 28 days, this is the picture. Again, if I open income tax marathon, for example, okay, based on that marathon, we got 310 subscribers. Like those who are watching that marathon, while watching that marathon, subscribed. Okay, and many of them are many auditing students also were there. Now you see engagement. Each student, each time when a person open this video, on an average they watch 12 minutes. Generally in online, 10 minutes is the benchmark. If you're able to hold a person for 10 minutes or more than 10 minutes, that means your video is performing good. Able to understand? 12 minutes. Because after 12 minutes they'll be taking break again. Again they'll be getting back, again watching for another 12 minutes. Number of views is different from number of viewers. Views are not equal to viewers. For example, viewers, I'll show you. Audience. Unique. How many till date? Number of students or number of viewers who watched this video, only 24,000. But video views are 88,000 views. 88,000 actual views are 88,000. Okay, so 23,000 only actually viewed. Returning 20,000 viewers are returning, means these people frequently return back to this video. 20,000 students are watching the class. Able to understand? These are returning viewers. Now you see what is the age group and what is the percentage, and you see how many of them subscribed actually. 20,000 students plus they're watching, right? Only 53% of them subscribed. 46%, exactly almost 50% of them without subscribing they're watching. You're getting it? So, and revenue generally zero. I will not have any revenue because my YouTube channel is zero. I don't monetize at all. If I put revenue, more advertisements will come. More advertisements come, students learning will affect. Already even now also you'll get advertisements, but lesser. Generally, if you have monetization on, more will be more advertisements will come. So that's the reason we switch off every video monetization. I don't monetize at all. Almost all my videos, if you see, we don't monetize at all. Example, I think that will be there. And you see estimated revenue some 5,000 rupees only from last 28 days. Nothing, because monetization is off. For very few videos, very long back which I uploaded, that time some 2 or 3 videos have monetized, that related one. So most of our videos are not like on, like they're not for monetization, real time. Last 48 hours, how many were watching? Last 60 minutes, how many views were there? Okay, you can see many types of analytics, and I can understand which video, like I can also get, this particular video, right? How's to, from which source we got this. I'll show you this. This is even more, like directly on the YouTube search, 1200 students found, 1200 views were found directly. The people searched income tax, 1200 direct views are coming from their voluntary search through browse features, through other features, playlist. So through external links. External links means what? Either on Telegram or WhatsApp. Somebody shared this link and there they clicked, and then that's how they came to this video. They give you this much analysis, so you understand where your audience are coming from. Actually, this is only mobile app related one. Desktop website is there, web backend is there. There you can see even state-wise information, more detailed information you can see, even more in-depth information. Which videos these people are, who are watching my class, right? What are the other popular videos which they are watching? While watching which video, this video got recommended. Able to understand? So I will get entire sort of analysis. This is how YouTube analytics. This is data analytics. Content creators use this as a lot. And again, you see, I'll show you at what time audience will see mostly. That also I'll show you. You see on Monday at what time? You see the thickest means that is the time when they're active. Okay, thick pink. Okay, you see morning times and all dull. Evening you see 6 o'clock onwards it's brightest every day. Whereas you see Sunday, you see the Sunday pattern is different from other days. Monday you see only evening people will see. Monday, Tuesday, Wednesday, Thursday. Friday onwards weekends, right? Generally Friday you see even daytime also there are some views because they'll be free. And again, this is one analysis. Again, how many of my viewers are using mobile, computer, tablet, TV? Through TV, how many are watching through TV? And what is the age group, gender, as I already showed. Okay, again you see Here geography, state wise were there, right? Okay, obviously for every channel some other states related will be there, pakka, some random click might come. Okay, so within India breakup we can see that in desktop. Okay, in actual, again, content creators, those whose job podcasting they do, right? Content creators, many, yes or no? Podcasting, for them it is useful. For us this much analysis is not relevant also. For us, what, like, for us we just upload the video at right time, that's enough. So whether the video is performing better or not, we'll see. If at all the average duration for a marathon is more than 10 minutes, that's a successful marathon. That's what the benchmark. Getting it? Yeah. Next. Because no, imagine hooking up a particular viewer for more than 10 minutes is not an easy task, because he's at voluntary state. It's not like you in class. In class itself, many students will deviate after 20 minutes. Generally. Again, they have to come back. Beyond 45 minutes, a student cannot focus attentively. Definitely a break is required for productive focus for the next 45 minutes. Maximum 1 hour. You can hold attention maximum 1 hour productively. So that is data analytics. Understood? So data analytics means this data analytics can be applied everywhere. Consumer behavior, sales pattern, purchases pattern, everywhere, production pattern, everywhere. Electricity consumption pattern, so many. So data analytics is a combination of processes, tools, and techniques to extract meaningful information from vast amount of electronic data. CAT. Tools and techniques used by auditor to analyze electronic data from obtaining audit evidence. So CAT. So CAT are nothing but tools and techniques. CAT tools are nothing but the software. Data analytics means what? Using the software we analyze the data. Data analytics means what? It's a process to extract meaningful information from data. Tool means what? CAT means what? CAT is nothing but computer assisted audit techniques or audit tools. These are nothing but the tools through which we do data analytics. Data analytics means what? Using the tools we analyze the data. Tools means what? Using this to analyze the data. Yes. Tools and techniques used by auditor to analyze electronic data. What is the significance of data analytics for auditors? Obviously, auditors have to understanding the entity and its environment. Means what? Data analytics. So the auditor can use data analytics in audits for testing electronic records and IT systems to achieve the following. Auditor can verify completeness of data and population for control testing, substantive testing. For example, no, whether all the purchases are recorded. I can see purchase order register. Purchase order register has 1200 orders. Company recorded in purchases only 1150. What about remaining 50? So whether purchases are completely recorded, I can analyze data and then tell you. So no, next, for using sampling, random sampling, systematic sampling, we can use sampling techniques and then analyze the data to reconstruct a trial balance from transaction data. Okay, data analytics can be used for this. For performing mathematical calculation like depreciation, bank interest calculation, I can download from bank, all the loans outstanding, and I apply the interest rate and I can calculate and see what is the real interest amount bank debited, how much bank accounted interest, and I will calculate and see how much they accounted. To analyze journal entries as per 240, MCQ might come. Analysis of journal entry, under which standard it is discussed, 260 or 240 or 250 or 299, they'll ask 240. Be clear. Analysis of journal entries as per 240 to identify fraud risk. 240 standard deals with fraud, so fraud risk related. And use tools for fraud detection and investigation. So where and all auditors will use? They will use for completeness check, they will use for audit sampling, they will use for recomputation, they will use for mathematical, they will use for journal entry analysis, they will use it in fraud investigation. There are so many places where data analytics will be used by auditor. Are you clear? Next, digital audit. What is digital audit? Entities are adopting digitizations to stay aligned with evolving business environment. In CA final we have a full chapter on that, a 5 marks chapter in CA final, digital audit chapter. So digitization, entities are adopting digitization to stay aligned with the business environment. New technologies are transforming operations and traditional business models. Automation plays a central role in driving digitization. So auditors integrate digital technology through the audit process, from planning the audit till expression of the opinion. Key technologies. What are the key technologies that we also can use in our audits? Artificial intelligence. We are using now ChatGPT. We are also using in our classes, or no? data analytics and other latest technologies, they help the auditor to understand the business in a better way. And these tools enhances audit quality and allow the auditor to focus on high risky areas. Digital audits enable better risk identification using technology. That's it. Clear? So this is entirely automated environment. Now, once I study an entity automated environment, once I understand their controls, once I test the controls, I will generally identify some loopholes. In the company controls, I will identify loopholes. I will report findings in IT environment. SSN report findings in IT environment. SSN report findings means what? Communicating deficiencies in the internal control. Here it is internal control is which control? IT control. So communicating deficiencies in IT control to whom? Management or top management, as the case may be. Now look at the conclusion of an audit. Definitely some findings or exceptions in IT environment will be identified. So at the conclusion of audit, findings or exceptions in IT environment and controls must be assessed. Please assess it. Then findings should be reported to relevant stakeholders like management, top management, board of directors and audit committee. Next, obviously you need to apply judgment to assess findings based on various measures, quantitative and qualitative. Evaluate findings individually as well as in aggregating by combining with other deficiencies to know whether it is a significant deficiency. To know it's a significant deficiency. For example, no, very simple. See, in a company, right? In many companies, right? Purchase order plus GRN plus accounting plus finance. Okay, these four must be working perfectly. Order only authorized person can place. Okay, we placed order. We are receiving goods, right? This must be linked to PO. Accounts must be linked to GRN. Finance means payment. Payment must be linked to accounting. If these kind of integration is there, that's an effective procurement system. Okay, suppose no, let us assume purchase order and GRN is not linked, but rest all of them are linked. PO GRN link is not there. What is the risk here? You know, we ordered 1000 units only. Manufacturer, the other person might send 1500 units, might deliver 1500 units. He will give bill also for 1500 units. Our people also accept, because you know, when we order 1000, we are receiving 1500 delivery. What is the risk here? 500 units over delivered, risk of overstocking, risk of obsolescence. Yes or no? Long outstanding inventory clearance may not be on time, which might leads to damaged inventory or deteriorated inventory. Are you getting it? This is the risk. Okay, these goods are very durable goods, so even if they are outstanding for a long time in our godown also, not an issue. This is no doubt a deficiency. First of all, this is a deficiency. Array, you ordered 1000, how will you accept 1500? You can accept either 1000 or less than 1000. Array, I ordered 1000, 10 lakh rupee, they delivered 1500 and billed me 15 lakh, and our company also accounted 15 lakhs, paid 15 lakhs. There is no fraud risk here. There is no fraud risk here involved. And you know, order is only through the order is made only to the same vendor, approved vendor, not somebody fictitious vendor. Just that ordering quantity risk is there. This is a deficiency. Suppose vendor itself can be changed. Dummy vendor can be created. Placing order, dummy GRN can be generated because these two are not linked. Dummy GRN can be generated. Because of this, accounting entry will pass. Because of this, payment will go for a dummy transaction from a dummy vendor. This is also normal deficiency or significant deficiency. Exactly. Significant deficiency means if the magnitude and likelihood is so high, that's a significant deficiency. Are you getting it? Even significant risk also similar meaning, where likelihood of their occurrence and magnitude is so high, then we call it as significant risk. Significant deficiency, this we must communicate to those charged with governance. This risk is the right, this we can communicate to purchase department and goods receiving department, and then we will tell them to rectify. But if at all I feel this is also significant risk, then I need to communicate to top management. I will communicate them, and I will also communicate to top management. Are you clear? So auditor has to evaluate findings in IT environment. Findings, why you need to evaluate, what you need to evaluate? Quantitative findings, qualitative findings. Right now we found one quantitative 500 units were different. That is one finding. That's because of an error. Qualitative, system is not linked. Yes or no? Then evaluate findings, sometimes individually, or sometimes each finding may not be but that severe, but all of them put together severe. Okay, so combining with other deficiencies. Now question yourself, are there weaknesses? What is the impact of this weakness in the overall audit? Report deficiencies to management via IC memo, management letter, which is also called as letter of weakness. Communicate the deficiencies to management via internal control memo, management letter. You need to please make an observation that management representation letter is different, management letter is different. Management representation letter is management giving you. Here what is that? Management letter means auditor is giving to them. Management letter is actually, in reality, we call them as what? Letter of weakness. Management letter. Management letter means what? We are giving a letter to the management. Management representation letter means what? They are giving us. Management representation letter 580 standard. Management letter 265 standard. Be careful. Management letter is what? 265 standard. Communicate significant deficiencies in writing to those charged with governance. That's it. This communicating deficiencies, this is what 265 standard is talking about. Management letter, communicating significant deficiencies, these C and D points are nothing but 265 standard. We'll be discussing that. And auditor has to assess impact. The auditor must assess each finding or exception to evaluate its impact on audit. So assess the impact of each finding or exception. What is its impact on the audit? Deficiency. What do you mean by a deficiency? Okay, I understand you need to evaluate the deficiencies. What do you mean by deficiency? A control is not designed to prevent, not designed to detect, not designed to correct, or designed correctly, but implementation operation is failing. A control is not designed, implemented, operated to prevent, detect, correct. Why are controls? To prevent fraud. Okay, some fraud happened, mistake happened, to detect it, to correct it. Controls are there for prevention, detection, correction, but they're failing. We implemented some control, but they're failing. Security guard is there, but he's sleeping. For example, yes or no? A control is missing. A control is there, but not working effectively. The deficiency. Control itself is not there. It is also deficiency. Deficiency means what? Either the control is not working or the control is missing. Both are deficiencies only. Yes or no? That's it. So the auditor assess and report audit findings in IT environment. 5 marks question. The auditor has to assess and report findings in IT environment. So when you need to, at the conclusion of the audit, findings or exceptions in IT environment must be assessed. Findings should be reported to stakeholders, including management and all. Use judgment to assess findings. Evaluate findings individually. Are weakness. So key considerations. Are there weakness in IT? What is the impact of these weaknesses? Report deficiencies via management letter. Communicate deficiencies to top management. What is the impact? A control is, what is a deficiency? A control, actually originally how it is like, here it is not, here the word is not there. How it is there, right? A control designed, implemented, operated in such a way it is unable to prevent, unable to detect, unable to correct, unable to prevent, detect, correct. That's how it is. Or a control not designed to prevent, or a control is unable to. Better you write this word. A control is, you keep remove here, a control designed, implemented, operated, which is unable to. That is even more better. That phrase is even more better. Which is unable to prevent, detect, correct misstatements on a timely basis. Or a control is missing altogether. A control which is required is missing. That is also deficiency. Easy? Yes or no? That's it. Now we still have IFC and then SA 330. Once this is over, we will only have left with internal control topic in this chapter. Okay, I will come back to these three topics little while later. First we will finish 265. Pakka question will come. There is a high probability. Okay, we will first finish 265 and then get back. I will stop this recording, 2 minutes gap. We will continue in the next video with that particular 265. Okay, yes. So let's continue discussion on IFC. I told you, right, internal controls are three types. Internal controls are three types. One is operating control, financial control, compliance control. Compliance controls are those controls which are meant for complying with laws and regulations. That is the object. Financial controls are those processes which a company implement to make sure their books of accounts, financial statements are free from MMS. Operating controls are those controls where they mainly focus on efficiency in operation. Whether employees producing these many units every day, whether resources we are utilizing correctly or not, whether electricity consumption is properly or not. So these kinds of operational efficiency, these are monitored through some processes called operational control. Now the discussion is on IFC, internal financial controls. Yes or no? Now, what is internal financial controls? Internal financial controls are nothing but some policy. It's nothing but some procedure. Remember, SQC, quality control is also a policy and procedure adopted by a company to ensure internal financial controls are some policies, some procedures which a company follow for achieving the following objectives. 1. Safeguarding assets. Protecting companies' assets from misuse. That's why companies will maintain fixed asset register. They maintain a list of fixed assets. They will have asset identification, tagging will be there, so that the company periodically do physical verification in order to safeguard their assets. Then second one, fraud prevention. Ensure prevention and detection of fraud. Why purchase order? Why vendor master? Why all this GR and integration with purchase order, everything? Fraud prevention. Segregation of duty. Why segregation? Multiple people. Why they need to do? A single person can do everything, right? Why multiple? Fraud prevention. Accurate. Maintain accuracy and completeness of accounting records. Ultimately enabling timely preparation of reliable financial statement and compliance with laws and regulations. Now you see, safeguarding of assets and compliance. Safeguarding of asset is generally operating control. Legal compliance is generally a compliance. But we are discussing IFC, right? Financial controls, right? Even within the financial controls, you see, very simple. If a law and regulation is not complied, GST law, we did not interpret correctly. We claimed wrong input tax credit. It leads to understatement of GST liability. It may impact financial statements. Yes. So some controls were there which are both a compliance control and financial controls. Some processes, no, they're common. They are operating process, also financial process. Able to understand? Yes, sir. So internal financial controls have 5 objectives: safeguarding of assets and legal compliance. These are the 2. Remaining 3, you see, financial objectives. What are the financial objectives? Prevention and detection of fraud, maintaining completeness of accounting records, enabling timely preparation of financial reports and statements. Easy or not? Next, responsibility. Whose responsibility primarily for designing and implementing? Management. Directors and management are primarily responsible for implementing and maintaining IFC. Auditors have to evaluate the design and operating effectiveness of IFC. We just have to evaluate how the IFC, internal financial controls, are designed, how they are operating effectively. You know, in corporate world they were called as IFCOFO. IFCOFO, internal financial controls. You see, IFCOFR. IFCOFR, it's a very popular word in corporates. Internal financial controls over financial reporting. That's what. Basically, right now, the first entire part is IFC. This entirely is IFC. Now, under Companies Act also emphasizes effective implementation and reporting of internal control under Companies Act through IFC provisions. This IFC is used at some places in Companies Act. For example, 143 subsection 3 clause I. As per this, the auditor report must state whether company has an adequate IFC in place and whether IFC is operating effectively. Under Companies Act 143 subsection 3 casted a duty on the auditor, where auditor has to report on adequacy of IFC. The auditor has to report on operating effectiveness of IFC. However, this reporting does not apply to private companies where they are one person or small, or have a turnover less than 50 crore or have a borrowings less than 25. If any one of these condition is failed, IFC is applicable. The auditors have to give a IFC opinion. Sir, more about IFC we will have in CA final. Okay, next, under 177 also, audit committee must evaluate IFC and risk management system. Audit committee was given a duty under Companies Act where they need to evaluate internal financial controls. 149, independent directors must abide by code of independent directors. Their role includes integrity of financial information. They must ensure financial controls and risk management systems are robust and defensible. No, they will give you MCQ. Which of the following have to ensure the IFC and risk management systems are robust and defensible? Option A, board of directors. Option B, independent directors. Option C, audit committee. Option 4, auditors. Independent director. Independent directors must abide by code of independent director. As per the code, no, they need to ensure financials reporting is integrity. Integrity is there in the financial information. They need to ensure controls and risk management systems are robust and defensible. And audit committee must evaluate IFC. Auditors must report on IFC adequacy and operating effectiveness. Under 134, listed companies especially, director responsibility statement must state that IFC were laid down, such controls are adequate and operating effectively. Even board of directors have to give a board report. Inside the director responsibility statement will be there. Inside that they need to tell about operating effectiveness of IFC. They may ask in exam, they asked it in the last attempt or that before attempt or maybe in MTP. Write about provisions of Companies Act dealing with IFC. What are the directors' responsibilities relating to IFC? That also may ask you. Nothing but 134 answer you need to write, 149 subsection 8 answer you need to write. In case of listed companies, board of directors must include in director responsibility statement, yes or no. In board report, no, so many parts will be there. Inside that, one of the part is DRS, director responsibility statement. Inside that, directors have to make a statement whether they were laid down or not. And they need to make a statement whether they're adequate and operating effectively. Further, auditor through his audit report should comment on adequacy and operating effectiveness. And in case of audit, no, these are the companies which are exempted. Okay, whereas in unlisted companies, direct responsibility statement need not talk about this. Able to understand that IFC also over. Now, last one part. What is IFC and what is internal controls over financial reporting? What is the difference between IFC is nothing but policies, and IFC means it's a policy. It's a policy. What is a policy? Reliability of reporting, effectiveness of efficiency of operations, compliance with laws, safeguarding of assets, prevention and detection of frauds. Whereas ICFR, nothing but internal financial controls over financial. What does it mean? These controls specifically focus on financial reporting process, closing entries. Once 31st March is over, closing entries company has to pass, prepaid outstanding. Who will pass that? Some rules were there. That's internal control over financial reporting. Auditors have to express an opinion on effectiveness of internal controls over financial. We have to give opinion on not entire IFC. We have to give opinion on those IFCs which are dealing with financial reporting. This opinion is distinct from opinion in the financials. That's why in many audit reports you see listed companies, you will find audit report on financials, audit report on IFC over financial reporting. Two audit reports you will find. IFC is a broader term covering all aspects of controls, whereas ICFR, internal controls over financial report, is a narrow term which is limited only to financial reporting related controls. Sir, what do you mean by financial reporting related controls? Very simple. See, purchase voucher has to be signed. Purchase voucher, only purchase voucher signed, then only purchase can be done. That's a financial control. Financial control over financial reporting means what? Control over financial reporting means what? Once year is over, we need to identify cutoff. We need to perform cutoff to ensure transactions are recorded in right accounting period. Management only has to do cutoff. Remember, we verify. We also do cutoff. But more than us, who should do that? Management. Management only should identify closing entries to be passed. Management only should identify accounting policies to be selected. Management only should identify disclosure related requirements, all that. These are, somebody has to be delegated with responsibility, right? Somebody has to be delegated with this process, right? Some control has to be established, right? This control is called as control over financial reporting. You clear? So that is IFC over. Okay, so they may ask you this itself in exam for 4 or 5 marks. Write about what is the distinction between IFC and IFC over financial reporting. Internal controls over financial reporting. Okay, or IFCO for internal financial controls over financial reporting, or internal controls over financial reporting. Anyway, both are same. So IFC means they're talking about policy. Internal controls over financial reporting, those that are dealing with financial reporting. And auditor has to evaluate whether IFC system in place, are they operating effectively. By directors have to mention IFC, were they laid down, and are these controls are operating effectively. Audit committee must evaluate IFC. Directors have to evaluate, independent directors have to evaluate financial controls and risk management system, are they robust and defensible. That's it. You see, IFC topic is over. Pakka. Many times asked IFC topic, very easy. This is not so complicated at all, it is very easy. Okay, that's it. So IFC is also over. Now we are having 330. Once 330 is over, we will be covering 320 and then 450. With that main will be over. Then we'll be left with, I told, internal control 530, 520. Okay, yes. So 330. Yeah, 330 we will discuss. Or else just a minute, I'll save this file separately and then we'll save them. Yes, let's continue. SA 330. I told at the beginning also, chapter 315 talks about identifying and assessing. 330 is what talking about, yes, response to the risk. How do we respond? By performing audit procedure. Why we perform? To get the evidence. What evidences? SA 500, 5th chapter, audit evidence chapter we saw. Audit procedures, 5th chapter. Completion and review, 6th chapter. All this is nothing but response of the auditor. All this is nothing but response of the auditor. So how do we respond? Auditor's response to assessed risk. So the standard deals with auditor's responsibility to respond risk of MMS identified, obtain evidence by designing and implementing appropriate response. So designing overall response to risks at financial statement level, performing further audit procedures at assertion level risks. Generally, I told you, we only find assertion level risks. For that, we will plan further audit procedures at assertion level. But you know, when we find a risk at financial statement level, no, our responding way will be different. We may withdraw from the engagement. Generally, what we will do if financial statement level risk is found after accepting the audit, we'll withdraw. We will not continue. But if it is assertion level risk, no, we give more attention to that area. We plan our further audit procedures where I will give more attention to the assertion level risky areas. Now, designing further audit procedure, nothing but the standard is exactly talking about designing further audit procedure. When you're designing, no, you need to identify reasons for risk assessment at assertion level. Why there is a risk at assertion level? You found some risk at assertion level, identify the reason. Consider likelihood of the misstatement. Consider assessment of control risk and reliance on the operating effectiveness. Assessment of controls, what is the control risk there? Reliance on the operating effectiveness, what is the inherent risk and what is the control risk? If inherent risk is there, control risk is not there much. I mean, like risk of MMS possibility is very low, then you may give less attention to. When you are designing further audit procedure, you know, you need to figure out reasons for risk assessment. Specifically, what is the likelihood of misstatements? Okay, some risk is there. What is the likelihood? Is there a control implemented for that? Okay, and obtain more persuasive evidence for higher risk. If at all you classify risk as higher, you need more evidences. And you know, what are further audit procedures? Test of controls, substantive procedures. Compliance procedure, substantive procedure. Further audit procedures are nothing but compliance procedure, substantive. Compliance procedures are called as test of controls. Substantive procedures are test of details, substantive analytical procedure. Yes or no? Yes. Now, test of controls. Why are we performing test of controls? Especially when do we perform test of controls? When we want more persuasive evidence for higher reliance on control. We perform test of controls if at all we have to obtain evidence for reliance on controls. We want higher persuasive evidence on reliance of control, or perform test to evaluate operating effectiveness of controls when substantive procedures alone are insufficient. Imagine in a bank, no, how many transactions you will verify, how many loans you will verify? Impossible. Better what you verify? Look at the system, look at the controls, how the transactions, how a loan is given. Verify the process of giving the loan. If the process is effective, 90% loans will be effective. So substantive procedures alone are not sufficient. That time you must test operating effectiveness of controls, and auditor relies on controls for substantive. When auditor is deciding to rely on controls for substantive procedure, or when auditor decided that substantive procedures alone are not sufficient, then auditor will design and perform test of controls. Further, if at all there is an expectation that auditor requires more assurance on effectiveness of control, if the auditor's risk assessment includes an expectation, if the auditors has a duty to know audit, has a duty to verify operating effectiveness, then also I will test the control. For example, in 143 subsection 3 clause I have a duty to report on adequacy and operating effectiveness of IFC, internal financial controls. Now tell me, if I have to report there, I must test the control, right? Yes. So test of controls are performed when the test of controls are performed, straight away a 3 or 4 marks question. The auditor will perform test of control to evaluate operating effectiveness, especially in the following two circumstances. One, he want to use test of controls for substantive procedure, and he want substantive procedures alone are insufficient, or he want to obtain more persuasive evidence for higher reliance on control. Obtaining more evidence for higher reliance on control means what? Maybe with a for the purpose of reporting on IFC. Next, an auditor relies on control for substantive. What is meant by auditor relies on controls for substantive testing? See, I am verifying purchase transaction. I want to know whether this purchase transaction is authorized or not. I will see authorization matrix. So which means, in order to perform a transaction, first I must know controls are effective or not. For that reason also I will test the controls. Or only transaction testing is insufficient, that time also I will test controls. Next, nature and extent of controls, I'll come back to it later. Okay, now substantive procedures. Another audit procedure is what? Substantive procedure. What are the types of substantive procedures? You see, what are the types of substantive? Two types: test of details, substantive analytical procedure. Test of details means what? Verifying actual transactions through vouching, verifying balances through verification. Okay, example, verify purchase transaction using invoices, GR and register. This is called substantive procedure. Verify fixed assets through physical verification. That is also called verification, which is also test of details. Another substantive procedure is what? Substantive analytical procedure. What is substantive analytical procedure? Evaluating financial data. Evaluating financial data using relationships among financial and non-financial. So I will evaluate the given financial data, sales, so much amount, by evaluating this financial data with non-financial, number of employees, non-financial. Last year number of employees 100, this year number of employees 200, but sales are same only value. So I'm evaluating sales value by looking at non-financial data and comparing relationships. Yes or no? Evaluating financial data using plausible means what? Acceptable relationships. Correct? Huh? Number of employees to sales, can I measure it? You can link these two. Hello, number of employees is equal to sales. Can I measure this relationship? Can I link these two factors? Yes. Are you getting it? Number of kids director is having and sales, for example, can I link this? Exactly. Able to understand? So number of employees is an acceptable relationship for comparison. Yes or no? That's it. Investigate fluctuations or inconsistencies in data. Okay, last year 100 employees are there, company turnover 10 crore. This year 200 employees are there, company turnover is still 10 crore. Inconsistency. I will investigate now. I then investigate fluctuations and inconsistencies. Use recognized ratios to support reasonableness of recorded amount. Last year turnover ratio this much, this year turnover ratio why increase? Do ratio analysis. Predict total rental income based on number of months, vacancy rate, all that. Correct? Huh? So that is substantive analytical procedure. Now the auditor may, like, okay, what nature of substantive? See, there are two types of substantive procedure. One is test of details, substantive analytical procedure. Which one you perform? I can only perform analytical procedure if it is sufficient to reduce my audits. I will not take any vouchers and then test. I will only perform analytical. Or I may use test of details if at all supported by control testing. Okay, use test of details if supported by control testing. Remember, in reality, control testing, substantive testing are not done separately. Generally, control testing itself will give me substantive testing. Combine analytical procedure and test of details, which is a most responsive risk, most best risk response. The best response to risk is what? Both substantive analytical and test of details. Increase extent of procedure when test results are unsatisfactory. Suppose you tested some transactions, you found some mistakes. Immediately what you should do? Increase extent of substantive increases when results are unsatisfactory. Consider sample size and alternative testing methods when doing test of details. So use sampling techniques all that when you are performing test of details. Are you getting it? So they may ask you straight away a 4 marks question. Write about nature and the extent of substantive procedures. So write about nature and extent of substantive procedures. Perform only analytical procedures if sufficient to reduce audit risk. Use test of details. Combine analytical procedures and test of details. Increase extent of procedures when when test results are unsatisfactory. Consider sample size. Any other testing methods which are available. See, sampling itself is one of the best method of testing. Best method of selecting sample and then testing. There is no alternative method. Clear? That's it. Alternative testing method means what? 100% verification. To a sample, what is alternative? 100% testing. If the number of transactions are very small, we can do 100% testing. That's it. This is nature and extent of substantive procedure. So substantive procedures are performed. What is the purpose of substantive? They are performed to detect material misstatement at assertion. Okay. Now, performed for each class of transaction, account balance and disclosures, regardless of assessed. Substantive procedure is must. Only by checking internal controls you felt that company system of internal control is very effective. Can you directly give opinion on the financials? Performing substantive procedures, either analytical must be performed or details must be performed or both must be performed. Performing substantive procedure is must, irrespective of assessed risk, regardless of assessed risk. Might be low, risk might be high, according to you, it doesn't matter. You must perform substantive procedure. MCQ, substantive procedures only reflect the judgmental nature of risk assessment and limitations of internal. Yeah, you might have judged the risk high, low. You might have concluded internal control operating effective, or they are operating effectively or not operating, that and all. Whether they are true or not, which will reflect you. Substantive only when I really test the transaction, my judgments regarding risk, my judgments regarding controls will be reflected. My judgments are correct or not, how do I know? Test real transaction. Are you clear? That's it. So this is substantive procedure, important. Confident, all of you? Next. Now, what is test of controls? These are performed to evaluate operating effectiveness of controls when auditor relies on controls for substantive procedures, and substantive procedures alone are insufficient, or he want to get a more evidence on, more persuasive evidence on reliance. In order to, suppose you want to trust controls and then do the audit, then you need to get evidence on the controls. In some entities like banks, insurance, because predominantly automated environment, controls oriented, there I cannot do substantive procedure alone. Okay, that alone will not give me evidence. Controls procedure, compliance procedure must be done. Nature, what extent, how will I test the control? I will combine inquiry with other procedure like inspection. Remember, we saw one question, test of controls, automated environment. So how do I test control? I will inquire management, or I will also inspect records and I will do reperformance. I will consider how the control is applied, automated or manual, when it is applied. Consistency, generally automated controls are consistent. Who applied? Management person. Who is the person responsible for control? Determine reliance on indirect. Is there any other indirect control? Combine inquiry with inspection or reperformance for greater assurance. Adjust testing based on nature of the control. That is, inspect documentation for evidence of effectiveness. So nature and extent of control means this. Able to understand? See, this topic is little difficult to comprehend. Okay, but already we are exceeding so many hours, so I need to finish it up within shortest time. Okay, but this is sufficient. This understanding is sufficient. Next, factors influencing extent of testing. To what extent I need to test? What extent I need to do control testing? Expected rate of deviation. If at all you think control deviation high, very control deviation is high, the possibility of control deviation is high, I will do more testing. Relevance and reliability of evidence. If at all I get more reliable and relevant evidence, I will pakka test the control. Evidence from other related controls. Whether by testing some other control you will get evidence, then you can ignore this control. If at all you are not able to get evidence from some other control process, then test this control. Length of reliance on the control. How long you want to rely upon this control, for what period? Suppose I want to know whether the control is operating effectively throughout 12 months. Then I need more evidence. More extent testing is more required. I just want to know whether control is effective on a particular date. Just on the day control is testing, on a surprise check you do, you will get an evidence. Frequency of control performance during the year. What is the frequency? For example, no controls over financial reporting, only at year end they will perform. They may not be performed throughout the year. So some controls, purchases, throughout the year they'll perform. Asset purchases, whenever asset is purchased, no, they'll perform. Suppose during the year, no, the company does not purchase any fixed asset. So control related to fixed asset purchase, they didn't use at all. So frequency of control performance during the period. Factors influencing extent of testing. Factors. Generally, I don't like to tell students to remember, but in this topic, I just have to tell you. Okay, this is the only way. Frequency of test. If I have to discuss all the examples, it'll take so much time. Okay, so this is sufficient. Next, timing. When can I do? When I can do this test of control? I can do test controls for a specific period or throughout the period for which reliance is intended. Suppose if you have a duty to comment on operating effectiveness throughout the period, then you must test the control throughout the period. Means you need to take records on April month, you need to take records of June month, you need to take records of September, randomly some months you take, see on those days controls are working effectively or not. Yes or no? Then point in time evidence may sufficient, like testing physical inventory counting. Timing of test of controls. Some controls, you can only test, for example, inventory. Whether company inventory physical counting is correct or not. I want to test that control. Only I can test at that point when physical inventory counting is going on. So point in time, evidence may suffice. For reliance over a period, perform test to verify controls operated during the relevant times. Example, monitoring of controls. Okay, just this topic 330 is only one standard where you have to remember for sure. Like, there is no other alternative for it. Then using audit evidence. Can I use audit evidence from previous audits? Yes. Sir, last year only I tested all the controls, sir. First time that year I'm first auditor. So last year, since I'm doing for the first time audit, I tested so many controls. Can I use that same evidence? Absolutely. But compared to last year, this year, some changes might have been there. Identify. Considerations for using prior period evidence. This itself can be asked as a 4 marks question. Effectiveness of other control elements. Check out how effective other control elements in the current year. Characteristics of the control. Is it a manual or automated? General IT controls effectiveness check. And ensure, last point you see, G point, ensure continuing relevance of prior period by confirming whether any changes occurred. And material misstatement risks and all level of reliance consider. Controls effectiveness and deviations noted in previous audit. Check out. Risk due to lack of change in control. Check out in the changing circumstance. See, my doubt is, last year I tested control, sir. This year again I'm doing audit. Should I test once again this year also? This is the question. Can I use the last year evidence? You can use it, no problem. But this year, how other control elements? How effectiveness of other control elements? Sir, what do you mean by other control elements? Internal control system has 5 elements. That topic only we kept pending. Internal control. Internal control has five elements. Control environment, control activity, risk assessment process, information system, monitoring activity. Like that, there are totally 5 components in internal control. 5 components in internal control. That's a very vague topic. Okay, that's very challenging topic. Okay, fine. So can I obtain? Yeah, if remaining controls are effectively working, check out. Then you can use previously obtained evidence in the current year. Characteristics of the control, manual, automated. If it is manual, you must do audit once again. You must test controls. If it is automated controls last year we checked. Can I use the same evidence in current year? See whether are there any significant changes? No changes, sir. You can use the same evidence. Yes or no? Then general IT control. In this year, How IT controls are effective? Check out. Sir, they are very effective. Yeah, you can use last year evidence, no problem. Control effectiveness and deviations noted. Last year also you might have noted some deviations, right? What is the status in the current year? Check out. And risk due to lack of change. Some controls, no. Last year same control, this year also same control. There is no change. Is it okay? Like, because no, every business is dynamic. Every year controls has to be updated. If at all there is no change in a control, is it okay? So lack of change in control in spite of changing circumstance. See whether business circumstances change and control remain the same. Business circumstance change, controls have to be changed. See, test the controls whether they are operating effectively in the changed circumstance or not. Able to. These are the factors which we consider while evaluating evidence, while deciding whether previous audit evidence regarding test of controls, can I use it in the current year or not. That itself can be asked as a straight question. Timing of test of control, 3 marks. Factors influencing test of controls, 3 marks or 4 marks. Nature and extent of test of controls, 4 marks. Even in the last Jan exam also, one of this was asked. Evaluating operating effectiveness of control. Now, so why are you testing controls? Ultimately, to know whether they are operating effectively. See, determine whether a detected misstatements indicate effective. Suppose in the audit, generally you might find some mistakes. It might indicate generally a weakness. Absence of misstatement does not confirm control effectiveness, correct? Huh? Just because you did not find any mistake, does it mean controls are effective? Exactly. A material misstatement is a strong indicator of significant. We have seen indicators of significant deficiency. Material misstatement identified by the auditor. Yes or no? Now, sometimes when you're testing controls, you might find a deviation. Like purchase order 1000 units, but our company received 1200 units. How come? It's not possible. Then how did GRN is generated for 1200 units? That's an automated control. There is a software very clearly written where GRN quantity cannot be more than purchase order quantity, but one transaction I found where GRN quantity is more than, control is deviated. And control is deviated, I need to, when deviations in controls are identified, this is many times asked for 4 marks. When deviations in controls are identified, auditor should assess whether test of controls provide sufficient basis for reliance. All these days I'm thinking GRN control is effective. Now I found a deviation. Yes, whether test of controls provide sufficient basis. See whether additional testing is required. Address potential risk using substantive procedure. When deviations are identified in controls, I want to know whether a fraud happened or not. So for that reason, I will do more substantive testing, and I will do test internal controls more aggressively, and I will see whether whatever the test of controls I already perform, is it reliable or not. I will check out. When deviations are identified, what are the specific inquiries? When deviations are detected, these are the specific inquiries which auditor has to perform when deviations in the internal controls are identified. Are you okay? That's it. 330 standard is over. I know I have discussed this topic and this particular mainly 330 standard little faster, but see, look at the chapter size. Understood? So much is there, but that too so much vagueness is there. That's why I tell people to keep this as a choice chapter, because if a real practical question comes, you can't answer. For example, I'll show you in the recent exam, some question was asked on this. Many students could not even understand the question. Segment information. Yeah, you see this 4 marks question is actually asked from internal control topic. Whether existence of a satisfactory control environment can be considered as an absolute deterrent to fraud. Existence of satisfactory control environment, can it be considered as a deterrent, absolute deterrent to fraud? So existence of satisfactory control environment, in our book also it is there. 330 is over, right? The internal control topic. Control environment, there it will be there. Yeah, control environment, you see. satisfactory control environment, not an absolute deterrent. This matter they ask. How in between point they're picking and asking. You understood? Next, many students what they do, they focus so much time on risk assessment, but when it comes to answering in exam, they write wrong answer, or they may not give the correct accurate answer. They score 1 for a 5 marks question or for a 4 marks question, 1 mark they score. They spend so much time on risk assessment because it's a lengthy and complex. The same time is spent on other chapter. You can revise entire audits. Whatever the time you spend on risk assessment topic for learning first time and revising, the total time equal to revision of remaining entire subject is best. Revision of the entire other subject. That's the reason I tell people to leave this particular topic. Okay, because hardly you maybe not be able to attempt some 4 or 5 marks only by skipping this chapter, because choice also there na, maximum or worst case 10 marks you may not be able to attempt, but rest 90 marks you can attempt. That's it. So strategy, you must always apply strategy when you're applying this all, like when you're deciding something you need to apply strategy. There is another question I'll show. This is audit related one, basis for opinion. See, generally many chapters that we have seen, no, before risk assessment, until before risk assessment, you can study well, you can understand well, you can also reproduce well. This is one topic, that to internal control topic 330. Only these two topics is something you can't comprehend it easily, and you can't reproduce also easily. This is internal audit work. 1 4 marks question visa, correct? There is another question, I guess so. There is another question. I think that's it. Only 4 marks was there in the last attempt. We'll see. We'll see. I think there is one more question to best of my knowledge. You see, automated environment. Explain types of audit tests that commonly used in automated. This we discussed in depth. That we already discussed in depth. Types of tests. Remember, inquiry, observation, least effective, least efficient. That only. Okay. Yes, that's it. So don't worry, predominant risk assessment topic we discussed recently. Which one? Risk assessment, understanding, automated environment, IFC. 320 I will discuss now very in depth. Okay, 320, 450 also I will discuss. 265 we discussed in depth. What I am not discussing is internal control. I'm not discussing in depth. 330 and all I'm not discussing. Clear? That's it. So with this 330 topic is over. Almost half an hour we spent. Okay, 330 topic is over. What I recommend is internal control topic 330. In 330 also, nature and extent of substantive procedure is there, right? That you cover. Controls is there, right? You literally speaking in risk assessment topic, what I'm asking you to avoid is control topic. Internal control section you avoid. Within 330 also test of control is there, that you avoid. If a practical question is framed on that, it's impossible for any student to comprehend, right? Comprehend and write, impossible, because they'll ask you conclusion also. That conclusion you can't give correctly. For that reason I'm telling you that internal control 330, test of control topic, only these two takes lots of time. That's why I recommend not to consider that. Okay, whereas remaining, what one is which one? 320, everything that we discuss in depth, and we also cover them in depth. Clear? That's it. 2 minutes, we'll begin 320 right now. Yeah, we'll begin essay 320. Materiality. Essay 320 will begin. Materiality in planning and performance of an audit. Materiality. This topic is important even in CA final, but in CA final book this discussion itself is not there. But in exam paper the last question. Many CA final students, they will see surprisingly this question in the question paper, because that is not there in the CA final book. Implied assumption is CA inter also should be studied thoroughly. That's what the ICA is, an implied assumption. They ask in-depth questions. Students will be shocking to see the question all that. And when I say that it is there only in CA Inter, they'll be again, that's a surprise for them again. Technically, CA Inter audit syllabus is tougher than final. For me, final is quite easy. For me, final handling is quite easy. Even in final, we have more exemptions than in Inter. Because final syllabus is quite easy compared to CA Inter. CA Inter is like a solid foundation. It's like a laying foundation only. Very, very strong. CA final, CA Inter audit is extremely difficult technically because every standard is discussed in depth for you. In final, only few standards will be discussed in depth. Of course, there are other topics. In final, there are other topics were there. Apart from standards, we have some more different standards. We have some ICA Act will be discussing, that and all is there. But coming to major syllabus standards, as a whole, if at all you ask me, CA Inter audit is tougher than CA final audit. Materiality in planning and performance of an audit. You know, many a times we saw material misstatement, free from MMS, material. What is material? We know material means we can understand, we can comprehend it to some extent. What is material? In many companies, no, when we are doing audit across industry, the big four, whatever, you know what they take? 0.5% of turnover. For example, if a company has 1 lakh crore, 1% means 1000 crore. 0.5% means 500 crore. Overall materiality, what is it? 500 crore. But you know, when we are performing audit, no, we fix another materiality called performance materiality. Overall materiality is called as planning materiality. Overall materiality is called as planning materiality. But when we are performing audit, we do not compare the mistakes with this 500 crore amount. We compare mistakes with something called performance materiality, where we may keep 400 crore. 400, 350, 300, depends upon the auditor. Here, no, margin is some 25%. 25%, like from here. 400 plus 25% is equal to 500. Or from 500, the margin is 20%. Okay, so compared to overall materiality, performance materiality will be lesser by 20, 30, 40% like that. Okay, so there will be a margin here. There will be a margin. So we auditors will keep this margin. This margin is, why this margin? This is a margin for undetected misstatement. This is a margin for undetected misstatement. Now, so what is overall materiality? 500 crore. You know what does it mean? If at all I found any mistake, if at all we are finding any mistake in books of accounts, total of all the mistakes I will total. Mistakes total I will do total of all the mistakes. If the total of all the mistakes that I identified is more than 500 crore, then the financial statements are materially misstated, and I will give a modified opinion, which might be a qualified. Or I am unable to obtain evidence for 500 crore and above worth of information. I'm not getting evidence. Then also I will call it as inability to obtain evidence for material. You clear? But this is only material technically. But I will not even wait up to 500. That is not 500. I will only go with 400. Why? Why I am keeping performance materiality lower than overall materiality? Exactly. Somebody said we do audit based on sampling. We do audit based on sampling. The main reason why performance materiality concept itself came into picture is sampling. We do audit based on, in the sample itself I found more than 400 crore mistake, means real mistake would be more than 500 pakka. Yes or no? Real mistake means what? Suppose no, I detected some, 350 crore worth of mistake. In the sample I verified. In the sample I verified, I detected 350 crore worth of mistake, which is almost close to performance level. What about the mistake which I have not yet detected? In the sample itself, 350 crore mistake is there. In total population, undetected misstatement put together, how much will be there? That will be more than overall materiality. Are you getting it? So for that reason, I keep something called performance materiality. Performance materiality is an alert for me. It's a red alert. The moment I reach performance materiality, I need to be very careful. Forget about reaching main materiality level. Forget about reaching main materiality level. This is like a red alert. Are you getting it? Auditor has to alert the moment mistakes identified by him cross PM. Performance materiality, generally when the mistakes that we identify touch performance materiality, what does it mean? There is unexpectedly high risk in that. There is unexpectedly high risk in that entity. What generally we do, the time we revise this performance materiality to lower 250 crore. When I predicted more risk, I will reduce the performance materiality to lower. When I keep lower performance materiality, more mistakes, more audit procedures I will do, more risk it will be. Are you getting the point? See the analysis. Generally 500 crore. If at all in the financials more than 500 crore mistake is there, then only I will give a modified opinion. More than 500 crore mistake means, is it only detected mistake plus total mistake? Total mistake. Materiality you will analyze only with the total concept. But I don't know what is total mistake. I don't know what is total mistake. I only know detected mistake. So for detected mistake, I can't compare with overall materiality. Overall materiality is for total mistake in the population. But detected mistake, what I will cover? What I have to compare with? Performance materiality. This margin we will keep for undetected misstatement. Undetected. If the margin is low, between overall materiality performance, if the margin is low, auditor is expecting low risk. Margin is high, auditor is expecting high risk. Margin high means performance materiality is decreasing. Can I say that? Margin high. See, if I have to keep, if this gap is bigger means performance materiality increasing or decreasing? Decreasing. If performance materiality come to 250, then gap is high. If performance materiality increases to 400, then gap is low. When performance materiality we will decrease, when audit risk is high, audit risk is low. When audit risk is high, performance materiality will be low. That's why they say relationship between materiality and audit risk is inverse. What is the relationship? Inverse. Which materiality risk? Performance materiality. Now look at the last concept in SA 320. Materiality and audit risks are related. You need to consider materiality audit risk throughout the audit. Yes or no? Materiality applied when planning the audit and performing the audit. Materiality applied even when evaluating misstatements. Materiality is used even at the time of planning. While planning the audit I will use, while performing the audit I will use, while evaluating mistakes identified I will use materiality. For even forming opinion on audit report also I will use materiality. Materiality used at planning time, performance time, evaluation time, reporting time. Throughout the audit I am using. And audit risk is the risk of giving inappropriate opinion when financial statements are materially misstated. And audit risk means what? They gave a formula which we already saw in the very first class. Now, materiality and audit risk usage. Materiality and audit risks are considered throughout the audit, especially during risk assessment, identifying and assessing risk of MS, audit procedure, determining nature and timing and further audit procedure, evaluating the effect of uncorrected misstatements on the financials. Uncorrected means what? I found a mistake, I found it not yet corrected, management not yet rectified. For evaluating effect of uncorrected misstatements on financials, this itself a 3 marks or 4 marks question. They'll ask you, materiality and audit risks are considered throughout the audit. Explain. Yes, they are considered throughout the audit. When identifying and risk of MMS. When I'm identifying any risk, I will see whether is it possible to, is it leading to a material misstatement or not, I will see. For determining nature, timing and extent of further audit, like for designing nature, timing, extent of further audit procedures. For planning further audit procedures also I will identify, I will see materiality. Determining NTE means nothing but planning only. Determining NTE means planning only. Yes. And yeah, I planned and performed. I now found out misstatements. Evaluating misstatements on the financials and forming an opinion. So materiality is used throughout the audit, and the relationship between materiality and audit risk is inverse. The relationship is inverse. Materiality and audit risk means there the standard does not tell performance materiality, but we understood it as performance materiality. Clear? Now you see, I told you right now, revision of materiality, correct? Revision. Materiality levels may be changed. Materiality levels may change during the audit due to following. Why? Higher risk estimates than initially predicted. One of the factor why we are revising materiality, higher risk. Enhanced understanding, for better understanding of the client also we can revise materiality. Significant difference between actual financial results and array what I expected and what happened, both are significantly different, so I may revise, I have to revise materiality. Occurrence of new circumstances, availability of new information not known, yes or no? So originally I don't know some information, now I got to know. So materiality level, originally what I decided is based on old information, now I got to know new information, so I will decide, I will redesign, I will change my materiality. If actual financial refers differ significantly from anticipated results, the auditor revises materiality and evaluate whether evaluate if performance materiality and audit procedures need adjustment. So auditor may adjust performance materiality, audit risk, everything he will adjust. Audit procedures, revision in circumstance, revision of materiality. Many times asked this question, 4 marks. Many times it was asked. Revision of materiality. Materiality levels may change during the audit due to the following: occurrence of new circumstance, availability of new information, significant difference between actual results and anticipated results, high risk estimates than initially predicted, for enhanced understanding of the client business. You know what? Generally, when we keep material big, no, materiality level higher level, no. Many small items and all we ignore, we don't consider them because material. But if we keep materiality low, no, we even cover every aspect of the entity, every type of transaction we cover. When materiality is low, audit coverage is high. When materiality is high, audit coverage is low. For a better understanding, materiality generally be kept at low. Understood? Now documentation. What you need to document? Overall materiality you should document. That is called planning materiality. Specific materiality. Materiality for specific, sometimes no. Generally, financial statement 0.5% of turnover is overall materiality. But for a plant and machinery imported from outside India, to know whether that plant and machinery correctly accounted or not, there I can have a separate materiality level. That materiality is called as specific materiality. That we call it as what? Specific materiality. Materiality for specific class of transactions, account balances, disclosures if applicable. For example, no, for GST compliance, TDS, for statutory dues, I will not compare with 500 crore. I will compare just with 50 crore. That's a specific performance materiality. That's a specific materiality level. Array, in a GST, no, company paid GST by lesser amount by 50 crore. That itself is significant offense. Yes or no? I don't wait up to 500 crore limit. Generally, shareholders' point of view, financial statements, are they free from MMS? Yes. Mistakes were there, less than 500 crore, 1 lakh crore size of the company turnover, 500 crore less than is nothing immaterial. So they are free from MMS. Are statutory dues paid correctly on time? Are statutory dues are paid correctly on time? Is the company regular in depositing statutory dues? Whether computations and all is correct or not? There 500 crore I can't compare. There maybe 50 crore only required. Are you getting it? Up to 50 crore difference is okay, no possible. Sir, GST payments, sir, we sometimes pay higher amounts, sir, by mistake, or sometimes we pay lower amount. Up to 50 crore difference, no problem. GST department also not that bothered, because the tax amount that the company is paying is 18,000, 20,000 crore yearly. So GST liability is 20,000 crore yearly. 50 crore and all not an issue. There 500 crore is an issue. 500 crore might be an issue. So generally you can have a single materiality level for entire audit, but for certain specific class of transaction, for some specific balances, even a specific materiality you may have to decide, which is generally lower than overall materiality for the financial statements as a able to understand. So auditor has to document overall materiality and materiality for specific class of transactions, account balances and disclosure, performance materiality, any revision made to the above. So document overall materiality, document specific materiality, document general performance materiality, document any revisions for the above, including reasons therefore. Documentation of materiality, many times asked. Documentation of materiality, many times asked. Are you clear until now? Now look at this. F concept, you see materiality level for particular class of transaction account balances and disclosures. Materiality for particular class of transactions, account balances and disclosures. For certain class of transaction, for certain account balances, for certain disclosures, which are very sensitive, significant to the users. Misstatements below materiality could influence economic decisions. Misstatements below overall materiality 500 crore, that itself is enough to influence their decision. GST department will not accept up to 500 crore variation. They will accept only up to 50 crore, even if the misstatements are not material to financials as a whole. Able to understand? So the factors are, for example, law regulation may affect users' expectation about certain items. For example, GST department, up to 500 crore variation and all, you can't say immaterial. In GST, it's 500 crore is a very big variation. 50 crore only I'll permit you. Are you getting it? So when I'm verifying, when I'm telling my team member, no, hey, verify GST workings. My team member, no, he thought overall materiality 500 crore, right? In one particular, I mean, GST he verified, total fully. Company liability 17,600 crore. They paid. Actual liability 18,000 crore. 400 crore short paid. But my team did not report me. When I'm reviewing his work, no, I asked him, 400 crore variation is there? Why you didn't report me? Sir, you don't know materiality is 500 crore, so I didn't report. No, no, no. Here materiality is 50 crore only. Now once again go and come back. You do TDS reconciliation once again and come back. Provident fund, where and all you applied 500 crore in statutory dues related, no, once again go and do the work and come back and show me more than 50 crore differences. Yes or no? You're able to comprehend this now? Yes. So for certain class of transaction, account balance and disclosure, which are very sensitive or maybe significant to some users, yes or no, misstatements below materiality could influence their decision. GST department might levy penalty if at all the underpayment is more than 50 crore. See, actually we should not pay we should not make any underpayment. If at all any underpayment is there, you can pay along with interest. But if the underpayment is intentional, or if the underpayment is too big, GST department might also levy penalty. Their decision will influence depending upon the size of short payment. If the short payment is very small and minor compared to the total tax that you are paying, they may only collect that short payment plus interest. They may ignore penalty. But if the size of the amount is so big, GST department might consider this as intentional and might not only stop levying, might not only levy interest, they levy interest anyhow, plus they also levy penalty. They also initiate prosecution. Their decision will. So for some particular class of balance, some particular class of transaction, materiality level which is lower than materiality for financials as a whole may affect the user's decision making. Yes or no? So even if the misstatements, yeah, in GST 50 crore mistake, that is not at all material for financials, but for specific user it is material. This will affect his decision making of levying penalty on me or not. Able to understand? Now, so for example, like what are the factors? When you will decide specific performance materiality? Based on law and regulation. Laws and regulations or financial reporting framework may affect user expectation about certain items. For example, related party transactions and management remuneration. Related party transactions and management. Suppose no, the company materiality level is 500 crore, right? In the P&L, in the notes to accounts, no, they gave a list of significant shareholder. Significant, I mean, key shareholders means what shareholders? Shareholders holding more than 5% voting power. 5%. Company reported some 3-4 shareholders more than 5%. One shareholder has 50 lakhs paid up capital, another shareholder has 1 crore paid up capital, another has some 1.5 crore. More than company total paid up capital itself is, let us assume 15-20 crore. 1 crore if at all somebody is having is a 5%. You know, some 3-4 shareholders names they reported 2 crore, 1 crore. For one shareholder, he has 10% holding. Sorry, he has only he has 6% holding, but they didn't report it. Company considered his actual holding is 1.5 crore or 1.2 crore something, 6%. 1.2 crore out of 20 crore. Total company capital is how much? 20. He has how much? 1.2. So how much it is? 6%. His name also should come in the notes, but his name is not there. When I see the company records, no, actually in the company records 80 lakhs only were there. 40 lakhs were recently allotted. It was not yet updated. So this disclosure requirement, no, last year only they copy pasted as it is. Our team also saw this mistake. Since 40 lakhs mistake, why material they ignored it? No, it's material here. Even if it is 40 lakhs, financial reporting framework, user is expected to know. Users are expecting key shareholders list as on 31st March. Even though it is only 40 lakhs variation, that is the reason why you missed one shareholder to report. Yes or no? Even if you miss, it's a violation of financial reporting framework. It might be material. Next, key disclosures that are critical for industries based on their nature. Example, R&D cost for a pharma company is very important. For a pharma company, R&D, how much amount they are spending, how much amount is under development, intangibles under development, that amount purpose, no, you can't compare with 500 crore materiality. Here you may have to require a specific materiality. Users may pay particular attention to some aspect of the business that are separately disclosed in financials. For example, a newly acquired business, statutory due, segment information, penalties. In all these cases, you can't compare with overall materiality and ignore them. For them, a specific materiality might be required, and if at all a mistake is there in those amounts beyond a specific materiality level, we will consider that as a material misstatement and we will modify our opinion. Able to, that is called specific performance materiality. 5 marks question. How do I know? When should I decide specific materiality level? These factors, see the legal and regulatory impact, financial reporting impact, see key disclosures that users are expecting based on the industry nature. Key disclosures, for example, shareholders capital more than 5%. User may pay particular attention to aspect of entity business. For example, a newly acquired business related information, a company showing it. Segment information they're showing. Segment information purpose materiality level might be different. Able to understand? So a company can have a materiality level for a particular class of transaction below materiality that could below the materiality. Below which materiality? Below overall materiality. Add this word overall, better. Below overall materiality. Below overall materiality, where this amount itself will influence economic decision. Even a smaller amount will influence economic decisions. Understood? That's about materiality level for a particular class of transaction, account balance and disclosure. Then, the standard says, take some assumptions about users. Remember the very first chapter also I told. First of all, users and all can't read financial statements. When I'm discussing key audit matter also I told. First of all, do anybody understand key audit matter? Nobody. Others and all cannot understand. Only we are CS itself unable to understand. Others and all, how do you think they understand key audit matter? Financial reporting framework, fair value estimates, how do they understand? Balance sheet, they can't. Now, since they can't understand, can auditor take it as granted? No. Auditor has to take some assumptions about users of financials in the context of materiality. Like what? You should take an assumption that users have a knowledge of business, economics, accounting, and you must assume that users will be willing to read financial statements with reasonable diligence, means with reasonable competence, and assume that users are aware that financials are prepared, presented and audited with materiality levels. Take an assumption that users understand the inherent uncertainties in the measurement that involve estimates. Assume that users know about uncertainties in the company, assumptions, estimates that you have used in financials. Assume that users use the financial statements to make economic decisions. So don't think that users will ignore balance sheet, P&L. So why balance sheet? Nobody in reality will watch the balance sheet. No, don't think like that. Make an assumption. Users use the financial statements to take their economic decision. Make an assumption that users understand inherent uncertainties in the measurement of financial statement item. Make an assumption that users are aware of materiality levels. I make an assumption that they know about the business, they know about economics, they know about auditing, accounting, everything they know. Assume that they are knowledgeable. Assume that whatever you're seeing in the standards and auditing, they know. Now do audit carefully. Don't do carelessly audit thinking that they don't know anything. Anyhow, they don't know anything. Why should I verify all these points in audit? Don't be like that. So that's what they're alerting. They're alerting us indirectly. It's correct, no? That alert is very much correct, no? The recent September exam or maybe some before exam, this was asked for 4 marks. 4 or 5 marks this one. what are the various assumptions auditor has to take about users? What are the various assumptions the auditor has to take about various users in the financial statements in the context of materiality? Next, now 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 I told, right, overall materiality level, performance materiality level, the gap between this is for undetected misstatement. Generally, the moment the total mistake crosses PM level, we will be reacting. You know what we do? When total mistakes identified by us is reaching performance materiality, we directly increase our audit procedure, because there is a high risk here. I will do more audit procedure and I will still see, even then I'm getting more than PM level, I'll see. Then if at all it is getting more than PM level every time, I will tell the management there is unacceptably high risk. I may decide to give qualified opinion or add towards. Able to understand? That's it. Generally, the mistakes that we identify are less than PM level. Forget about less than OM level. It is less than PM level. Are you clear? Okay. There is another level called TM, triviality level. What is it called as? Triviality level. For example, overall materiality 500 crore, performance materiality 300 crore. Triviality level will be 50 lakh. Triviality level will be 50 lakh. What does it mean? What do you mean by triviality level? What does it mean? I told my team, beginning we started audit. I told my team member, we had a discussion. I told my team member that okay, we will do audit, all that. And I told them our materiality overall is 500 crore. But for performing the audit, for audit purpose, we will keep only 300. But for GST, statutory dues there and all, 50 crore will keep. That's a specific level performance. That's a specific materiality level. That's a different thing. I educated all my team. What my team member is doing, whenever they find a mistake, they are comparing with 300 crore and ignoring it. It's less than 300 crore, so ignoring it. Tell me, materiality level, is it for each mistake or aggregate of all the mistakes? Aggregate of all the mistakes. So whatever mistakes that they're identifying, they should accumulate first. Then they should total it. Then they should compare with the performance level. Then they should decide. Now when they're accumulating mistakes, I saw my article assistant working papers. He's accumulating 5 rupees mistake, 10 rupees mistakes also. He's accumulating 5 rupees, 10 rupees, 1000 rupees. Arey, why are you accumulating? Sir, you only told no. First, when I'm doing, since I ignored many items which are less than 300 crore, you're scolding. Now again, I'm collecting everything, again you're scolding. Hey, no. See, you must have common sense. See, 300 crore doesn't mean anything below 300 you can ignore. That doesn't mean 5 rupees, 10 rupees, 1000 rupees, 10,000 and all you have to gather. Have some balance. Triviality level. Trivial means what? Negligible. Trivial means what? Negligible. Okay. Negligible amounts don't consider. See, there is a difference between trivial and immaterial. Yes. Immaterial includes trivial, but trivial may not include immaterial. For example, 200 crore is immaterial. From materiality point of view, 200 crore is immaterial, but it is more than trivial. 10 lakhs immaterial and also less than trivial. Clearly trivial or less than trivial. Are you getting it? So I kept a limit called 50 lakh to my team. What I told my team, any mistake you're finding below 50, ignore it. Don't even think about it. That's negligible mistake. That is negligible. Ignore it. 1 lakh crore size of the company, 50 lakh, 10 lakh, 5 lakh mistakes and all you're finding, that's negligible. No problem at all. Let us keep not 50, 10 lakhs. Let us keep 10 lakh. Okay. Triviality level for the better understanding, 10 lakh. Anything you find 10 lakhs, don't even tell me. Don't even think about it. Ignore it. You found more than 10 lakh. Wait. Don't directly qualify the audit report. Accumulate. Sir, I found mistakes, sir. Purchases overstated, sir, 10 lakhs. Sales, sir, understated in one invoice, 15 lakh. Overstated, understated, should I keep any bracket to minus all that? Materiality will not have any sign. Purchases overstated, how much is the mistake? 10 lakh. Sales, how much is the mistake? 15. Both together on profit, only 5 lakhs impact is there. Is irrelevant for us. That is irrelevant. For example, sir, purchases increased by 10 lakhs, sir. Sales also increased by 10 lakhs. Both are inflated. Automatically P&L profit is zero impact. Now there is no material misstatement. Mistakes should be total. 20 lakh is the material misstatement. What is the misstatement? 20 lakh is the material misstatement. Able to understand. So you should not set off material mistakes. Misstatement, it does not have a direction. Is misstatement plus or minus? Don't have that. Misstatement is a misstatement, that's it. Whether it's a positively impacting profit or negatively impacting profit, that doesn't matter. Sign is not there. For a misstatement, sign is not there. So purchases, understated or overstated, doesn't matter. 10 lakhs, sales 15 lakhs. Okay, some sales related, sale invoice number 1, sale invoice number 5, some 20 lakh mistake is there. Accumulated, total you do it. Sir, it is coming to more than 300 crore. Then financial statements as a whole are materially misstated. I will conclude. So accumulation purpose, I define one more materiality level. That materiality level is triviality level. Any amount which is trivial and less than trivial, I will not accumulate. Any amount misstatement I found which is more than trivial, I will accumulate. Triviality means immaterial. Immaterial is different. Trivial means negligible. Immaterial may not be negligible. Are you getting it? It's not big, that's it, but it's not negligible. Are you getting it? So be careful. Now the triviality level discussion and all is what 450 standard we are going to discuss. What is triviality level? All that is what we are going to discuss in 450 standard. Clear? What is the concept of materiality? Now we will discuss and then freeze the topic. What is the concept of materiality? 1 minute. Yeah. What is concept of materiality? Tell me, when do I say something is material? When it influences others' decision making. See, some mistake is there, nobody is caring about it. Even if we tell also, everybody is ignoring. Is that material mistake? So financial statements must disclose all material items which could influence decisions or decisions of user. Materiality is not always about the quantity, size. Small items also can highlight serious issues. For example, a small fraud that might be significant. Examples. For example, quantitative limits. Is there any quantitative limit on materiality? Yeah, for example, Schedule 3 says, additional note must clearly disclose income and expenditure if for an item exceeding 1% of revenue or 1 lakh rupee, whichever is higher. Notes must disclose shareholders holding 5% share. So from shareholders point of view, 5% is material. Next, from turnover point of view, 0.5% only material. Depends. So 320, what are the relevant standards dealing with materiality? Two standards are actually dealing with materiality discussion in depth. One is 320, which is exclusive. 450 also predominantly discusses about materiality. 320, auditor's responsibility to apply materiality during planning and execution. What is actual SA 320 heading? Materiality in planning and performance of an audit. SA 320 heading is what? Materiality in planning and performance of an audit. 450, it talks about application of materiality in evaluating misstatements identified and uncorrected on the financials. So 450 talks about what? 450 standard heading, evaluation of evaluation of misstatements identified during the audit. The 450 standard heading is what? Evaluation of misstatements identified during the audit. You identified a misstatement, you need to evaluate. What you will evaluate? Is it material or immaterial? Whatever materiality concept you learn in 320, you should apply in 450 when you're evaluating misstatements you identified. 320 standard says you should use materiality in risk assessment process. You must determine materiality while planning the audit. Yes or no? You must use materiality while performing the audit. You must use materiality for evaluating misstatements, and you must use materiality in reporting. Materiality used throughout the audit. Remember, that's the last concept in this particular PDF. Yes or no? Yes, in this particular 320 standard. Now, financial reporting frameworks often discusses materiality in the context of financials. For example, Schedule 3 indirectly says 1% of turnover, 0.5% of turnover. Schedule 3 indirectly says that is material. Characteristics of material. When do we say misstatement is material? Material misstatements are those which will influence user decisions. The judgment is generally based on size, nature, or both. Size of the misstatement, sometimes it is quantity. Nature, sometimes it is quality. Sometimes mistake amount may be small, but it's fraud. If the amount involved, some misstatement is there behind, the reason is fraud, I will not ignore I will ignore the amount, I will see the nature. So materiality depends upon size and nature of the misstatements. Materiality judgments are generally based on user needs, not specific to any individual. Of course, we determine materiality keeping in mind generally all users. It's not based on specific. But in special purpose financial statements, materiality is decided based on the specific user requirement. If financial reporting framework does not define materiality, the above characteristics will give a frame of reference to the auditor. The above characters you can consider in your mind, and then you decide the materiality. Generally, we decide materiality based on Schedule 3. Schedule 3 says Division 2, Ind AS 0.5% of turnover. Division 1, 1% of turnover. I think some percentages were there. Able to understand. Next. So they may ask you this question. Write about materiality in financial. Generally, financial reporting frameworks discusses material. Okay, like what are the characteristics? Materiality is something that influence decision making. It depends upon size and nature. It depends upon common user needs and not based on specific individual needs. If financial reporting framework does not give you materiality, you can take this as a guidance and then you decide materiality. Clear? Next, assumptions I already told. Now, what is performance materiality? What is performance materiality? Auditors find it difficult to test individual mistakes. Hence, misstatements are typically considered in aggregate. Individually, you don't interpret. Generally, you interpret in aggregate. This leads to the concept of performance materiality. What is performance materiality? Performance materiality is a lower threshold, correct? Lower limit set by the auditor below overall. In our example, overall materiality is 500, performance materiality 300. Yes or no? To reduce the chance of undetected, uncorrected misstatement that exceed overall materiality. Undetected misstatements exceeding overall materiality. I told you the gap is mainly for undetected misstatements. So undetected or uncorrected? Uncorrected means what? I identified, but not yet rectified. Undetected means what? I myself did not identify. Undetected means what? In SA 530 sampling, what it is called as, projected misstatement. In sampling topic, the same is referred as projected misstatement. Okay, you will get to know it in sampling topic. So undetected misstatement is called as what? Projected misstatement. Okay, so performance materiality is lower threshold below overall materiality to reduce the chance of undetected, uncorrected misstatements that exceed overall materiality. To reduce the chance of total misstatement exceeding overall materiality. I will not go up, I will not wait up to the time. I will not wait up to total mistake exceeding overall materiality. To reduce the chance, I will keep a lower materiality level. Here itself I'll react. That's how the meaning is. Able to understand. So here the definition is drafted from auditor's point of view, completely auditor's impact assessment point of view. Performance materiality is an amount that is set at less than overall materiality, so that auditor will not wait up to total mistake crossing overall level. Auditor will react at performance materiality level itself. So the probability of total mistake exceeding overall materiality will be reduced by the auditor. Able to understand? Where I will do more aggressive checking, I will react at performance materiality level itself. Able to understand? On this you don't have to think much. Okay, I told you directly application of materiality in reality. Next, there is another materiality, SPM, specific performance materiality. See, specific materiality for a particular class of transaction is different. Specific performance materiality is different, which means the overall materiality, this is general 500 crore. Specific overall materiality for GST purpose 50 crore. Performance materiality generally 300 crore. For GST purpose 30 crore. Like that. For GST overall materiality 50. Why will I wait up to 50? I will react at 30 crore itself. That is specific performance materiality. Okay. So performance materiality may also apply to a specific class of transaction account balances disclosure set levels lower than their respective. It's not lower than overall materiality, lower than their respective materiality threshold. For specific performance, for particular class of transaction, I can have a specific materiality level. There also I can have a specific performance materiality which is lower than the specific materiality level. Why? What is what is the purpose of performance materiality? Like basically, what is the purpose? Setting performance materiality lower than overall materiality reduces the risk of aggregated misstatements will remain undetected and material to the financials. See, I will not wait up to total the moment it crosses performance. Oh my God, so many mistakes will be there. I will assume. Then I will increase my audit procedure. I will try to find out many more mistakes. That reason. So, performance materiality, a 4 marks. Finally, how do we determine materiality in reality? We use benchmarks. We use some benchmarks. For example, when I introduced this particular topic, I used turnover benchmark. 0.5% of turnover. Turnover is the benchmark for me to decide materiality. But you may choose some other benchmark. You may choose profit after tax. Somebody may choose profit before tax. Somebody may choose net worth. Somebody may choose equity. Somebody might choose fixed assets, amount invested, amount of capital employed, return on investment. Somebody might choose some other thing. Yes. Determining materiality involves auditors' professional judgment. Generally, how materiality, a percentage is applied for the benchmark to determine materiality for financials as a whole. Many times asked benchmarks applying, determining materiality involves auditors' judgment. Generally, a percentage is applied to chosen benchmark. Correct? So, what are the factors influencing the benchmark, sir? In this company, turnover is there, amount invested is there, capital is there. What is the benchmark? For example, it's a newly started insurance company, a capital benchmark for determining materiality. So it's a very big company, sir. Banks, sir, long back they started. So much capital and all, nothing in this company. Then take turnover, take deposits. Are you getting it? So for different entities at different times, different benchmarks might be suitable. Now, so what are the factors influencing benchmark? Elements of the assets, liabilities, equity, revenue. So what type of assets, liabilities, equity, all that is there in the company? Check out. Users may focus on specific items like profit in some companies. In some companies, they focus on revenue. In some companies, they focus on assets. When evaluating performance, for example, insurance company, assets is most important. Liquidity is most important. So no, for a normal manufacturing company, revenue is most. Are you getting it? Revenue is most important. So for NGO, again, net assets might be important. For NGO, stability purpose, net assets might be important. Then take net assets and decide materiality. Then entity's nature, life cycle stage. Suppose that the entity is at the beginning, then capital you take benchmark. Entity is already well established, saturation point it is there. Turnover you may take benchmark. Industry, banking industries, deposits you may take benchmark. Economic environment impact the benchmark. So entity's nature, life cycle, industry, and economic environment, these will impact benchmark selection by the auditor. But in most of the companies, what is a blind benchmark? We go turnover. The ownership structure, financing methods. Is it a government or non-government? Government na capital employed I may take benchmark. Non-government I'll take turnover benchmark. For example, is it a debt financed entity? All that you see. If a benchmark is volatile, for example, no volatility. Suppose if a benchmark like PBT, for example, is very volatile, array PBT is every year PBT will vary, then don't take that benchmark. Choose some other benchmark which is not volatile. For example, total revenue. Revenue may be not volatile. Only PBT, profit before taxes, net profit is only volatile. Turnover is same only. Many indirect overheads and all is there, right? They are very volatile. That's the reason why profit is affecting. So revenue stable, then take revenue. Revenue also volatile, then take capital. Are you getting it? So volatility of the benchmark. See, simple. Materiality means what? I need to check some amount. How will you arrive this amount? Take some benchmark in the balance sheet P&L, apply some percentage. Which benchmark I should choose? It depends upon assets, liabilities, equity. What assets and all were there? Study once. Okay. See where people are mainly focusing on in your company. Profit they are focusing. If at all they are focusing profit, then based on profit you decide. See, on turnover if I apply 0.5, on profit also will I apply 0.5 only for bit? No. On profit generally I apply a higher percentage to decide materiality than when I am applying percentage on a turnover. See, percentage is not 0.5 constant. On turnover I will take 0.5. But on capital I may take 1%. On profit I may take 5%. Judgment, Auditor has to decide what is material in this company. 5 crore material, 50 crore material, 500 crore material, 200 crore, which is material. Auditor only should decide. Consult with management, take their help also. They would have decided some materiality level, take their help also. Look at the ownership structure, financing method, look at the entity nature, what is the life cycle stage, industry and economic impact, all that you need to check. And if a bench, also check PBT. Are you clear? So examples of benchmarks, what are they? Profit before tax, total revenue, gross profit, total expense, total equity, net asset value, net worth, working capital, anything. Selection of benchmark. Relevant financial data. So from where you can select benchmark, which data, current year data you will use, last year data you will use, budget you will use, which one? That is also auditor choice only. The relevant financial data for choosing benchmarks includes prior period financials, current period financials, budgets, forecast of the current period, where you may have to adjust for latest circumstances, industry and economic environment. So current year budgets and all you take, apply latest changes in the circumstances and all, decide when I will take budgets at the beginning of the audit. At the beginning of the audit, current year financial data is not available. That time I will decide materiality based on budgets. Sir, current year already over, sir. Budgeted amount is different from actual amount, sir. So much difference is there. Then revise the materiality. Revision concepts. Are you clear? If materiality is determined on PBT, but this figure shows exceptional fluctuation, the auditor may use normalized PBT based on past results. So if at all PBT is very fluctuating compared to last year's, then I will take normalized PBT based on last year. Normalized PBT means what? Average PBT plus growth rate. That's a normalized PBT generally. In this year, some exceptional item happened, extraordinary item happened, prior period item happened, ignore it. So ignoring that, what is the normal PBT? Calculate. So finally, how do we apply? Professional judgment determines the percentage. You should apply your brain and decide what percent to be applied on the chosen benchmark so that materiality amount can be determined. Generally, the percentage for benchmarks like PBT is typically higher than that of the total revenue. The percentage of benchmark for PBT is higher compared to total revenue. You know what is the best accepted benchmark in the market right now? Materiality is equal to 0.5% of turnover or 5% of profit before tax, whichever is. This is what many big four and all follow. Be able to understand. That's it. 320 standard is over. I hope you are clear on this. So materiality determination. So materiality means what? Materiality is not always about the quantity, but also quality. Qualitative factors are also to be considered. Quantitative factors, for example, schedule 3 and all is giving little guidance on quantitative. Okay. Financial reporting framework generally discusses characteristics of materiality, if they're influencing decision making of user, size and nature, common user needs. These are the points or parameters I will take into account while deciding materiality. If financial reporting framework does not contain materiality reference, no, these points I will take into account and then decide. And you must assume about users that they are reasonably knowledgeable, they aware of all the consequences, they know uncertainty is there in the financial statements, and they are willing to read the financials and take economic decisions. You make assumptions like this. Don't think users are dumb, don't think users don't know anything. Assume that users are really knowledgeable and do audit accordingly. Then performance materiality. Performance materiality is a level which is lower than overall materiality to reduce the chance, to reduce the risk of undetected, uncorrected misstatements that exceed overall materiality. Performance materiality may also apply to specific transactions which is less than their respective materiality level. Yes or no? Benchmarks. Ultimately, auditor's judgment. Determining materiality involves auditor's judgment. A percentage is applied on the chosen benchmark. Factors influencing. What are the type of assets, type of liabilities, type of equity, type of revenue, type of expenses the company has? Depending upon that, I may choose a different benchmark. Users focus, I will see where are they focusing, profit or revenue, assets. What is the nature of entity? I will see what is the life cycle stage. Is the entity at the beginner, a startup, saturation, or industry, economic environment? I will see ownership structure. I will see, if a benchmark is volatility of the benchmark, I will see. If the benchmark is very volatile, I will choose some other benchmark. Sources from where the benchmark can be selected: current year financials, Prior period financials, sir, I'm only doing audit now, I don't want to take prior period data. Then take budget data of the current year, adjust it for changes in circumstances and industry environment. Sir, for example, changes in circumstance, budget I took. This year company suddenly purchased a big machinery, plant capacity increased, adjust it. Budget no, adjust plant capacity and revise budget it. Revise the budgeted turnover, then apply benchmark. Then apply a percentage on the chosen benchmark. Sometimes for a particular class of transaction, account balance and disclosure, materiality level may be decided separately. For certain class of transactions, account balances and disclosure, which are particularly sensitive or significant to users, misstatements below materiality could influence decisions, like law regulation, industry specific disclosures might be required. Focus on business aspect. For example, industry specific disclosure, NPA. For NPA purpose, materiality I may apply different. Next, revision. Okay, new circumstances arising, new information, actual results are different from budgeted, higher risk estimated than initially predicted. Enhanced understanding, for better understanding, I may revise the materiality. Documentation, overall materiality, specific materiality, performance, general performance materiality, specific performance materiality also should document any revision to the above. And materiality and audit risk are considered throughout the audit for identifying and assessing the risk, for planning the further audit procedure, for evaluating the impact of uncorrected misstatements on the overall audit, and while forming opinion thereon. In all these stages, I will consider materiality 320. That's it, 320. Okay, now we will have to cover 450. Okay, 2 minutes, we will start 450. Yes, let's begin the topic internal control, the last segment in the risk assessment topic. Actually, in risk assessment, there are so many topics. At the introduction I gave, how many subtopics were the risk assessment topic? Is there understanding of the entity? Is there IFC? Is there 265 we covered in this topic only, 450 we covered here only, 330 we covered here only, automated environment, is there digital audit? Yes or no? All that subtopics, many. 320 materiality we covered in this only. Only one topic that we kept pending in this chapter is internal control. That we will discuss now. Now, what is an internal control? Internal control is nothing but a process, correct? It's nothing but a process. So any process, a policy, a procedure, a standard operating practice which an organization follows, so that process is called as what? Internal. That process is called as internal control. Like, why these internal controls? The objectives are very simple. To safeguard the assets. Ultimately, main objective is safeguarding. The company has to protect its assets, and they need to ensure resources are used correctly, efficiently, effectively. Yes or no? The resources has to be used efficiently and effectively, correct? The internal control objectives are safeguarding of the asset and efficiency and effectiveness of operations. And every entity has to ensure they comply with laws and regulations when they are doing business. And by byproduct of all this is reliability of financial report. The byproduct of all this is reliability of financial reporting, correct? Now, so what is internal control? The standard 315 that defines internal control is a process. It is designed, implemented, maintained by the top management, governance, management and personnel to provide reasonable assurance about the following objectives. Internal control is a process. Typically, it's a process. At the end of the day, we lock the door and then go. That's a process. Yes or no? We switch off the power supply. That's a process. We delegate this to somebody. That's a process. Security guard is a process. Billing system, only after payment is made, bill will generate. That's a process. These are all various processes. Everything and anything that you see in a day-to-day affair is mostly their processes, and these processes are internal controls. Now, here controls definition is there, that you leave it, it's okay, not required. And the design, implementation, maintenance of controls, no, how it will be designed, how it will be implemented, it depends upon the size and complexity of the entity. And auditor has to understand internal controls, obviously, to identify potential misstatement, to identify risk, and for designing further audit procedures. For these purposes, auditor has to understand the controls. A brief point only they gave. Okay, next. Now, internal controls. See, management, no, in every company, they implement controls. Now, In spite of these controls, many theft will happen, frauds will happen, errors will be there, all that. Why these errors are happening? Controls are implemented, right? Why are they not preventing it? Controls, at the end of the day, they are processes. At the end of the day, they are implemented by human beings. Yes or no? And these processes have so many limitations. Internal controls, that's why you see the definition, meaning you see, internal control can only give reasonable assurance about various objectives of the controls. Internal controls cannot give you absolute assurance. They can't absolutely prevent. Security guard is there who has to ensure that unauthorized goods, unbilled commodity should not go out of the store. He may not verify it thoroughly. Yes or no? So there are so many limitations. Internal controls can only provide reasonable assurance about entities' objectives. Like why reasonable assurance? What are the reasons? Human judgment in decision making. Errors in judgment can lead to control failures. So we may take a wrong judgment. Yes or no? Design errors in the controls might occur. When we are designing the control, error might occur. We might not identify all. For example, a security guard is kept in a very big supermarket store. Okay, while exiting, he need to check entire bill and he need to match the bills in the trolley. I mean items in the trolley. But the design itself is faulty. Why? He should not check manually. He should check in a scanner. In bill, some barcode must be there. That and this, he should be scanning. Automatically left out items will be unbilled items. But this technology, who is using? Nobody. Are you getting it? So, and for example, in some foreign countries, in US, there is an Amazon store where no human being will be involved. And you can go take the car into the store, you can select whatever you want, and then by the time you come at exit place, that will be there. For example, you are ordering goods on Blinkit or Amazon, whatever you order, that only you will get. But you go to a physical D-Mart or Big Bazaar or some big store, you can bring extra commodities in the trolley and come out. Nobody will verify that. Yes or no? So design lapses. Why design lapses? Human judgment. Next, lack of understanding the purpose. Some people who are responsible for controls, responsible individuals may not fully understand the purpose. The security guard was told, take the bill and stamp and send. He was not told to verify item by item, item by item. He may not understand the control purpose. This can result in ineffective use of reports and it can lead to incorrect actions. Security guard will report at the end of the day, no deviations. That report management is using, which is incorrect. Sometimes collusion happen. The billing person might collude with security guard. So controls can be overridden by collusion of individuals or management can override. Example, side agreements with customers results in improper revenue recognition. And there is another limitation, judgments by management. Management may choose controls based on judgments about nature and extent of risk that they are ready to take. Like D-Mart, don't they know that some customers will take extra goods outside? They know it. Then why are they not reacting? Cost of reacting is more high. Getting it? Managements, they accept some risk. I know some theft will be there, some pilferage, we call it as petty thefts. Some pilferage will be there, but to protect the pilferage, if I put more security guards, the cost of security guard will be more high. So companies will accept some risk by default. And limitations. In smaller entities, the limitation is little more different. What limitation? Very few employees will be there. Where segregation of duties is impractical, the same person will bill, the same person deliver. If you go to a small store in your road, in your nearby house, if you go to any small store, grocery store, yes or no, one person only will handle everything. So the owner himself manages and they will have more effective oversight, but that may also override controls due to less structure. Suppose if the owner is left, manager was given duty, single person is there handling entire store, he can easily do frauds. So the auditor must consider these factors when assessing risk in smaller entities. In smaller entities, controls may not be formal. Controls will be less formal. Owner himself is managing. He himself has entire oversight. So consider these points in smaller entities and accordingly plan the audit. So what are the limitations in internal control? Human judgment can go wrong. Lack of understanding the purpose. Collusion among the people. Management might be ready to accept some risk. These are the limitations in internal control. That's why no matter what, internal controls cannot give you absolute assurance. They can only give you reasonable assurance. Okay, next. And remember, in limitations of audit, nature of financial reporting, inside that or somewhere nature of audit procedure, there also we saw this point in inherent limitations of internal control is also a limitation for audit. Next. Now, so internal control system, like what is an internal control system? You know, there is a framework called COSO, Committee of Sponsoring Organization. It's an international body. This particular body divides internal control system into 5 components. In a company, control system means what? The entire system. Suppose you go to Reliance Trends, you can see some system is going on. There is a system. This entire system can be conceptually categorized into 5 parts. What are they? Control environment, risk assessment process, information system, control activity, monitoring of control. And if you remember, in bank audit, understanding of bank's risk management process, one topic is there. There I told you that is similar to this risk assessment internal control chapter. The same discussion will come here in depth. After finishing this entire components of internal control discussion, you go back and then see the bank audit risk management process. You will understand better. Understood? Fine. So when you see any organization, there is some system which is visible. Now what exactly that system consists of? If conceptually, theoretically, if we have to divide that into multiple parts, 5 parts it will come. 1, control environment. There is some superior authority in the company who is monitoring everything. Control environment. Risk assessment process. You see, there are so many doors, locks will be there, cameras will be there, so many processes will be there, sub processes. Yes or no? You go to a bank, you try to withdraw money, so many people involved, 2-3 people will involve. So somebody is trying to figure out what can go wrong. Risk assessment process, and they are designing the control activity. And this entire system is implemented. This entire controls are implemented through information systems, computers. And after implementing all this, whether is this entirely functioning properly or not, an audit function is going on, internal audit is going on, internal inspections are going on, that is monitoring. So internal control system is broadly divided into 5 components. 1 is control environment, risk assessment process, control activity, information system, and monitoring of controls. Now what do you mean by control environment? Control environment has so many elements, you know. Control environment has so many elements. First of all, control environment means what? Control environment talks mainly about governance, management functions, and attitudes and actions of top management. Control environment sets the tone of the organizational controls, the tone of an organization. Getting it? Next, the following are the elements. The following are the elements of control environment. 1, communication and enforcement of integrity and ethical values. So control environment, top management will communicate. You know, they design integrity. They design, you know, some policies, code of conduct. In many companies, code of conduct will be there. Next, the effectiveness of controls cannot rise above integrity and ethical values. Absolutely true. Yada raja tada praja. Yes or no? The internal controls in the company, control system effectiveness, whether a control is effective, whether an employee is following his rules, it depends upon the effectiveness of top management. If top management is following rules and they are very strict in monitoring, a low level employment will follow. Low level employees will follow that. Integrity and ethical behavior influence effectiveness of control. That's why in companies, in the initial days when you were recruited, they will give training about their code of conduct, code of ethics, integrity, all that. They'll train you why you have to be honest, and they will have policies for punishment, policies for violations, punishments for violations. These will be communicated through policy statements, code of conduct, management actions to eliminate unethical behaviors, unethical incentives. So no, management action, for example, training, employee training, frequent employee counseling. Understood? So communication, enforcement, and integrity of and ethical values, this itself can be asked as a 3 marks question. And further, in the previous, inherent limitations of internal control many times tested as a 4 marks question. What is an internal control? What are the objectives of internal control? This point here can be asked as a 4 marks question. Next. And sometimes no, what are elements of control environment? Straight question they'll ask. Elements of control environment. What are the elements of control environment? Communication, enforcement of integrity and ethical values, commitment to competence, participation by top management, management's philosophy, organization structure, assignment of authority, HR policies. Only side headings you have to write. They will ask you in exam what is a control environment, what are its elements? 4 marks question. You need to write only side headings. Sometimes they will go in depth. One of the element of control environment is communication and enforcement of integrity and ethical values. Then you need to write these 3 points. Give few examples. 3 marks question they'll ask. Second one, another element is commitment for competence. How management is strongly focusing on competence of people. That's why training policies will be there. Rigorous training will be there. Rigorous interviews will be conducted to hire only trained person. So management consider competence levels for jobs and ensures proper skills and knowledge is there for the task, so that the task will be delegated. This also shows whether the entire system is operating effectively or not. And participation. Top management has to involve, which is independent from management. Yes or no? So involvement of those charged with governance includes independence from management, experience, stature and scrutiny. Their experience will be useful, their stature will be useful, they will scrutinize what everyone is doing, appropriateness of their actions, interaction with internal external auditors. So if top management is participating in all these ways, that shows a culture, that shows, oh my god, top management is monitoring, so we have to sincerely follow the rules. Lower level people feel that they have to follow the rules. Management philosophy. Now what is their approach in business risk taking? Okay, approach towards financial reporting. Some companies, they'll be very aggressive in financial reporting. They take beneficial interpretations. Approach to information processing and personnel. In approach to information processing and personnel, how are their approach to staff? How is their approach towards financial reporting? How is their approach towards risk taking? That also reflects you what is management's philosophy. You understand better about management philosophy. You understand about them, you understand the culture. Next, organization structure. Structure of an organization depends upon the size basically and nature of the activity. Okay, structure refers to what? Framework for planning, executing, controlling and reviewing activities. So how a company plan their activities, how they execute, how they review, all that. And it includes who are the key authorities, who are the responsible people, to whom they need to report. Like team member have to report on team leader have to report on manager has to report on main manager or president or vice president. Next, assignment of authority. It covers how authority and responsibility are assigned and how reporting hierarchies are established. How in this company assigning of roles is happening, who is deciding ultimately. Generally board of directors will decide everything. And HR, these are the policies related to recruitment, how employees are recruited, how they were trained, and evaluating employees works, promotion and compensation. Recruitment process, for example, if you see, they focus mainly on qualification, integrity, experience and skill set. Training includes roles and responsibilities through seminars and schools. Promotions are based on performance, ensuring advancement of qualified personnel. Only people who are qualified for promotion, they will be promoted. So this entire are the elements of control environment. These are all elements of control environment. So communicating ethical values, commitment to the competence, management philosophy, participation by top management and organization structure, assigning the authority and powers and HR policies. These are all collectively represent control environment in a company. And if this control environment is very effective, it's a highly indication that control systems are also effective. So control environment is the top. It sets tone of the organization. Understood? Next, by the way, if control environment is satisfactory, does it mean internal control systems are 100% functioning effectively? Satisfactory control environment is not an absolute deterrence to fraud. This itself can be given as a 4 marks question. Many times it came two times. I saw two times. I remember in 2018-19, that time this question came. A satisfactory control environment is not an absolute deterrence to fraud. You know, a satisfactory control environment can reduce the risk of MMS and may help lower the risk of fraud. However, it is not an absolute deterrence. Why? Frauds will happen because of deficiencies in control. Weakness in control environment can reduce effectiveness of controls, especially in relation to frauds. Suppose management is failing to address some IT security risk. Improper changes to programs are happening. Unauthorized transactions are processed. So what is the role of control environment? Control environment does not directly prevent, detect, correct MMS. It influences the evaluation of other controls. If control environment is good, auditor will feel that controls checking may be little less. So monitoring of controls, operation of specific control objectives. It influences auditors' evaluation of other controls, such as how monitoring of controls are working, how other specific control activities are working. So control environment effectiveness influence auditors' decision making of evaluation of other internal control components. The control environment affects auditors' evaluation of risk mainly. So control environment is not an absolute deterrent to fraud. See, effective control environment lower the risk of MMS. Make sure controls are operating effectively. Lower control environment effectiveness will lead to more failures in internal control. So control environment is no doubt important. It influences auditors' decision making on what controls to evaluate further, what need not be evaluated further. So that's about, control environment. So one element of internal control is completed. One component of internal control is completed. Control environment. The second component is risk assessment process. This itself can be asked as a 5 marks question. One of the important component of internal control is risk assessment process. Remember, you can design a process only when you know something can go wrong there. Yes or no? Very simple. The robustness of internal control depends upon robustness of risk assessment. If I know that so and so fraud will happen there for a big amount, I know how to put a control. Suppose you see you go to airport, security checks and all will be there. You go to metro station, for example, security checks will be there. See, every control is, they first anticipate what can go wrong, then accordingly put a control there. Yes or no? First understand the entity's process. The entity's risk assessment process includes identifying risks. The entity will do risk assessment primarily. It assists the auditor in identifying risk of MMS. So first understand entity's risk assessment process, how they are identifying risks. Once they identify risk, then they design a control, so that risk will not be arise, that risk will not turn into reality, that risk will be mitigated. Auditor evaluates whether entity risk assessment process is appropriate according to the circumstances, which is a matter of professional judgment. The auditor assesses whether entity has a process for, mainly in risk assessment process. Risk assessment process is one of the component of internal control. Internal control is something management responsibility. Risk assessment, who should do? Management. So auditor will evaluate risk assessment of the management to know whether it is appropriately done. So specifically what he will do, auditor assess whether entity has a process for, entity has to identify business risks relevant to financial reporting objectives. Entity has to evaluate significance of identified risk. They have to decide likelihood of risk occurring, and they need to decide actions to manage. You know what action they will do? They will design and implement a internal control there. So auditor has to evaluate how the entity is identifying risks. How are they determining its significance? How are they determining likelihood? How are they deciding on actions to manage those risks? So auditor has to observe entity's risk assessment process as a part of his risk assessment. Primarily, risk assessment will be done by entity throughout the year. They will have a risk management committee. Entities, companies, listed companies, they must have a risk management committee, just like an audit committee. You might have heard in law, CSR committee. Audit committee will be there, finance committee will be there. Able to understand? So risk management committee will be there. So the companies, they continuously identify various business risks, especially financial reporting objectives. For example, in hospitals, doctor's prescription will, number of prescriptions used by the doctor is compared with the bills raised on the patients in private hospitals. The prescription document will be there, right? It will have a numbering. It will be compared. Total number of prescriptions issued, total number of bills paid by the patients. Number is not matching, they will investigate. So risk assessment process, the auditor has to understand the entity's risk assessment, which is one of the component of internal control. Then information systems and related business. What is this? Information systems are nothing but what? Accounting systems, internal control systems, various softwares which a company uses, like identify transactions in the entity operations which are significant, and understand how these transactions are initiated, recorded, processed and corrected and transferred to general ledger and ultimately reported in financial statements. See how a purchase is happening in the company. First of all, how a purchase, like first a company raises a purchase order, first they will receive a request from stores department, then they will make a purchase order, then they will approve it, then they place it with the vendor, then the vendor will send the goods, then our team will give GR and note, then the same will be entered in the stock record, then it will be entered in the accounts record, then finance team will prepare a check, then the check will be approved, then amount will be paid to the party. How it is initiated, how it is recorded, how it is processed, how it is corrected if not there is a mistake, how it is transferred to the books of accounts, and finally in the financial statements. Understand the information system. And accounting records, check related accounting records, supporting information like bills, documents, vouchers, what are they maintaining, specific accounts used to initiate, like which employees monitor, which employees using. Next, evaluate how information system captures events and conditions that are significant to financial statements, how information system is capturing significant events and transactions. For example, in the computer software, accounting software, some penalties paid. So how it is capturing it? Or a provision is created for a contingent liability, or provision is created for some. How provision is created in the books? What is the mechanism company is following to identify items where provision is required? So what system company has? Understand the process used to prepare financial statements. SS controls surrounding journal entries like voucher controls, purchase order control. So when a journal entry comes in the system, how a journal entry is passed? Okay, accountant will pass. Who will approve it? What are the controls around journal entries? This entire understanding is called information systems understanding. Remember, understanding information systems from business angle is different. We are discussing it from audit angle. Entire this discussion we are doing it from auditor's angle. That's why we are only focusing on narrowly on a financial part. Internal control components 5 is there, right? The discussion is so big. That is so big actually as per COSO framework. That is from management point of view. This is from auditor's point of view. Understood? So information systems means what? Look at the class of transactions which are significant. See transaction procedure. Look at the accounting records. See how significant events are captured. Look at the financial reporting process. How the controls are there over journal entries. See keywords. How are they giving the entire matter? Yes or no? Next. Then the companies will implement control activities. After they understand the risks, after they understand what are all various risks possible, the companies will design and implement controls. The controls which they design and implemented, no, that's a control activity. So control activities are nothing but policies and procedure that ensures management decisions are carried out, like authorization controls, segregation of duty, physical controls like security guards, CCTV cameras, performance reviews. Now, control activities, whether in IT system or manual system, they serve various objectives and are applied at different levels of the organization and functional levels. So control activities, no, they may be IT controls or manual controls. Security guard is a manual control. Bill will be generated only after receiving the payment. That's an IT control. Able to understand? The auditor focuses only on those control activities. Which controls auditor is mainly focusing on? Those controls related to transactions, balances and disclosures. See, in a company, no, stock related controls will be there. How much maximum stock should be maintained, how much minimum stock should be maintained, that controls also are there, policies were there. That control is irrelevant for me. I am not bothered about it. For example, I have been auditing an airline company. That airline, suppose Indigo Airlines is there. It has a fleet of some 1,000 flights or some 500 flights it is there. These 500 flights has to be scheduled every day for different routes. Whether are they scheduling every day for different routes, the duty was delegated to some head, operations head. Whether he is functioning correctly or not, is it my duty as an auditor? No. I am bothered about which controls. I am bothered about control activities that are related to transaction processing, balances, disclosures. which are relevant for my risk assessment processing. So determining control activities, relevance, which controls are relevant? Control activities are relevant when, when a control is relevant for an auditor, when they relate to financial statements, and where there are significant risks and substantive procedures alone are inefficient, they are not sufficient. Sometimes only substantive, how many transactions you will verify, whether sales are properly made or not, how many transactions you verify. Look at the sales system, look at the sales processes. Auditor has to test internal control when substantive procedures alone cannot provide evidence. Suppose if there is one exceptional transaction, unusual transaction happened, only one transaction happened, that category, their controls need not be checked, direct transaction you check. Next example, they are, controls are considered relevant based on auditor's professional judgment. Controls are relevant when they are considered as relevant based on judgment of the auditor, or when they are dealing with financial statements item where significant risks and substantive procedures alone is not sufficient. Then controls will be relevant for the auditor, and when controls are relevant for the auditor will test those controls. Understood? So this is control activities. So control activities are nothing but what? They are policies and procedures. These may be IT controls or manual controls, which will have different objectives which are implemented at different levels. Yes or no? Auditor will focus on which control activity? Auditor focus on those control activities which are dealing with transaction balances and disclosures. How do you know whether a control is relevant or not? Control is relevant or not decided by professional judgment of the auditor, and also decided based on significant risk involved. Where only substantive procedure may not be sufficient, then auditor decided that control is relevant and he will use that, he will test that control. So control activities discussion is over. Easy. They may ask you, every of this component is tested in the past exams. I'm telling you, risk assessment topic is so lengthy. There are 7 to 8 subtopics in this chapter. Or no, internal control as a whole itself is one topic. From internal control, the weightage is 4 to 5 marks. From internal control, what we are discussing in the past half an hour and still another 1.5 hour probably. Total is 1.5 to 2 hours approximately. The weightage is 5 marks, 4 to 5 marks weightage. Control activities, this itself can be asked as a 5 marks question. Clear? Next, monitoring. Within the control system itself, monitoring will also be done. The company only will design. See, the company will identify risk. Management will identify risk, what can go wrong. They design a control through information system, and they only monitor whether this is working correctly or not, to find any lapses, so that they upgrade the control, they redesign the control. Internal audit is one of the monitoring functions. Are you clear? Monitoring. This is a process to assess effectiveness of control activities. Very simple. Internal controls over time. What is a monitoring? Monitoring of control. Monitoring of control is a process to assess effectiveness of controls implemented. Understood? For example, internal audit walkthrough test. Monitoring involves assessing effectiveness of controls on a timely basis and taking necessary remedial actions when any weaknesses are identified. Monitoring means what? Monitoring means assessing effectiveness of controls. How management monitors controls? Management monitors controls through ongoing activities or separate activities. Every day some monitoring will be happening. Every day one sudden inspector will be coming. Inspection department, we call them as internal inspection departments. And separate activities, internal auditors will come and check periodically, once in a month, once in a quarter, like that. Suppose you take a bank, concurrent audit is an ongoing activity. Internal auditor is a periodical activity. Able to understand? So ongoing, they were built into regular activities like management and supervisory review. Separate, they conducted periodically to assess effectiveness of the control. And monitoring may involve sometimes in involvement of external parties. Okay, monitoring may involve sometimes information which is received from external parties. Sometimes customer might give a complaint. Regulatory inspections might give comments indicating problems which need improvement. So monitoring of controls. Monitoring means what? Monitoring is a process to assess effectiveness of controls over time. So monitoring assess effectiveness of control on a timely basis, taking necessary remedial action. Management monitors controls through ongoing activity or separate evaluation. Sometimes monitoring may be from external parties. That's it. 5 components of internal control is completed. Let's once brush up once again now. I will look at once. components of internal control. 5 components: control environment, risk assessment process, information system, control activities, monitoring. Control environment, it means governance, management functions, and attitudes and actions. It is the tone of the organization. Now, elements of control environment: integrity and ethical values. The effectiveness of controls cannot rise above integrity and ethical values of top management. A control is effective only when the top management is effective. If they are ethical and integrity, 99%, the controls will also be very effective. Integrity and ethical behavior, no, they influence the effectiveness of controls. Obviously, yes or no? How the people inside the organization, are they ethical? Communicated through policy statements. How the ethical values, integrity is communicated, policy statements, code of ethics, management actions, all that. And another element of control environment is competence. Management consider competence levels for jobs and ensure proper skilled people are recruited. And participation. Control environment also includes one more element: participation, involvement of top management who are independent from the normal management. Their experience and stature, scrutiny, how they're taking, what actions they're taking, how far they're appropriate. Interactions with auditors, how are they interacting? All this will influence competence of the, participation by top management. Are they participating thoroughly or not? Also look at management philosophy. Management philosophy encompasses covers management's approach to business taking, management's approach towards financial reporting, management's approach towards personnel and information processing. Control environment is again influenced by one more element: size, nature of business. Organization structure means what? It's a framework for planning, executing, controlling, and reviewing activity. Organization structure: top management, middle management, low management, where they plan and distribute activities among themselves. It includes key authority, responsibility, and reporting lines. And control environment also includes assigning of authority. Organization structure alone is not sufficient. You should assign them roles. So covers how authority and responsibility are assigned, how reporting hierarchies are established. And most importantly, HR: recruitment, training, evaluation, promotion, compensation. Training includes roles and responsibilities through seminars. Promotions are based on performance. All these points collectively give an idea about control environment, whether it is effective or not. Just because a control environment is satisfactory, it doesn't mean there are no frauds. Remember, a satisfactory control environment can reduce the risk, may help lower risk of fraud, but it cannot 100% eliminate frauds. But remember, weakness in control environment will reduce control's effectiveness, especially in relation to fraud risk. If control environment is weak, there is a high possibility that frauds will happen. Management failure to address IT risks. For example, they know some IT issues are there, IT weaknesses are there, and they fail to address. Automatically, some improper changes might happen to the IT systems, and unauthorized transactions might happen. So, what is the control environment role? It cannot directly prevent anything or correct anything or detect anything, but it influences my perception of other controls. Auditor perception on other controls is influenced by effectiveness of control environment. So the control environment affects auditor's evaluation of risk of MMS. Now the second component is risk assessment process. Risk assessment process means what? Auditor will check whether entity is identifying risks, whether the entity is evaluating significance of the identified risk, and what is the likelihood of risk, and what are the actions to be taken. And third component is information system. Identify transactions in the operations, understand how the transactions are initiated, identify the related accounting records, identify how significant events are captured. Auditor will evaluate how the financial reporting is done. Auditors will evaluate controls over journal entries. Control activities, these are the policies and procedures where management directives are carried out. Application: control activities may be implemented through IT system or manual system to serve various objectives which are implemented at various levels. Auditor focuses on only those activities which are related to transactions and balances. Whether a particular control activity is relevant or not is a matter of professional judgment of the auditor, and it also depends upon how they are relating to financial statements. And if there are significant risks, substantive procedure alone may not be sufficient, so the control may become relevant for the auditor. Clear? Monitoring. Monitoring is a process to assess effectiveness of controls on a timely basis and taking remedial action. Management monitors controls like two methods: ongoing activity, for example, concurrent audit in a bank. separate activity like an internal audit in a bank. And sometimes monitoring may involve using information from external parties, like complaints received from customers, which shows that our staff is not functioning correctly, which identifies indirectly a weakness in our internal control system. Are you clear? Then we have the discussion, what do you mean by controls relevant to audit? Now controls over completeness of information, all that. Okay, fine. So from here we will discuss after a small break. Okay, another 1 hour or 1.5 hour maximum, this topic internal control will be finished. Until now, thorough, clear? Let's continue the discussion. Controls relevant to audit. So see, a company will have obviously so many types of controls. As per COSO framework only, the controls are again 3 more types. Operating controls, compliance controls, and financial controls. We are predominantly concerned about financial control. We are not much concerned about operating controls and compliance controls unless they have an impact on financial reporting or books of accounts. So if any controls that are having relevance to financial statements, that are having relevance to transaction processing, all that, then those controls only will be relevant for audit. Like here you see, the auditor obtains an understanding of internal controls which are relevant for audit. Most of the controls related to financial reporting may not be relevant for auditor. Again, within the financial reporting controls, some controls may not be relevant for auditor. Okay, next, whether a control is relevant to audit or not is a matter of professional judgment. Now the following are the factors which will affect this judgment. Okay, materiality of the control, materiality of the controls, okay, and significance of the risk associated, size and operations, the nature, organization, ownership characteristics of the entity, diversity and complexity of operations, applicable legal and regulatory requirements, circumstances and applicable internal control components, nature and complexity of the systems, whether a control prevents, detects, corrects individually or in combinations. Like sometimes a control may be relevant, a control may not be relevant, but its related control might be relevant. Able to understand? So combination of controls, as an individual it may not be relevant, but as a combination it might be relevant. So many factors. Any 4 points in this? Whenever you see factors, the factors points will be more or less like this only: size of the entity, nature of the entity, yes or no, significance of the risk. For example, materiality, significance, size of the entity, and applicable law and regulation. And yeah, these 4 are easy to remember. Okay, and of course, nature of organization, ownership characteristics of the entity, all this will decide whether a control is relevant or not. Next, there are some controls which are not relevant. Certain controls, though important for operations, may not be relevant for audit. Like what are these controls? For example, an airline's automated system for maintaining flight schedule may not be relevant to audit. Understanding all internal controls in every operating unit may not be necessary for the auditor. So auditor need not understand all controls, yes or no? That's it. So this is about controls relevant to audit. Many a times they have asked this. Write about controls relevant to audit and not relevant to audit with an example. Understood? All of you? So many controls which are related to financial reporting may not be relevant to audit. So not necessarily every financial reporting control is also relevant for auditor. For an auditor, which controls are relevant? Whatever will influence financial statements, preparation thereof, whatever, those controls might be relevant. Further, if auditor feels at a particular place controls is, he decided not to test, he want to go only with substantive procedure, that time that control is irrelevant. It may have a direct impact on financial statements. Understood? Next. Then this separate question might come here. Write about controls over completeness and accuracy of information. There will be controls for completeness of financial statements, completeness of recording, and there will be controls for accuracy of the recording. Totally. For example, billing system. You see billing system, you automatically scan how many units and the rate is predetermined. So automatically totaling error will be avoided. So that's a control. Accuracy related controls. Yes or no? Automatically, whenever, suppose you see in a bank, when you withdraw money, automatically the balance will be computed, arithmetical accuracy and all system only will take care. That's control. Controls for completeness. What do you mean by controls for completeness? Purchase order register is a control for completeness of recording of purchase transactions. Purchase order register, for every order that we place, we record it in register. And whenever we receive it, when we receive the goods, we maintain separate register, GRN. Whether we have received all the purchases that we placed order, POR control is there. Purchase order control. Are you getting it? So for everything, again you see in Amazon, when you place an order, order confirmation you'll get. Once you get the delivery, invoice you will get. Invoice is different, order is different. Order copy, order confirmation is a completeness related control. So there will be controls over completeness and accuracy of information. Just for completeness purpose and accuracy of information purpose, there will be certain controls. What are they? Controls over completeness and accuracy are relevant if auditor uses the information for designing and performing further audit procedure. Whenever we are using some information, we wanted to know whether that information is complete or not. And when auditing revenue, the auditor evaluates accuracy of price information and completeness of sales volume data. So we want accuracy of sale price, and we should also know whether all the sale units are recorded. Only then sales value will be correct. Remember, in analytical procedure also there is one point. I think analytical procedure you will be watching later. Okay, you will get that point. Whether the analytical procedure result will be reliable or not, that is influenced by accuracy of the data, reliability of the data. Like that, some discussion will come in analytical procedure. So there you will understand. Next example, purchase order register control. Next, a purchase order register control ensures that all purchases are correctly recorded. Next, and there will be some other controls called operational and compliance controls for completeness and accuracy. Controls related to operations and compliance may be relevant if they involve data the auditor evaluates or uses for audit procedures. For example, use purchase orders to verify accuracy and completeness. Verify completeness of recorded payments. Bank statement will be a control. That's a thing. Using bank statement, you can see whether your cash book is correctly updated. So these are all various controls. Getting it? So controls over completeness and accuracy. So controls over completeness and accuracy are relevant if auditor uses the information for performing further audit procedure. For example, when auditing revenue, the auditor evaluates accuracy of price information and completeness and accuracy of the sales volume data. Another example is purchase order register control. Controls related to compliances and operations. Controls related to operations and compliances objectives may be sometimes relevant if they involve data the auditor evaluates. For example, fixed asset register is maintained. Fixed asset register, for operational aspect, it is maintained. The same data may be used by auditor to do physical verification of fixed asset. Are you clear? Next, and many companies will maintain entry and outward, inward and outward registers. They will maintain, like what are all entered inside, goods, material, whatever, machinery, what are all went outside. That's for operational purposes. That may be useful for physical verification of fixed assets. Indirectly, that will help us to detect any material misstatement in financial statements. So these are all some operational controls which may be relevant for the auditor. There will be controls over safeguarding of assets. Again, controls over safeguarding. Here there are two objectives. Financial reporting objective is there, operational objective is there. For example, we gave some standard, we set some standard. For every 100 units of output, you can use 120 input raw materials. You can take 1 ton and give an output of 750 750 kgs output. So we can put some normal loss, abnormal loss, standard consumption norms. This is also an operational control, just to protect the assets, just to ensure that the assets are used efficiently. So controls for safeguarding related to operations are usually not relevant to financial statements audit. Generally, we don't bother about that. For example, preventing excess material use in production or meeting input output ratio. These targets may not be important for the auditor. Understood? Certain operating controls may be relevant for auditor. For certain operating controls may not be relevant for the auditor. Why in a company raw materials are consumed high? Why scrap is generated more? We don't bother about it unless it's a government audit. In government audit, we are bothered about efficiency, effectiveness, economy. But in a normal regularity audit, private sector audit, we are not bothered about it. Correct? Next, financial reporting. The auditor focuses on controls which are relevant for reliability of financial reporting. For example, assets valued above 5,000 are considered for financial statement audit. Next, examples of safeguarding controls: asset tagging, physical verification of assets, all that. Safeguards for example, best example, you go to any store, ready-made store, every shirt or pant, whatever it is there, some tag will be there, RFID tag. If you cross that barricade, it will siren, the alarm will buzz, yes or no, buzzer will play, correct? So that's nothing but asset tagging only. Understood? So these are all the controls over safeguarding of assets. So internal controls for safeguarding of assets may be for the purpose of financial reporting or operations or both. So there will be controls for safeguarding which will be useful for both financial reporting and operating. So this is regarding internal controls over safeguarding of assets, which itself can be asked as a separate 4 marks question. Next. Now the auditor has to understand the controls, right? How you need to understand, to what extent you need to understand. You need to consider whether a control can effectively prevent, detect, correct material misstatement. In this context only we understand whether a particular control is preventing misstatement, detecting misstatement, correcting misstatement. So whether this control has a relationship with misstatement. It is the nature of understanding we want to obtain. Now a control is considered implemented. How do I know whether a control is implemented? If at all existing, an entity is using it. Security guard is there, that's a control. Exit control. Next, the design of control is evaluated first. First we will identify how the control is being designed, what process exactly they need to follow. Improperly designed control may indicate significant deficiency. If a control is improper in design, then this may be called as significant deficiency. So the auditor has to perform procedures to obtain evidence about design and implementation. With respect to control, auditor has to get an evidence on design and implementation. So what is the nature and extent of understanding? What nature of understanding? You have to obtain evidence about implementation. Inquire, inquiring entity personnel about what processes they implemented. Observe the specific control applications. Inspect the documents. Trace transaction through the system relevant to financial reporting. See, not only understanding. Sometimes you have to test operating effectiveness. Unless automation ensures a consistent operation. Generally, if a control is automated, automatically testing need not be done. If it's a control is a manual control, then you may have to test it whether it is functioning correctly or not. Testing a manual control does not provide evidence of its consistent operation, correct? When you test a manual control, the time when you tested whether it is functioning effectively or not, you know. But later on, whether it's effective or not, we don't know, because manual control may not be consistent. For IT control, inherent consistency may allow testing implementation as operating effectiveness depending upon program change controls, all that. In IT controls, no, unless the program is changed, it will be working consistently throughout the year. So I will see whether IT control is implemented. It is implemented. Okay, and you tested it, how it is working, and there is no change in the program throughout the year. Means this IT system will be consistently applicable, consistently working throughout the year. I can take that call. Are you clear? So nature and extent of understanding of relevant control, 4 marks question, right? So consider whether a control individually or with other controls is effective in preventing, detecting, correcting material misstatements. A control is considered implemented if it is existing, an entity is using it. So when an entity is using a control, you evaluate the design. An improperly designed control is a deficiency. So we need to perform risk assessment to obtain evidence about design and implementation. So what procedure you will perform? You will inquire them how the control is designed. You observe how the control is being executed. You inspect the documents and reports regarding control manuals. Yes or no? You trace the transaction through information system whether the control is implemented in the transaction correctly in the same way or not. Tracing through system, no, we will identify transactions, right? This transaction we will vouch, we will test. That is called test of control. Understanding control alone is not enough to test their operating effectiveness unless automation is there. And manual control, no, that does not provide evidence for consistent operation. For IT controls, inherent consistency will allow testing implementation as a test of operating effectiveness. In IT control, no, if you test whether the control is working, that itself is enough, whether it is operating effectively or not. That's it. Depending upon assessment like program change controls or not. You should also keep in mind program change control when you are checking IT controls. If at all program is changed, whenever there is a change, What kind of change is there? After change, how the control is working? Is it effective or not? You need to check. So this is regarding controls, nature and extent of understanding of controls. Now, what is the benefit of internal control evaluation? Like, what is the benefit of internal control evaluation? Obviously, the auditor examines and evaluates internal control to ensure accounting system is adequate and all information is recorded. Our ultimate objective of control checking is ensure that everything is recorded correctly. Reliability of financial reporting. Next, the auditor gains an understanding of accounting system internal controls to determine nature, timing and extent of other audit procedures that are necessary. See, in this entire chapter we are understanding risk assessment. Other audit procedures means what? Further audit procedures. So the auditor understand accounting system internal control system in order to design other audit procedures. What are the benefits? You will understand adequacy of the system, determine whether a control system is adequate. You will understand, verifies whether an effective internal audit department is there or not. Because of understanding internal control system, you will get to know whether internal audit is effective or not. Ensures that controls adequately safeguard the asset. Assess how well management ensures accurate transaction. Ensures reliability of reports. Identifies the extent and depth of examination required in various areas. Determines the most suitable audit techniques. Highlights the areas where there is a weakness. Identify potential recommendations to improve. When you understand internal control, these are the benefits. When you're evaluating internal controls, these many benefits are there. Any 4 benefits. Okay, any 4. That's enough in exam point of view. And obviously, only after understanding of internal control, you need to develop an audit program. Program they're talking, it's not about plan. A program can be developed only after a sufficient understanding of internal control, because what to check, what points to check. What points to check means what processes to check, what processes you should check. Program is nothing but what? Series of steps that are to be performed, that are to be verified by the team, series of processes to be verified by our team. Now, what are all the processes to be verified? Which processes? Only if I evaluate the processes, only if I evaluate the control, I will understand what processes to check. The program can be developed, whether it's a purchase program or sales program, fixed assets program, whatever it is. A program can be developed only after a satisfactory understanding of internal control. Correct? The auditor formulates audit program only after understanding internal control system and how they are actually operating. The auditor must confirm whether internal control system is actually in operation, as management sometimes fails to ensure compliance after registry. Sometimes management, they just implement the control, they may not review it. So you have to test the actual operation and then frame the program accordingly. Reviewing internal controls allows the auditor to to identify controls and implications, enabling objective audit program. To assimilate means, probably here the context will be, so to understand. Okay, to understand, you can simply use the word understand. Assimilate means comprehend, understand. So reviewing internal control allow the auditor to get an idea on controls and its implication, so that you will develop an audit program objectively. Proper understanding of internal control helps the auditor apply audit procedures in different areas correctly. And the extent and the existence and operation of control system influence the plan for test checking. Correctly, test checking is influenced by controls existence. Weak controls. When internal controls are weak, the auditor might choose additional procedures or alternative. He will extend the test to cover more transactions. He will perform extra test to get reasonable assurance satisfaction. Correct? For example, if internal control over wages is weak, the auditor may include observation of wage distribution. If controls over sales and trade receivable is weak, the auditor may get confirmation on the balance sheet date, cover large sample of trade receivable. If controls are satisfactory, confirmations can be obtained at any other time near the balance sheet date. If controls are not accurate, auditor want to know exactly what is the outstanding amount on balance sheet date, because he is doubtful about accuracy. So that's about development of an audit program after understanding. This itself can be asked as a 5 marks question. Next, how should I evaluate? Okay, I need to evaluate the control, I understand. How should I evaluate? There are 4 methods of evaluation. There are 4 methods of evaluation of internal control. 1, narrative record. Method number 1 is narrative record. What exactly is happening in the company? I will develop a detailed description. I will develop a detailed paragraph kind of. Okay, detailed description of system in operation. This is suitable in case of small businesses where there is no formal control system. What exactly happening in a normal grocery store? You can develop a narrative record. Disadvantages: difficult to comprehend, difficult to identify weakness, and update for changes. It is difficult to update for any changes because narrative records is often in descriptive format. Checklist: there is another method called checklist. Okay, checklist ICQ I will come at last. Flowcharts: there is another method called flowcharts. Through flowchart also you can evaluate an internal control. What is a flowchart? You know, it's a graphic representation of internal control system showing activities, goods, material flow, and cash inflow, outflow. Entire internal control system in the organization or purchase related system, how purchases are happening, they will give a flowchart. You know, first stores will, you know, in flowchart, no, graphics will be used, arrow marks will be used, so it will be easy to understand and it will be easy for us to spot deficiencies. So it provides concise view, it reduces narrative descriptive explanation, shows transaction flow stages, gives a bird eye view, easy identification of areas for improvement. Flowcharts. In exam they may ask you, write about flowcharts, 4 marks or 3 marks question. Write about narrative records and flowcharts, they will ask you. Next, checklist. There are checklist and questionnaire, they both actually look same. In both the cases questions only will be there. But in checklist, no, auditor himself fills that. Whereas in questionnaire, no, auditor will design the question, management will fill the answers. Questionnaire is something given by auditor to management and management will reply. So checklist is nothing but series of instructions or questions about the control. Responses are usually yes, no, not applicable. Checklist for purchases: are tenders called? Is purchase order standardized? Is purchase order having pre-number? Is store requisition received? Is purchase order authorized? All these questions. Auditor will go and check the actual system and he will tick it. Questionnaire. No, it is a comprehensive set of questions which is talking about existence, operations, efficiency of control. Main advantage is it oversight or omission of significant control is less likely. Like, you know, oversight of any small controls, all that is very less. In questionnaire, no, we cover all types of possible questions. IC evaluation can be reviewed in sections or interim basis. General practice to review control system annually. Answer yes denotes satisfactory, no denotes weakness. Usually it is issued to the client for completion by executives and employees, followed by auditors review and recommendations for improvement. So questionnaire is something that is usually issued to the client, where their client executives, client employees will fill it. Then auditor will review it and recommend for improvement. The answers are usually yes, no. No indicates a weakness, yes indicates satisfactory. In such a way we design questions. We design questions in such a way. Yes. So yeah, once again I'll repeat ICQ. Okay. Usually ICQ is issued to the client, where client executives employees will fill it, then auditor will review it and find recommendations, and then he will give recommendations. Here the questions are drafted in such a way: yes means satisfactory answer, no means some weakness. Wherever no answer is there, we want explanation there of the client. General practice to review internal control system annually. It is better to review at least once in a year and record the details. Yes or no? Then internal control evaluation can be reviewed in sections or interim. Main advantage is omission of significant control is less likely. Big controls and all you can't omit. In a questionnaire you try to cover almost every significant control aspect. And this is a comprehensive set of questions about the existence of the control, operation of the control, efficiency of the control. We will cover existence, efficiency and operations. All the points will cover in ICQ. For example, there is an ICQ for purchases. How an ICQ will be there for purchases? In exam, this itself they can ask. Or ICQ for creditors. Or they can ask you ICQ for fixed asset. Getting it? Anything they can ask you. Or they can ask you ICQ for inventory. For example, purchases. How ICQ will be there for purchases? Questionnaire. Are purchases centralized in purchase department? Yes means positive answer. There is a purchase department. Are purchases made only from suppliers who are approved? Yes. Yes means a proper answer. Is list of approved suppliers maintained? Vendor master is there in the company. Okay, company will finalize who are the vendors from whom we can place an order. So that's a satisfactory answer. Does the master list have multiple sources of key materials? Are purchase orders based on valid requisition by authorized personnel? Are quotations invited? Are purchase orders pre-numbered and signed by employee? Are all materials are received only in the receiving department? Are receiving staff restricted from issuing orders because of receiving departments and purchase order department both must be different? Are materials inspected by the receiving department? Are receipt evidenced by GRN? Receipt department received the goods? No, they should issue GRN that they received the goods. These are all various controls in case of purchases. Questionnaire, internal control questionnaire. Creditors. Are suppliers' invoices sent directly to accounts department? Are they entered in a bill register? Are advances payments noted on invoices? The system ensure all invoices are processed? Are quantities reconciled with purchase invoices? Does the accounts department match invoice GRN and purchase order? Are prices and terms checked and duplicates invoices marked? Are supplier statement compared with ledgers? Are unpaid creditor list prepared and reconciled periodically? Inventory. Are stocks stored in a proper area, assigned area? Are stocks comprehensively insured? Is the adequacy of insurance reviewed periodically? Are perpetual records maintained? Are they reconciled with accounting records? Are shortage excesses investigated and adjusted with after approval? Are there norms for stock level, minimum, maximum, reorder? Then fixed assets. Are budgets there for capital expenditure approval? Is authority for expenditure restricted to some specified officials like board of directors? Are capital purchases subject to purchase control? Are fixed assets verified periodically? Is there a written procedure for verification? Are reports prepared including details of damaged and obsolete items? Are discrepancies in verification investigated and corrected in the records with appointing authority? So many questions. Anything you take, some questions I will have. That questions I will ask them. Accordingly, I will get an idea what control is effective, what control is not effective. Then I will plan my further audit procedure or audit program. Understood? Now look at, these are various methods of evaluations. Remember. So, auditor determines controls and procedures by reviewing manuals, organization chart, flow charts, and through inquiries with officers and employees. So, how auditor will how he will determine about controls? By reviewing manuals, charts, all that. Auditor must understand how accounting information is collected, how it is processed, and how it is controlled, so that assets are protected, information is reliable. In many cases, little written information is available, so the auditor must ask the right questions to obtain necessary details about controls. Auditor should make written notes of relevant information from manuals and or any information that he obtained through inquiry. So whatever you feel important, he will take a note of it. Next. Why test of controls are performed, what it includes. After understanding the controls, the auditor will conduct a testing on a selective basis to ensure system is actually in operation. We take some few transactions and we test the transactions to know whether the control is effective. Testing can be planned to cover all important areas over a period. And further remember, once in 3 years, even this is actually COSO framework says. Even IFC framework also says the same in India. Once in 3 years, auditor has to do test operating effectiveness. You need not test every year. Test of controls provide evidence about effectiveness of design of the control, operation of the control throughout the period. It includes control environment test where strength reduce control risk. If control environment is strong, control risk will be reduced. Procedures for understanding controls may also provide evidence for effectiveness. Whatever procedures you are performing to understand the control, no, in questionnaire, narrative records, like that methods, no, they themselves will give you do simultaneously testing also. That itself will give evidence for testing, operating effectiveness. Example, sales control procedure. Check inventory position before accepting order. Authorized advice sent by sales manager with order acceptance. Standardized forms are used which are forwarded to inventory section. Normal credit period allowed with special credit requiring manager approval. Clear terms for rates, transport, everything. Credit worthiness reviewed by a credit section. Credit team will be there, they will review. Test of controls includes inspection of documents, inquiries, re-performance, testing IT control. Verify transaction authorization. Check who performs the function versus who actually supposed to do. Re-perform the controls. Assess specific computer application and IT functions. Access controls. Test compliance with procedures for initiation, authorization, recording, documentation at each transaction stage. Like who sent material requisition note to purchase department, who sent that, Who is authorized there? The same person sent or not? Now, who placed the purchase order? Who designed the order? Same person or not? Respective person or not? Who approved it? As per the control manuals, you will find all that. So test compliance with procedures. So test compliance with procedures for initiation, authorization, and recording. Recording will be by accountant. So no, authorization will be by finance manager, production manager. Initiation by stores team. Next, sometimes no, you will identify deviation from prescribed control. What is prescribed in manual? Okay, in the company's internal control manual, what is prescribed? Auditor, upon verification of control, he found a deviation. When you find a deviation on verification, specific inquiries on deviation. Auditor makes specific inquiries on deviation to assess implications. Sometimes no control might be deviated, but that may not result in any fraud or error. If deviations are significant, auditor revises preliminary control risk assessment unless supported by other control test. If deviations, if there is a huge control risk, if there is a huge control deviation, auditor will change his preliminary control risk assessment. You know, control risk assessment, auditor might keep it as low or might keep it as high. Suppose originally control risk assessment he kept as low, but when he is verifying the control, he found deviations. Once he studied the internal control as per the policy, he felt control risk is low. After when he is verifying, he felt that control risk might be high. Adjusting, when a control risk is revised, the auditor modifies the nature, timing, and extent of substantive procedures. If you modify the control risk higher, you will naturally increase the substantive procedures. So that's about internal control topic. Full-fledged we understood. Complete internal control topic is over. Clear all of you? Deviations from prescribed control. Then we have in 330. 330 is already completed, already I explained, but once again I will roughly explain 330. You see in 330, what is 330? Auditor's response to assessed risk. I already completed, but once again I am covering. Whatever the risk you assessed as per 315. How do you assess the risk? Control risk assessment, just now I told, right? You do understand the entity and its environment, you evaluate internal control, you get information about internal control, you test the internal control, then you will fix one risk. Now how do you respond it? Yes or no? So this actually 330 standard is the one which is actually talking about further audit procedure. 315 is talking about risk assessment procedure. 330 is further audit procedure, nothing but. So what is the objective? This standard deals with responsibility to respond to the risk of MMS identified as per 315. The objective of this standard is get sufficient appropriate evidence by designing and implementing appropriate responses to assessed risk. So designing further audit procedure. When you are designing further, no, identify the reason for risk assessment at assertion level. What is the likelihood of misstatement? What is your assessment of controls? Control risk, how did you classify? And how far you can rely upon control effectiveness? Accordingly, plan your further audit procedures. Obtain more persuasive evidence for high risky areas. Perform test to evaluate operating effectiveness of control. Obtain more persuasive evidence. Nature and extent of test of control. To what extent? You generally combine inquiry with other procedures like inspection, reperformance to assess the control. How the controls were applied, with what consistency it is applied, who applied, determine reliance on indirect controls, combine inquiry with inspection, all that. Adjust testing based on nature of the control. Timing, test of controls for specific time period or throughout the period. Test controls for a specific period or throughout the period, depending upon the auditor's need. Point in time evidence may be sufficient. Generally for some controls, no, when you test, no, that time you get evidence, no, that is sufficient. For reliance over a period, perform test to verify controls operate effectively throughout the period. You can also use evidence from previous audits. Okay, considerations for previous audit, how effective they are. Characteristics, general IT control effectiveness. If general IT controls are effective, you can use previous audit evidence also. Controls effectiveness and deviations noted in previous audit, check that also. Risks due to lack of change, identify, consider that also. Material misstatement risk and level of reliance. Ensure continuing relevance of prior evidence. Specific inquiries when deviations are identified. Assess if test of control provides sufficient basis for reliance. Determine if additional tests are required. Address potential risks of MMS using substantive procedure. All this actually I covered. Then substantive. Substantive procedures are performed for each material class of transaction, account balance and disclosure. regardless of assessed risk. Purpose, it is designed to detect material misstatement at assertion level. Test substantive procedures are two types, test of details and analytical, correct? Details means verification of transactions and balances. Substantive analytical means they use financial data and plausible relationships and investigate fluctuations. For that, what is substantive analytical, I detailedly covered in 520 standard. Nature and extent of substantive, you can only perform substantive analytical if it is sufficient to reduce audit risk, and you can use test of details if supported by control testing. Combine analytical and test of details for most responsive risk assessment. Increase extent of procedure when control tests are providing unsatisfactory results. If controls are not effective, then you will increase substantive testing more. Consider sample size and alternative testing method when designing test. That's it. Entire risk assessment topic is over. Now you understood why I say this topic is very tough. In fact, I can discuss even more and more examples also. It's already with question bank discussion all put together, it is coming to 95 to 100 hours. But all again we discuss in depth, it will take another 5 to 10 hours for this chapter to get absolute command. So that's the reason this is so lengthy. Many points will be confusing, especially internal control topic and 330 standard. That is the very reason I always tell this, you keep it under 1/4 priority topic. Okay, not in the 3/4 main, last priority this. Just you listen to the class, understand conceptually. If at all an MCQ comes, you can answer. Understood? That's it. So with this, risk assessment and internal control is complete.